Hearing of the Senate Economics Legislation Committee inquiry into the Treasury Laws Amendment Tax Reform No. 1 Bill 2026 and Income Tax Rates Amendment Tax Reform No. 1 Bill 2026. I begin by acknowledging the traditional custodians of the land on which we meet and pay my respects to their elders past and present, and I extend that respect to Aboriginal and Torres Strait Islander peoples here today. The committee will be conducting today's hearings in person and via teleconference. I am Senator Lisa Darmanin, and I am joined today by the Deputy Chair, Senator Little, and Senators Walker, Chandler, Dean Smith, Senator Andrew Bragg, O'Neill and McKim, who will also be joining us. These are public proceedings being audio broadcast live via the Parliament's website, and a Hansard transcript is being made available. If there are no objections, the committee authorises media reporting and photography of the committee's proceedings in accordance with Senate Resolution 3. I remind the media that this permission can be revoked at any time, and the media must follow the direction of Secretariat staff. I remind all witnesses presenting in Australia that in giving evidence to the committee, they are protected by parliamentary privilege. It is unlawful for anyone to threaten or disadvantage a witness on account of evidence given to a committee, and such action may be treated by the Senate as a contempt. It is also a contempt to give false or misleading evidence. Witnesses also have a right to request to be heard in camera. If a witness objects to answering a question, they should state the ground upon which the objection is made, and the committee will determine whether it will insist on an answer having regard to the ground which is claimed. If the committee determines to insist on an answer, a witness may request that the answer be given in camera. I remind senators of their obligations under the Behaviour Code for Australian parliamentarians to treat witnesses with dignity, courtesy, fairness and respect. I remind committee members and witnesses who are appearing via teleconference and who are not speaking to mute their microphones. So I now welcome representatives from the Institute of Public Accountants and Chartered Accountants Australia and New Zealand. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full names and the capacity in which you will appear today? And I will start on my left.
Yeah, Tony Greco, Senior Tax Advisor, Institute of Public Accountants.
Susan Franks, Australian Leader, Tax, Super and Financial Services, Chartered Accountants Australia and New Zealand.
Damien Ogden, Group Executive, Advocacy, Public and Government Affairs, Chartered Accountants Australia and New Zealand.
And Geraldine McGarry, Group Executive, Policy and International, Chartered Accountants Australia and New Zealand.
Thank you very much. I now invite you to make a short opening statement, and at the conclusion of any remarks, I will invite members of the committee to ask questions. Who would like to go first?
Yeah, through the Chair, thank you for the opportunity to participate in this public hearing. Institute of Public Accountants, we are in the main represented by practising accountants. They're the arms and legs that have to make or implement what's been proposed. In regards to our submission, we've only made comment in relation to Schedule 1 and Schedule 4, so the CGT changes and the standard deduction. For the record, instant asset write-off. We applaud the decision made in the budget. We also applaud the loss carryback. It's a good feature. It helps viable companies deal with shocks to the system, so it acts as a good tax absorber. Now, the first point I want to make in regards to what is in the bill that we included in our submission is that we are not completely reverting back to 1999 indexation for the following reasons. There is no averaging. That's off the table. The ability to use losses. There is a mandatory ordering of the way you can use losses under what's been proposed. The minimum 30% tax rate is a new feature. No longer any pre-CGT assets, and this one's particularly important because of what else has been proposed in the budget. I'm referring to the discretionary trusts. Companies do not get access to indexation. So no model is perfect. Indexation, one of the not so good features of indexation is the way it treats nominal losses. I'll put that on the table. Now, the other thing, when we went from indexation to the 50% discount, averaging was taken away and companies did not have access to any CGT relief. Now, the second point I'd like to make is regarding the actual consultation process, or the lack of. We've pretty much thrown the book out the window in regards to process. And there's a good reason why we have protocols in relation to consultation. Even with consultation, we always put in a post-implementation review process to make sure in the real world, the intended outcomes for anything that's been proposed is actually being achieved. So bad process invariably leads to bad outcomes. So the time period, this bill was in the main introduced without public consultation, except for Schedule 4. We did see an exposure draft for Schedule 4. We only had 11 days to respond, and I'm referring to the standard deduction. There are lots of interactions with CGT. Treasury have done a reasonable job trying to put the legislation before us, but there are interactions with employee share schemes, with the small business CGT concessions, and early investor concessions. There are consequences for doing it this way. Legislate, consult later. We end up with unintended outcomes, subsequent amendments, uncertainty, disputes, and real-world implementation issues. Now, all of us in the tax world, we adhere to good tax principles, and I'm referring to fairness, efficiency, and simplicity. Now, these CGT changes, there's a black mark against all of them, and sometimes there's a little bit of trade-off one over the other, but rarely do you see across all three. And there's also this issue of compliance and complexity. Now, Treasury have put a number in the explanatory memorandum, and I think it's in the vicinity of $88 million. Our belief is that that is grossly underestimated, and valuations, particularly for illiquid assets, cost a lot of money. So we're almost forcing people to get a valuation for these illiquid assets. And then the extensive use of legislative determinations. Now, they are good, they provide flexibility, but the number and what goes to the heart of some of these changes, there are three particular legislative determinations that should be in the primary legislation. I'm referring to the definition of new residential, important in regards to the apportionment, the methodology, and what other assets are eligible for the 50% discount. Those three out of the 9 should be in the main legislation. So no one likes to sign a blank checkbook. We don't want to go into this debate with our hands behind our back. The third point, and this is where
there'll be time
Yep.
to dig into quite a bit of this. So if
third point is just around
enable time
the
for questions.
broader economic impact of what's been proposed. And I think that was well articulated yesterday. And lastly, the standard deduction. We have got comments, and I invite questions, so I might stop there.
Yeah, thank you so much. Mr. Ogden? Yes. Thank you.
Thank you, Chair and members of the committee. Thank you for the opportunity to appear today. Chartered Accountants Australia and New Zealand represents more than 140,000 financial professionals, supporting them to build value and make a difference to the businesses, organisations and the communities in which they work and live. Our members play a critical role in the economy, supporting individuals, small businesses and large organisations to understand and comply with Australia's tax system and to make informed decisions based on that advice. The proposed changes to negative gearing and the capital gains tax regime are significant. They form part of a broader package designed to reshape incentives in the housing market and alter the way capital gains income is taxed in Australia. Our focus is ensuring that, if implemented, the law is clear, coherent and workable in a self-assessment environment, and whether taxpayers and their advisors can apply it with confidence and ease. Poorly drafted and overly complex laws increase compliance costs, create uncertainty and risk unintended consequences. From our perspective, more comprehensive consultation upfront will reduce the risk of technical issues and the need for later amendments. A consistent theme in our submission is the need for legislative clarity and certainty. Key policy elements are being explained in the exploratory memorandum or left to future legislative determinations, rather than being clearly stated in the law itself. In a self-assessment system, that is problematic. Taxpayers and those advising them need to be able to look at the legislation and understand how it applies to their circumstances. The proposed changes introduce complexity, particularly in the CGT rules, including new classifications of gains and losses, valuation requirements at 1 July 2027, and more complex record-keeping obligations over time. This will impose real compliance costs on Australians. CAANZ has 3 suggested changes to the proposed CGT provisions. First, changing the ordering in which capital losses are to be used to preserve the grandfathering of the 50% discount. Second, changing the rules that currently prevent a taxpayer from accessing indexation if they've been a non-resident at any time when they own the asset. And third, allowing companies to access indexation. CAANZ acknowledges the concern of tech startups about the difficulty of indexing an asset that has a low-cost base. Tech startups are not the only businesses that face that situation. Increasing the thresholds for the small business capital gains tax provisions that provide a 50% discount for active business assets and reconsidering the use of an income averaging mechanism could help remediate this issue without requiring industry-specific provisions. CAANZ's message is straightforward. If Parliament is undertaking major tax reform, the legislation must be clear, coherent and administratively workable and fair in its application. We stand ready to work constructively with the Government, Treasury and the ATO to ensure these reforms achieve their intended purpose in a way that works for all taxpayers in practice. Thank you, and I'm joined by my colleagues Susan and Geraldine from Chartered Accounts.
Thank you. We will go to Senator Chandler for questions first.
Thank you. So we might start with, sorry, glasses on, the Institute of Public Accountants, if I may. Just on the simplicity issues, do these bills simplify the tax system or do they make it more complex?
The answer is much more complex. We've got new definition or new method statement for actually calculating a capital gain. Under discounting, you could basically, most people could actually calculate the CGT net gain on the back of an envelope. We're going from that to something much more complex. And invariably, there will be a need for a tax professional to review the calculations under self-assessment. We've got onerous obligations under self-assessment. By far, the complexity of dealing with a pre and a post, 2 regimes, the different types of capital gains created by this legislation, the need for valuations, things like dividend reinvestment plans. You're creating a lot of complexity for something quite small. The only caveat I have is the apportionment that will be an legislative instrument is yet to surface. But invariably, even if that document were to surface, the requirement on the 1st of July 27 for evaluation increases the complexity.
Next to the fairness question, do you think the CGT changes are fair or do they unfairly treat some taxpayers? Again, if you've been listening along at Senate estimates a couple of weeks ago, and I won't blame you if you weren't, we went through some of the examples of low-income earners, part-time workers, women on maternity leave who might want to sell a few assets to supplement their income while they're off from work, and the impact that these changes will have on them now that they will now face a minimum 30% tax rate. Now, we couldn't really get a straight answer out of Treasury as to whether that would be the case. Is that the case, and is that fair?
First of all, under indexation, we had averaging, recognising the lumpiness of selling capital assets. We don't have that now, and it makes things worse when you impose a 30% minimum tax rate. And you're right, there are people not engaged in tax minimisation, people out of the workforce for part of the year, or self-funded retirees, or there's lots of scenarios where they'll end up paying more tax. And it's not about tax minimisation, it's just the way that 30% will work going forward.
On the efficiency and productivity issue, again, this is something that we transversed in our hearing yesterday. Do you think these reforms will promote an increase in productivity, or do they risk distorting investment decisions and reducing capital allocation to productive sectors?
See, that's a very important question in regards to productivity, because we don't see the CGT changes helping with what the government has said is a significant long-term problem, productivity. You're skewing investments in favour of low growth and instead of high growth. And to me, that just doesn't make economic sense. We need more entrepreneurs. We need people to risk capital. We need innovation. All these things reduce the economic pie. So from that perspective, productivity, I'm yet to be convinced that these CGT changes will in fact help in regards to the productivity agenda that the government said was all important.
When you say reduce the economic pie, what do you mean by that, and how do you think these changes will do that?
Okay. If you've got a business and you reduce the amount of investment in the business and you just chunk along, pay dividends, that's what the market will want companies to do under this. But also, we need more entrepreneurs. We need people to risk capital. And risking capital comes with, you want a reward for that risk. We're telling people, don't go and earn above inflation. And that's what it's doing. It's skewing the economic decisions. Now, this compounds. We're sending a message to the broader community that don't go for high growth. And what is the rationale for this change? Outside of residential investments, the rationale is that we should align income, salary and wages with... Now, even Ken Henry recognised the importance of treating capital a little bit differently because it grows the economic pie. It turns the wheels of finance. It's basically the thing that incentivises people getting up in the morning, risking capital, working hard and trying to get ahead. I mean, what is at stake here? So I'm challenged by what is the productivity to be gained from trying to align. Now, the high personal tax rates on salary and wages, that's a symptom of another problem that we're trying to fix. It's basically, you can't put a Band-Aid on a scratch. We're talking about an open wound here that needs major surgery. Our high personal tax rates is really what will fix the long term in relation to trying to align those two. So I'm in the business camp here. I'm saying that it doesn't appear to be a strong case for going down this path.
And beyond all of those concerns about productivity that you've just outlined, would it also be fair to say that the compliance costs that will be associated with businesses trying to figure out a way forward, given these changes, would have a productivity, would result in a productivity slowdown as well, right? The lawyers, the accountants that businesses are going to have to engage with to figure out what these changes mean for them and how to manage their businesses going forward. Yeah. That's surely got to be a huge productivity drain.
It absolutely. I mean, the phones have been ringing off the hook since budget, and I can tell you one thing, it's not the negative gearing changes, it's the CGT changes and the discretionary trust.
Yeah.
Now, there is a submission which you have access to, which tries to quantify the complexity and the compliance costs in relation to these measures, and they're not insignificant. We're imposing a huge compliance cost and much more complexity. And the standard deduction, for example, is trying to drive people, make their compliance obligations a lot easier. Even in retail land, these are complex provisions that everyone will get caught up in when they sell a CGT asset. I can't stress the complexity and the compliance costs in associated with this measure. And then you've got to ask yourself, why are we doing this?
You're at 8 minutes.
Thank you, Chair. I might just ask a couple of questions to the Chartered Accountants now as well. What are your views on the consultation process that the government has gone through in regards to these changes? obviously we're not talking about really small and significant changes to our tax system. They are huge reforms that are going to have a huge impact. Do you think that the consultation has been good? Were you consulted with by the government prior to the changes being made?
We weren't consulted by the government prior to the changes being made. We have had the same time as the Parliament to actually look at this legislation.
Wow.
It's a very short period of time.
It is.
In which to actually analyse these provisions, which is why we've recommended that there be a statutory review within 1 year.
So, in this being the government's approach, are you concerned that there would be, I mean, you probably also already foreshadowed this by saying that there needs to be a statutory review, but are you concerned about unintended consequences of this legislation that we're talking about here today, or indeed the impact of any regulation that has to be made under this legislation? We don't know what the detail of that regulation looks like yet, do we?
We would like the number of legislative determinations to be dramatically reduced in this legislation. When you're drafting tax legislation, there is a great need for certainty, particularly as we're under a self-assessment system, and leaving core concepts to legislative determinations or describing key aspects of the legislation in the explanatory memorandum is far from ideal. Our members have actually got a lot of clients knocking on their door, as Tony has said for the IPA, wanting to know the impact of these budget changes. And looking at this legislation, when you've got new residential dwelling not defined, when you don't have a valuation mechanism explained in the legislation, it's very difficult for our members to give guidance to their clients. So we need to have the legislative determinations and the key concepts that are discussed in the explanatory memorandum to be included in the legislation, so people do have certainty and can start analysing this legislation in greater detail.
Just for those listening along at home that may not have the experience in your industry that you do, why is certainty in the tax system important?
Certainty is important because that's how people make investment decisions and how they actually plan ahead. So having the ability to know what the rules are and to be able to see it on the legislation is important. If there's a dispute between a taxpayer and the ATO, the courts look at the legislation and only go to the explanatory memorandum if there is doubt. So that's why we're arguing strongly for key core concepts of these proposals to be included in the legislation, which will also enable the Parliament to do an appropriate analysis of what is actually in the legislation.
But just one more question, Chair. Would it be fair to say that accountants are currently in a position where they cannot explain to their clients what these changes are going to mean for them exactly because the scope of the changes isn't clear?
Our members are waiting for legislation to come through and clear legislation to come through so they can advise their clients. At the moment they're saying, look, these are the budget changes, we don't have legislation, we need to get the legislation to actually provide that detailed advice to you.
But they can't provide that advice based off the bill that we're talking about today.
There are key concepts in the bill that are missing, as
Yep.
I said, like the new residential dwelling, and which would benefit from actually being in the legislation.
Thank you. Thank you, Chair.
Thank you. I'll go to Senator O'Neill.
Thank you very much. If I could go first to Cairns, if I can just reflect on your statement after the budget, which essentially indicated that the reforms included genuine positives and address long-standing imbalances. By any book, that's a positive response to the budget. And today we're digging into some of the detail, but overall, I just want to give you the opportunity to explain what you meant by that in a climate of fear and alarm, because people who are running businesses and Australians who need the tax system to work for everybody need to understand what's really gone on here, not just constant fear and alarm.
So, Senator, I think there is wide agreement across the community that there is much needed tax reform. So we encourage tax reform. We do recognise that there are challenges in delivering reform, and I'm glad that we're talking about productivity as well. That is absolutely a national priority at the moment. Productivity means different things to different people, but at its heart, it's about lifting living standards and prosperity for people. It's not purely about tax levels or spending. It is about creating certainty across the community in terms of the tax system. That's why we're encouraging consultation and ongoing consultation to get the legislation right before it goes up to Parliament. But we absolutely, and we've long advocated for tax reform that does lift productivity, and I think that was very much a theme from the productivity roundtables last year. You know, our role as a professional body is to explain those changes and create that certainty once those changes are delivered, and also play that really important role as a trusted advisor to government, across government, around getting the details right.
So thank you for your answer, Mr Ogden. So if I can kind of, over the course of consultation, the productivity roundtables, many discussions there, what you see manifesting in the budget is actually a response to those consultations in some way, particularly addressing productivity. Have I understood what you said correctly?
It's very clear that the proposed changes are moving in a direction that is trying to address systemic problems in the Australian economy.
Yeah.
What we're looking at is how do we get the detail right.
Okay, so thank you for that. So the language that you used, apart from genuine positives, were imbalances. So what are the imbalances that the reform package seeks to address in your view?
Yeah.
Ms Margaret.
Yeah, thank you, Senator. We were looking at the way that, you know, income, capital and trusts are taxed. So you could see that the budget was moving towards having a sort of, you know, a fairly standard rate, whether, you know, the 30% across those three forms of, you know, whether you you take money from capital, whether you take it from your, you know, you're a teacher or etc. earning
Or a
pays,
nurse.
or nurse, yep, earning you know, paying tax as you go, or you're getting a distribution from a tax from a trust. So
Okay, so just before you go on, you said you could see that coming.
No, in the budget. So we're
Yep.
saying from that budget measures that to us looked like that was, again, we thought that was a genuine positive, that there was seemed to be a sort of an equitable way of putting tax onto people, no matter how they derive their income.
And in principle, because yesterday we talked about the principles of taxation, CANS is often perhaps mischaracterised just as a voice for business, but as a social leader and a social commentator, your view, if I can take it from your comments so far, that this reform to more evenly share taxation across whatever way in which income is derived by capital trusts or in a wage is a fair move of reform. Is that correct?
That is correct, although there are, you know, some issues across each of those that we would like to see addressed.
Yep. And we're hearing a range of views about what people have particular concerns about, and they're offering their insights to the government at this stage to say, basically, if I can use your example, we think you're on the right track. A nurse shouldn't be paying, you know, a huge amount of tax when somebody who earns twice as much as that nurse is paying far less. So evening out some of the unevenness there is something that you support, but the way in which that happens is your comments to us today. Is that correct?
Yes.
Okay, fantastic. Thank you. So what are the imbalances that you note that needed redress?
Oh, do we want to start?
Ms Franks.
Imbalances, I mean, the negative gearing provisions have been fairly well accepted by our members. It's just a matter of wanting the clarity about what is a new residential dwelling. So I think they've been thinking that's been a while coming to try and
So
get
in
some...
that you would accord with Mr Greco's observation about the need for a definition of new residents, in addition to the information the government has already provided around duplexes and brand new properties?
What the government has provided so far has been basically in the budget explainer and
Yes.
maybe a couple of comments in the explanatory memorandum.
Yes.
For certainty when you're looking at investing, because I mean, investments in new residential property is quite substantive for your mum and dad investor. They need to have that certainty in the legislation and a bit of clarity there as well
Right. So it is in the explainer, but your argument is that it should be
in the legislation.
in the legislation. Okay. And you accord with Mr. Greco on that. Okay.
Yes.
What else in terms of
In terms of negative
imbalances
gearing,
that need? Yeah.
well, when it comes to the capital gains tax, we certainly have heard from our members as well as the tech councils about the high growth, and as Tony Greco had outlined, when indexation previously existed, there was, income averaging. There was also a 50% discount on goodwill. Now that 50% of discount on goodwill disappeared when it was transferred across to the small business CGT concessions, where you got the 50% discount on active businesses. We would recommend that the government look at increasing the small business CGT provision thresholds. They haven't been adjusted for quite a long time. We've had a Board of Tax report recommending that they be substantially increased. Now, I understand that there has been documentation put out that the small business concessions cover 90% of small businesses at the moment, but it's
1.5 or something.
but it's the 10% of businesses which are actually growing that need to be actually captured by these small business thresholds. So increasing them to...
a number of announcements from Treasury and from the Treasurer, I believe, that there's consultation particularly around those zero high growth entities in both the tech and small business sector, however that might be defined. So that, if we put that off, that is for consultation. So if we just come back to the CGT.
Well, the CGT, we'd be concerned about industry-specific carve-outs. We think it needs to be more general than that, because it's hard to pick winners as to which companies are going to be growth industries and which ones aren't. I think you need to be more general in the provisions that you're putting forward. Otherwise, there's lots of entities that have growth in goodwill other than just a tech startup or a biotech, or it could be the space industry. It could be just somebody who's a really good consultant that have built up a business based on their name. So all of those type of people, it's very hard to pick a winner or a particular carve out for a particular industry. So to be more generic along that.
So consultation continues. If I could just, I've only got 1 more minute. So Ms. Margaret, if you
I
want
just want to add one more thing, Senator, which is actually just around the application to non-residents. So Australians who may have gone offshore for a couple of years, they may have been seconded with their organisation, but they are, they're good Australians who have, been taxpayers for a long time. The way that the legislation is drafted, that that asset is outside of, they don't get any indexation to their assets. So we feel like for non-residents, this is Australian non-residents who are only a non-resident for tax definition for a short period of time.
Yeah.
They shouldn't be disadvantaged.
Okay, that's noted. Could I go to the instant asset write-off? A very significant Labor policy established a long time ago, removed from access by the incoming Abbott government, which really hit those businesses pretty hard, now to become permanent. Could you just give me a sense of what that does? I'm looking at an ATO explainer about Jack, the sole trader with the aggregated turnover of less than 10 million. He purchases an excavator for $220,000 for his business, talks about the dates he purchases it on. And then, of course, if you have an excavator, you need different size buckets, and he buys a bucket for $19,000. Could you explain why making such deductions of a bucket for an excavator operator running a sole business is actually an important thing to lock in as a policy for this country?
Chartered accountants have been advocating for the instant asset write-off to be made permanent for a number of years, and we were very glad to see the government made it permanent in the budget. It provides cash flow benefits to the small business, but more importantly, it actually provides some certainty so that they can know what they can plan when they're doing their investment plan going forward. It's got rid of that business uncertainty by making that permanent. Chartered accountants also have been a strong supporter of loss carrybacks for quite a long time, and we're pleased to see that that's been made permanent. And there was also the budget announcement about new to business and getting some tax benefits there in relation to FBT and PAYG withholding that's coming in as well. So that was a welcome announcement too.
Thank you very much. Thank you, Chair.
Thank you. Senator Chandler.
Thank you, Chair. Interested in both sets of witnesses' insights on this one. The government has estimated that the CGT and negative gearing changes will increase average regulatory costs by $88.4 million per year for individuals and businesses. Do you think that is a reasonable cost estimate?
We haven't actually done a cost estimate, but there will be a substantial increase in compliance costs. A lot of it will be coming through from the need to value your assets at 1 July 2027 from a CGT perspective. So people will need to get valuations. I mean, if you own a publicly listed company, that's relatively easy. You just get it from the stock market. And we've been talking to the tax office to try and see whether for everyday Australians that have investments in publicly listed shares, whether the ATO could actually capture that information and make it available via pre-fill. But for those that have investments in private companies and need to value goodwill, valuations can be quite expensive. So they're going to be substantial costs. And as Tony Greco outlined earlier, there's also an increase in compliance costs in that when you sell an asset that you own now, you'll have to do two calculations, one for pre-1 July 27 and one for post-July 2027. You've got 4 different classes of assets and 4 different classes of losses, which you need to keep track of, which will require a tax agent to help you with.
Mr. Greco, did you have anything to add to that?
Yeah, just in relation to the small business CGT concessions, there is a lot of confusion. It's hard for an accountant to say this, but they are very generous. But you have to meet the eligibility criteria. Why I say they're generous is there's no upper cap for the preferential tax treatment on the gain itself. Now, the Board of Tax have done a very good, and I was part of that task force. Back in 2019, we put together a package to make them fit for purpose. Simplify them, allow more small business to be eligible, but actually cap the size of the gain. That particular concession, we saw the data back then and it was unsustainable. So we need a circuit breaker. Now this has come along and it's exposing companies that do not meet that criteria to indexation. So that's not a good for people that risk capital. So indexation does not work for high growth, and we've seen that for employee share schemes. I mean, we're trying to legislate and then consult in regards to the carve-outs. It should be the other way around. So in relation to the CGT changes, the negative gearing ones, you can proceed. Any non-residential CGT asset, I think there's a lot of work to be done on getting all the ducks lined up. We've got employee share schemes, we've got early stage investors, we've got the small business CGT concessions. All these have to work with what's being proposed. So we're just at the starting gate. And there's a lot of unintended consequences. If we try to bung this through Parliament, you can dissect the bill, proceed with parts, and you'll find there will be a lot less noise in relation to this bill if you took out non-residential assets.
Just on the valuations question, I mean, I think you've already alluded to this, Mr. Greco, a concern with how heavily reliant these changes will be on valuations. Do you believe there's currently industry capacity to undertake those valuations, or is this something that the industry is going to be completely swamped once these changes take place?
It will be completely swamped because you're talking about anything that's illiquid. Anything that's listed on the ASX, not a problem. There's a transparent market price. You don't have to pay. just to get a real estate valuation, you could be paying anywhere from $300 to $1,000. Now, when it comes to a business trying to value goodwill, you're forcing them to undertake a valuation. You're forcing them to calculate a CGT gain under the old rules. You're forcing them to undertake a calculation under the indexation rules. Bit of both. As Susan has also said, you've got 4 classes of gains, you've got 4 classes of losses. You have made the system incomprehensible for an individual. They're going to be forced to comply, costs in relation to valuation, ongoing record keeping, and that's something that I want to make sure we shout from the roof, that there are significant compliance costs. There is one submission that has put a number against ongoing and one-off. And I draw you to that submission. We haven't had the chance to even consider or quantify, but we can certainly say, hand on heart, that, and Treasury have not provided the mechanism for calculating that $88 million.
Yeah.
Chartered Accountants has actually had a meeting with our members that are in the valuation community, because I was quite concerned about the need and the prospect of our members being swamped by this. Their message back to me was that valuations can be done retrospectively. It's just making sure people have the right paperwork. It's a question of what that paperwork is, and at the moment we've been reached out to the ATO, and we're also working with our valuations committee to try and educate our members about what paperwork is needed for those valuations and how easily they can be done in a retrospective point of view.
That was going to be my next question in terms of the paperwork and the bookwork that businesses are now going to have to undertake. Are we in a position where we have clarity of what that needs to look like, or is that still effectively a guessing game as well?
We're waiting for that apportionment methodology, and so that's a missing piece. But even when that surfaces, clients will want to understand what will it look like compared to evaluation versus that apportionment.
Yep.
They'll still be required to get evaluation because they'll want to compare A with B.
So just on the apportionment formula, have either of your bodies had engagement from the ATO on what the tool is going to look like?
It's the Minister, through his legislative determination, that will determine the content, and that should be in the primary legislation, but
no conversations have happened to figure that out yet.
Correct.
Not with the ATO. There was a meeting with the Assistant Treasurer on the Wednesday after the budget with the accounting bodies. Tony was there as well. The question was asked how that would work, and my understanding was that it was just market value less the cost apportioned over time, but we don't know for certain because we haven't seen the legislative instrument.
And you don't know, you can't speak to your members for them. Sorry, let's peel that back. Accountants are not in a position where they can, goodness me, there's a party going on outside, where they can talk to their clients about what evidence they are going to have to provide the ATO or their accountants to then provide on their behalf to the ATO to prove how all of this is going to work.
The ATO does have some guidance on how it has to determine market value on its website, because
But
market
that's general
value
to
is
the current circumstances, right? Not relevant to this legislation.
market value to a certain degree. So, there isn't anything particular about this apart from the fact that everyone is expected to have some sort of valuation on the same day.
It is relevant for SMSFs, so there is guidance. I'll just put that.
Sure.
there.
Oh, yes, thank you. Apart from the CGT changes, we've also, we discussed this yesterday, talked about this anomaly with fringe benefits tax and the standardised deduction. Can someone walk me through how more tax might end up being paid as a result of seemingly a tax cut?
Yeah,
Thank you, Mr.
it was highlighted yesterday. The standard deduction. There is a rule in FBT land where it's called the otherwise deductible rule. So it avoids the problem of someone double dipping, getting the benefit of the $1,000 deduction and also salary packaging. But if someone does more than the $1,000, there will be an FBT liability on the employer. Now the employer will seek recompense for that and seek that from the employee. So it just doesn't work. Now, we did get an exposure draft. We did highlight this to Treasury, and there were no adjustments whatsoever. Even though the bodies had 11 days to respond, all the bodies alerted Treasury to this anomaly, yet nothing absolutely changed in the legislation. And that's, so consultation mattered for nothing.
Yeah, thank you, Chair.
Thank you very much to all of you for coming today. We appreciate your time. We'll conclude with this session and just suspend for a short minute while we invite our next witnesses to join us. Thank you. I now welcome Professor Miranda Stewart and Dr. Sonali Walpola. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full names and the capacity in which you appear today?
Yes, thank you. Miranda Stewart. I'm a professor at the University of Melbourne Law School and a visiting professor at New York University School of Law in the US.
Thank you. Sonali Walpola. I'm a tax academic at the ANU, but I appear in my personal capacity.
Thank you very much. I now invite each of you to make a short opening statement, and at the conclusion of any remarks, I'll invite members of the committee to ask questions.
Okay, thank you. And yes, I should just confirm for clarity, I also appear in my personal capacity with that expertise. So thanks very much to the committee for the opportunity. We know you're dealing with a lot of material in a short period of time. I've been out of the country for nearly a year. I knew if I left the country something would happen in tax reform, and clearly it has. It's exciting to see. The submission that I have put in and a couple of other public materials that I have published, an op-ed and a bit of public commentary, is generally in support of the reform. So I first of all would like to make that clear. Tax reform in general is always balancing competing considerations, different stakeholder perspectives, the economic impact, the equity and fairness impact, the revenue impact. In particular, I think capital gains tax reform, it pretty much nobody will be 100% happy. In my experience, the CGT is really a kind of compromise tax to ensure fairness and revenue while not disincentivising economic activity. In my view, the reforms as an overall package, and that overall package is quite important, do achieve that policy goal. They do improve fairness and equity in the system, which has been a long-standing concern and I think is not a surprise to taxpayers, to advisors, to members of government, has been long debated that the CGT 50% discount is overly generous relative to the appropriate taxation of capital gain, and we have also seen increasing inequality and unevenness in the holding of assets and the benefit of gain in the Australian population. So it was important to do a reform that achieved that, and actually I would commend the government for doing so. The negative gearing measures also have been long understood. The solution to that is always tricky. The government has reached a compromise solution which I think achieves the policy goals as a whole. I'd also like to say, and I can elaborate on this in response to questions or in a little bit more detail, I support the minimum tax at 30% of capital gain. I do not think it is unfair, and I'm happy to explain a little bit more about why that 30% minimum actually achieves the policy goals of the legislation and does not overtax any potential hypothetical individual members or investors in Australia. I support the indexation approach. I do make one comment at the end of my submission about the treatment of foreign residents, so we can come back to that if you wish. The other thing I want to highlight in my opening remarks is that these CGT, negative gearing, indexation measures are combined with two measures to do with the taxation of labour income, the working Australian tax offset, and the standard deduction for work-related expenses, and also for small businesses, we know the permanent business expensing, small business investment expensing. Those actually reduce tax on workers. In fact, they reduce tax even on high-wage workers. So what we see in the reform is a rebalancing of the tax burden, not drastically, but a little bit, towards the taxation of capital gain and the holders of assets who have benefited from the last 2 or 3 decades of appreciation in capital assets, and workers who deserve that tax cut. So I'll stop there with the opening remarks, but I can elaborate on any aspect. Thank you.
Thank you. Dr. Walpola.
Thank you. I agree with Professor Stewart's comments. Yes, sure. Oh, thank you. Yeah. So I support all the tax measures in these bills. The focus of my joint submission with Dr. John Minnis is on strongly endorsing the CGT reform. We submit that the merits of the CGT reform should be determined by the national interest, that is, the social and economic well-being of the Australian community. Our fundamental premise is aligned with Nobel laureate Professor Joseph Stiglitz, who has stated that we should use our tax system to create a better society. In Australia today, the main way in which the tax system can create a better society is by reducing income and wealth inequality, which is a significant and growing problem. The CGT discount is a massive tax expenditure, nearly $22 billion in 25-26. For more than 25 years, it has contributed to inequality in Australia. We know that most of the CGT discount benefit goes to high-income earners. Even more concerningly, the CGT discount exacerbates wealth inequality. The inequality of wealth in Australia, like most or all developed countries, or probably all countries, is higher than the inequality of income. ABS data shows that Australians in the top 20% in the wealth scale have 90 times the wealth of those in the lowest quintile. The need to address wealth inequality provides a compelling reason why the CGT reform should extend to all assets, including shares. And I can provide further detail on that. As detailed in our submission at page 5, there are strong reasons to doubt the claim that the CGT reform could have a negative effect on innovation and can provide further detail in response to questions. We also note that the federal budget provides for a large suite of measures to support innovation and business. In light of growing inequality, our position is that the national welfare does not justify carve-outs from the CGT reform for particular sectors of the economy. Thank you.
Thank you very much. We'll go to Senator Little first.
Thank you. Dr. Walpole, I think I'll ask you first.
Sure.
Some of these questions. I want to go to comparable countries. Do you have a view? You know, often we compare ourselves to Singapore. You know, Singapore is a country that has real wage growth, high productivity, and they have no CGT. I'm interested to understand, in your view, given that when we look at most comparable countries and their rate of inflation, we are doing worse as a country than most of the comparable countries that we refer to when we talk economy. Do you have a view on how these tax reform changes will have an impact on those, given here's a comparable country that is doing quite well without the CGT?
I think every country should have a CGT, and okay, if Singapore doesn't have one, well, I disagree with that position.
But the question is really, why?
No, but it's much broader, that in evaluating whether we should have a capital gains tax and at what rate, we have to look at it from a big picture perspective, and it is the social interest that is the number one consideration. The point is that capital income is income, and this principle was endorsed by the landmark, our only landmark tax review, the Asprey Review, which endorsed the Haig-Simons comprehensive definition of income, according to which all accretions to net worth are income, and our Asprey Review endorsed a comprehensive income tax base in the widest terms.
You've mentioned that you've been advocating for CGT and tax reform for some time. I'm interested to understand, given the amount of evidence we've heard about the lack of consultation about these changes. We've just heard it prior to you giving evidence today. Can you give me some insight into whether you have a view that there has been an appropriate level of consultation?
Yeah. Well, just one clarification. I absolutely endorse the CGT reform, but I would say my co-author, colleague, John Minnis, is the one that for a very long time has been arguing for the abolition of the discount, and many colleagues in our academy. And in terms of for how long they've been doing this, actually they started in the late 90s, that when the discount was proposed, leaders in our discipline gave testimony predicting the dire situation we have now with, for example, the housing affordability crisis.
So this is significant reform. Is there anything you don't like about this legislation?
I fully support the tax measures. It may not be perfect. We would, that is John Minnis and I, would have supported a more ambitious reform, but this is a huge step in the right direction, and I'm more concerned about these bills not becoming law. So I fully endorse and congratulate the government.
Thank you. Professor Stewart, I want to ask you, you mentioned when you, in your introduction, that you were here in an individual capacity.
That's
as
correct.
well as, right. Can I ask about your joining Treasury as a hand-picked appointment as a visiting Treasury fellow. Is that correct?
I was engaged at the Treasury for overall about 8 months in the period between November 2024 and September 2025. I was a academic visiting fellow as part of reinvigorating Treasury's academic visitor program, which is a program that they have done from time to time, not just in tax, but across Treasury. So during the time I was at Treasury, I was on unpaid leave from Melbourne University, and I was paid a salary, for that period of time from the Treasury.
Was that a competitive round? Was that a competitive process to be a fellow in Treasury?
I was invited to join the
okay.
Treasury.
Given that invited status, obviously you're held in high regard by the Treasurer. Did the Treasurer or his office consult you at all before this tax reform became public?
I'm sorry, I didn't understand
Did
the
the
question.
Treasurer or his office consult you at all in relation to any of these tax reform changes?
No.
Have they consulted you after it's been made public, the tax reforms?
No.
Are you engaged with anyone from that office?
No, I'm not engaged.
Okay. You said you've been advocating for many years. Is there, and we've heard, as I said before, a lot of criticism this morning about the lack of consultation and the lack of time between the announcement of these tax reforms posed in the budget and where we are today. Is there anything you don't like about the tax reforms? Is there anything that concerns you about the tax reforms?
The answer is no, and let me tell you a couple of reasons why. The first is that the start date is 1 July 2027, the main start date for that capital gains tax change. I would have been concerned if the start date had been 1 July 2026 for those changes, because those changes do require significant preparation and transition work and valuation, as we've heard in the previous submissions. There is no doubt that the transition will generate significant compliance cost, right? It is demanding. But I think that any alternative would be worse. And as I commend the government for the reform, and I think the reform is appropriate, I think that the transition rules are appropriate. So what they do, an alternative of grandfathering everybody who had an asset before 1 July 27 would completely undermine the reform and its policy goals and its revenue and fairness results. An alternative of taxing everybody under the new regime, no matter when they bought the asset, no matter how long they'd held it, I think would not be taken kindly by taxpayers or advisors, and fair enough too. So the transition, if you say things I don't like about it, it's not quite right to say that, but I fully acknowledge and agree with some of the comments of the professional advisors that it will generate significant transition compliance cost. I hope that we see the ATO pragmatically managing, providing very significant guidance. And one comment I would make on the legislative instrument aspects, and happy also to comment more generally if there are questions on that, is that in my view the legislative instruments in general are an appropriate way to manage most of the rulemaking associated in particular with the transition, with listing exemptions, with listing the kinds of payments that might lead to exclusion from the minimum tax. Regulations are used for this purpose in the GST quite commonly, less so in income tax. But I would have thought the profession would prefer legislative instruments to, for example, just ATO guidance on the website. The legislative instrument can be reviewed by this committee and the Senate. More generally, judicial review, and is fully binding on the government. It's important that the government really do all of this properly, and I really sympathise with taxpayers in terms of managing that transition. Nonetheless, I support the overall change.
At a per cap, 9 minutes, thank you. At a per capita event in 2025, you were asked, given the removal of inheritance tax, how would it ever be feasible to reintroduce one? Are there backdoors that would be more politically palatable? And I understand your response was the challenge with land tax on primary residence is that people don't always have cash. and that inheritance taxes are complex, but one can have a pretty high threshold. Do you support land taxes on primary residences and inheritance taxes?
Yes, with appropriate design and thresholds. Of course, that's not what this reform is doing.
When you were advocating for changes to capital gains taxation and the trusts at Treasury or elsewhere, did you do any analysis on the impact on economic growth or productivity? And are you aware of any analysis on, as you know, uncertainty is a big issue for businesses, and we've seen record insolvencies right now, extraordinary record insolvencies. Cost of living is going up for everyone, including businesses. Could this not have come at a worse time for businesses in Australia to be dealing with another issue when they're trying to work out how to keep their businesses going?
Look, on one view, there's no good time for law reform. It's not clear to me that this reform will have significant negative impacts on business. The removal of much negative gearing or the quarantining of rental losses, in my view, will actually redirect investment potentially towards equities and away from sort of speculation in real property. Small businesses, sole proprietors will actually get the benefit of the lower tax rate, right? The Working Australia's tax offset, the permanent business expensing. So it's not clear to me what in this reform is particularly of concern in terms of small businesses. Okay. Was there something particular that...
No, I'm asking you because that's certainly not what we've been hearing from other
Yes,
witnesses.
I understand that, and it's not entirely clear to me what the concerns are of other submissions that have been made to this committee. It is very easy to say in a submission, this creates uncertainty, business will be unhappy. Right? It is much more difficult, actually, to explain what it is about these changes that undermine business activity. In fact, most small and medium businesses in Australia either are going to benefit from lower personal income tax rates or are benefiting from a 25% corporate tax rate, which will be lower than the rates on capital gain. Undoubtedly, transition creates complexity. I don't think it creates uncertainty, but it does create complexity over the next couple of years, for sure.
Thank you. I'm going to have to rotate the call. Senator McKim.
All right, thank you, and morning to you both. Thanks very much for coming in. Dr Walpole, firstly for you, you referred in your opening remarks to the part of your submission that asserts that claims that the reforms will impact on innovative activities are without foundation. I just wonder if you could talk us through that a little bit more at length, please.
Yeah, sure. Thank you, Senator McKim. I'll just start with a useful statement that I think further to Professor Stewart's comments. I didn't refer to this report in our submission because I really discovered it after that. The OECD Taxing Capital Gains 2025 report, and the first author gave evidence at the CGT discount inquiry. So it is really a very comprehensive treatment of the existing literature. And the useful statement is capital gains tax relief appears to have little impact on overall economic growth. And that's analysing OECD countries. Also from that report, the literature exploring the question, this is about carve-outs for small business startups, finds little support for the claim that tax policy materially affects the rate of entrepreneurial entry or the growth rate of new firms, since unless capital gains tax rates are very high, they do not feature as a first-order consideration for entrepreneurs. And the Tesla chairwoman quoted in the AFR in recent weeks made the same comment, stating that she'd never met a startup who thinks about the tax on a future payout at the time when they're establishing their business. So the main points, I guess, is that firstly, it's not unfair for small business owner, startup owners, and say business becomes successful and they're selling, to pay the same tax that wages, or as per wage earners. Then second point, in any event, we have a large suite of incentives for business, for startups, and the primary way in which the Australian tax system, like many tax systems in the world, incentivise innovation is through R&D tax incentives. And the literature on innovation tax incentives has shown that incentives at the point of expenditure are far more effective at stimulating innovation compared to incentives, if you can call it that, at the end of the process. And there's a paper cited in our submission. The 26-27 budget provided for an expansion of the R&D tax incentive. Well, then there's the instant asset write-off, loss refundability, and special measures for startups. And finally, ultimately, it's the national interest that should even determine whether there should be any carve-outs for any group. And rising inequality in Australia must trump any sort of concessions for any business or, yeah, that's it.
Thank you. Professor Stewart, did you have anything you wished to offer there?
So I'm not an economist. I would never say that I have that level of expertise, but I do have 30 years of experience in tax law and policy and observation of its effects. There's no doubt that a tax reform change like this changes investor behaviour, right? Whether it actually generates lower or less efficient or less valuable investment for the nation is really a very difficult question to answer, and in my view is very unlikely. If there is
unlikely that it would manifest as lower.
It would be very unlikely to, sorry, just for clarity, very unlikely to undermine economic growth or prosperity overall, and in fact it may enhance it. And the main reasons there would be the rendering rental investment less attractive relative to equities, ensuring that only real economic gain is taxable. Just to comment on startups and successful founders, this is a very, very small percentage of the population of equity investors. Successful founders will do very well even after tax. Don't forget that capital gains benefit from deferral in taxation. If you're a wage earner or a business owner with earning profit, you pay tax as that is earned. Capital gains accrue over time, but tax is only paid when they're finally realised or sold 5, 10, 15, 20 years later. That deferral is a very significant economic benefit. Taxpayers can plan for a tax impost in the future. Don't forget that successful founders with a low cost base have invested very little upfront after-tax capital. That's why their cost base is low. Human capital is untaxed, right? It's actually exempted. So sweat equity is not taxable. So if there is a very large capital gain, all power to you. It's appropriate that the Australian government and the rest of us taxpayers accrue a share of that.
Thank you. Interested in both of your thoughts on this. There's been a fair orthodoxy that capital income should be taxed lighter than income from labour. Do you think that orthodoxy is starting to fracture a little bit? And what are your views on that economic orthodoxy that capital gains should be taxed more lightly than income from labour?
So very briefly, I just might point out that even under the reformed regime, capital gains are taxed more lightly than labour income, and that is because of deferral, right? Because we have what we call a realisation-based system, which addresses the cash flow concern that was raised in respect of land taxes and inheritance taxes that may apply where there isn't cash flow. We only tax capital gain when there is cash flow, but that could be many years after that gain has actually accrued. So they already are taxed more lightly. The policy is, the reason for that sort of debate, that common argument, is capital mobility in general, right? That we are competing for capital internationally, and that has been raised. We have a residence-based tax system in Australia for capital gain to, if you like, be mobile, go elsewhere. The taxpayer themselves has to leave. Okay, so our individual founder who wants low tax on capital gain, who wants to be taxed differently from workers, they have to go and live in Dubai, live in the US, live in order to achieve that. So we're talking not about mobility of capital here, we're talking about mobility of people. It's a very different question, and I don't know about you, committee, Your Honours, but honourable members, but I am currently living in the US. I'm not there for tax reasons. I'm there for the opportunity. That could happen anyway. I would not choose at the moment to live in Dubai for my own personal risk profile, but others may, and it may be that tax plays a role. If Australian innovative businesses want to establish in New Zealand because capital gains tax is zero there, all power to them. Why aren't they there already? So, you know, this mobility question, the economic evidence now, more generally empirical evidence, is that, of course, some people move in response to tax rates. The majority do not.
Yeah, sure, Doctor.
So my position is there's no case for taxing capital gains lighter than other income. Probably there's a case for taxing it at a high rate, but we won't go there because it's hard enough to try and get it taxed at the same rate as labour. And perhaps, well, this is what some economists claim, that there is a strand of economics that claims that capital gains should be taxed at a lower rate to other income. I think that OECD 2025 report really goes a long way to debunking that. And if we're looking at what the economists are saying, Professor Joseph Stiglitz, the Nobel laureate, also recipient of the Sydney Peace Prize, has stated that we should be taxing capital and speculation as high a rate as work. And in 2024, before a United States Senate committee, Professor Stiglitz stated, the fair taxation of capital gains would eliminate their tax advantages over other forms of income by at least equalising tax rates. And ultimately, fairness demands that capital gains be taxed at the same rate as other income.
Thank you. Do I have one more? Just one more quick one. I know we are short on time.
Yeah,
I just wonder whether each of you has a view on if these changes do pass through the Parliament in terms of their impact on investment decisions, where you expect people would be drawn to put their money for advantageous tax treatment. Do you think superannuation and in particular self-managed super funds will become more attractive, given that these reforms don't touch those?
So look, I was on the radio this morning and I was asked about a 20-year-old who, might invest in shares. In my view, of course, the vast majority of 20-year-olds, if they are earning income, they're earning labour income. they will benefit from the tax cuts in the proposal, the Working Australians tax offset and the standard deduction. They should be contributing to superannuation. I hope their employers are, and they are as well. And superannuation will retain good tax treatment low tax treatment for this kind of investment, and also for exposure to equities in a managed and hopefully prudentially sound way for those young investors. So they should be doing that. They can also utilise superannuation to save for a home deposit under recent mechanisms of the government. So yes, it does make that more attractive. That's not, in my view, a bad thing.
Dr. Walpole.
Yeah, so I think on the superannuation point, and I'm not an expert, but I did hear Associate Professor Catherine James' testimony yesterday, and I would adopt her comment that, okay, that maybe we do have to look at super, that it could become a tax minimisation vehicle and become something other than what it was originally conceived as, which is saving for retirement. And in terms of, well, a point also made yesterday, the preferential CGT treatment is there for new dwellings. So what we could see is more investment there, and that would be a good thing.
Thank you.
Thank you. We have Senator David Pocock on teleconference, so we'll go to you now, Senator Pocock.
Thank you, Chair. I appreciate that, and apologies I'm not there in person. Just wanted to start just listening along. I've heard that these should pass with urgency, but at the same time they only come into effect July 1 next year, and just wondering why it's so urgent if they do come into effect mid next year and the Senate potentially has a bit more time to work through some of the detail in the non-housing parts of this bill.
Thank you, Senator. Professor Miranda Stewart speaking here. Look, in my view, it's actually quite good practice to have introduced a bill with many detailed provisions in it with a start date that is a year out. It does, as a matter of transition, give taxpayers time to prepare. The passage of the legislation will produce certainty. We have, unfortunately, in the tax area, and it is the case for some other tax proposals that we're not considering today, not seen legislation sometimes until after a stated start date or with difficult transition, and that does generate uncertainty. So, Senator, I understand that there have been comments about some of the technical aspects of the bill and some concerns about the use of legislative instruments. The advantage of this process and the Senate's role, of course, in the legislation is that you can identify potentially if there are technical matters that the committee considers are important or concerns you have, that can go back to government and some changes potentially could be made. Also still in plenty of time before the start date. So in my view, actually, it's probably a better practice than not to have this legislation done soon. And to enable all taxpayers and advisors and the ATO time to prepare for the 1 July 27 transition.
But Professor Stewart, on that point, doesn't most of the detail come through delegated legislation? So is that not one of the problems with this bill, is the Senate is being asked to vote on sort of this skeleton bill, and then most of it comes through delegated legislation, which we won't be able to look at through the Senate inquiry process.
Sorry, Senator, for interrupting you. I'm not seeing you there. Look, in my view, that's not a correct characterisation of the bill. The bill seems to me to be comprehensive. The elements and sufficiently detailed. The legislative instrument elements are almost all about identifying particular list of types of assets, detailed types of characteristics of one element. That new residential housing definition obviously is important. The kinds of income support payments that will provide for eligibility not to be subject to the minimum tax, and so on. So I just would take a different view that I think that the bill actually is pretty comprehensive and the legislative instruments will support that rather than the reverse.
Okay, thank you. One of the concerns raised yesterday was tweaks to enable capital gains to be averaged over multiple income years. This obviously help people like farmers whose income is quite variable. Do you have a view on that proposal?
Yes, so when we originally had CGT introduced in 1985, we had, of course, taxation of real gain with indexation at marginal rates. I might just point out marginal rates were higher in those days. And we then had averaging, as you say. So there was the ability to average. The averaging did lead to significant tax planning, and there was a use of averaging that led to low taxation on certain kinds of capital gain. That actually was one of the arguments for removing it when the discount was introduced. The minimum tax addresses most of those. Whether or not there should be averaging then becomes a matter of should taxpayers who would otherwise face a higher marginal tax rate get to spread that over more years, essentially meaning they pay, in effect, a lower tax rate on that gain. And just, in my view, it's not a particularly serious issue these days. That 30% rate, marginal rate, applies from 45,000 up to 135. Then we have a 37% rate. It's only over 190,000 that we have that top marginal rate. There are very few ordinary Australians earning a taxable capital gain, net of all costs, net of losses or other offsets that would exceed 190,000 Australian dollars. So in my view, the averaging is not as much of a concern as it has been suggested. It's a policy option that was not chosen by the government. So.
Mm-hmm. Okay, thank you. I've got a couple of questions for Dr. Walpola. It looks like you're supportive of changes that use CGT and negative gearing to incentivise new supply, but you maintain that the national interest doesn't justify preferential taxation of capital gains for selected industries. I'm interested how you reconcile these two things and why we shouldn't be incentivising things like startups given the value they add.
Yes, just to clarify, I didn't actually say, and neither did we in our submission, that we didn't make any statement about supporting the fact that the preferential treatment is maintained for new dwellings. My comment was in response to Senator McKim's question about what would be the effect on investor behaviour, and I expect that there would be new builds are more attractive going forward, and so that it was more a predictive statement, but yeah.
Okay. And so do you think if the government incentivised startups, we would see the same sort of thing where we'd see more capital flowing to startups in Australia?
Yeah. So with respect to startups and innovation, so earlier in this session, sort of in response to Senator McKim's question, I outlined my position on that, and in particular, I would refer the committee, and maybe the committee is already aware of that 2025 OECD report that really does not provide any supportive evidence for giving preference to capital gains, preference to startups or new businesses.
You're at 8 minutes,
Senator. And is that a sort of purely sort of rational economic argument that you don't want to have any discrepancy in tax settings, or do you think we should be using the tax system to incentivise things we want and discourage things we don't want?
In terms of the evidence from the economics literature, I'm not an economist. There doesn't appear to be any support for preferential capital gains tax treatment for entrepreneurs, small business. At best, it's mixed evidence. Then, in terms of the big picture, I would argue that the national interest does not justify those carve-outs, those proposed carve-outs.
Okay. I understand you're also supportive of the WATO, the $5 a week back for taxpayers, but I'm interested to understand why more targeted support wouldn't be a better policy. Surely senators don't need that $5 a week back when we could potentially be giving more to Australians who need it the most.
Yeah. Thank you, Senator. I'm going to let Professor Stewart address this one.
Senator Pocock, just in terms of targeted support for startups or new investment, new firms, there's plenty of evidence that actually finding ways to provide capital to those businesses would be helpful. There is evidence that research and development tax incentives, well designed, can encourage new R&D. And there is evidence that, if you like, the risk sharing that we provide when we permit business losses or capital losses to be deducted, which is the rest of us Australians kicking in support of investors who are taking risk, that sort of loss support and loss refundability perhaps for startups, loss carrybacks, that these things can make a difference. I think the point Dr. Walpole is making is that whether capital gains tax discounts at the other end make a difference, the evidence is really quite mixed. But I'll let her briefly. Yeah. So we're in agreement on that, as I understand it, Dr. Walpole.
Oh, yeah, and the WATO.
Sorry, what was the
WATO comments on that?
I beg your pardon, I'm sorry, I missed that question about the...
So I was asking about the WATO. There seems to be broad support for it, but I'm interested to understand why more targeted support wouldn't be a better policy. It seems to me $5 a week back for senators and members earning very good money is money that could potentially go to people who aren't earning as much, who need it far more.
Yeah, sorry, I missed that last one. Look, in my view, actually, tax on labour income could benefit from a tax cut across the board. Not all my colleagues agree with me there, but I actually think our top marginal tax rate kicks in a little low when we compare that with other countries. In my view, one of the key rebalancing things that this reform does is shift the taxation a little bit away from labour income, a little bit towards capital gain. That's appropriate, and that is appropriate across the board. Essentially, the WATO delivers an increase in the tax-free threshold for workers across the board. That's appropriate in my view. In contrast, indexing tax brackets thoroughly would actually also deliver that tax cut to capital income and gain, and that is something I don't support.
I'm going to have to rotate the call now. We are running over time.
Thanks, Jim.
Thank you. Senator Smith has a quick follow-up. Yep.
Oh, no, it's a substantive follow-up, I would call it.
Given, if we could keep it as tight as possible.
Given Professor Stewart's unique position, having worked in the Treasury. Professor Stewart, just to be welcome, thank you for participation. Just to be clear, that when you were on the academic visiting fellow program in the Treasury, you were working in the revenue group under Ms. Diane Brown. Did I understand? Have I understood that correctly?
Yes, I was employed.
And were you regarded as a special advisor in addition to a visiting academic fellow or an academic visiting fellow?
So, as I think, and I think I'm correct in my memory, so apologies, Senator Smith, I'm not right. I think my title inside the Treasury for a kind of employment level title was principal advisor, something like
I
that.
recall seeing an organisational chart.
Yeah, in an
where-
organisation, I was sort of described as an academic visiting fellow in a more general sense.
In your opening remarks, you said the reforms were exciting to see and you were generally in support of them. Am I right to hazard a guess there's some professional pride that your time at the Treasury has resulted to a degree in the development or the formulation of this reform package?
So I was not involved in any way in this reform package, Senator.
Are you still associated with the Taxation Committee of the Law Council of Australia?
I am a member of that committee. I have been overseas for the last year, so I'm not directly participating.
One line of inquiry that I'd be interested in getting your understanding of, and I'll quote from the Law Council of Australia's submission to this inquiry. It says, when talking about the minimum rate of tax on capital gains impact on philanthropy, it says, and I'm quoting now, the consequence of this change to philanthropy is likely to be significant. In your biographical details, you also reference the point that you provide policy advice in regards, or have provided policy advice on a variety of topics, including not-for-profits. And I'm just wondering what observations you have to the claims made by Philanthropy Australia that the changes to these arrangements are a donations tax. The Communities Council of Australia has come out and criticised these reforms for their very negative impact on philanthropic and charitable giving. The Australian Council for International Development and others have all drawn attention to the significant impacts to charitable giving in Australia as a result of the government's reforms. I'm just wondering what observations would you make about that commentary?
So I have read the Law Council submission. I wasn't involved in that submission.
But you had previously been on the Taxation Committee of the Law
yes,
Council.
no, that's correct. I know many members of that committee and think well of them. As I understand it, what they have pointed out, and this does appear to be on my reading of the legislation also, this is the result. They're talking about the effect of the minimum 30% rate. The hypothetical that is given in the Law Council submission, I would submit respectfully to this committee, is very unlikely. I suppose it's possible. They seem to be assuming a taxpayer realising a $100 million capital gain, wanting to keep 50 million of it and give 50 million away, and arguing that under the current CGT discount, the discount would include only 50 million of that to tax. Let's assume currently we're ignoring indexation, I might point out in this example, and then a deduction would be obtained for the 50 million donation to the charity, to the DGR organisation. The consequence is that the taxpayer realises 100 million capital gain, donates 50 million to charity and pays no tax at all. So the minimum CGT tax does prevent that result. Because it would apply a minimum, let's assume 100, sort of 30 million of tax. There could still be a deduction for the donation, but there would be still that minimum CG tax. Yes.
Any more information that you can provide on notice would be helpful in regards to the Law Council of Australia case, and any other observations you might like to make in regards to the commentary made by Philanthropy Australia, the Communities Council of Australia, Future Generations, the Australian Council of International Development, and others would be most valuable as well.
I could take that on. I could do a follow-up written submission if that would interest the committee.
That's my request of you. In your Tax and Government in the 21st Century, you make the observation that most countries apply a lower tax rate to capital gains than to earned income, or in some cases to other forms of capital income. But Dr. Wapola, in her observations about the OECD a moment ago, remarked that the OECD had noted that high capital gains taxes disincentivise investment relative to other countries. I understood that correctly, did I, Dr. Wapola?
Yeah, that's based on the analysis of the authors of the report. Yeah. It is true that the OECD countries do preferentially tax capital income.
So my question then, then in that, isn't there a concession then that this actually puts Australia in a position where its taxation of capital gains is higher than comparable countries, higher than comparable countries, and therefore would have an adverse or a disincentive on innovation. Have I understood the flow of that?
Yes, I understood. Thank you, Senator. So, as you say, thank you very much for quoting the book. It is the case across the board, or in many countries, that often a lower flat rate is applied to a capital gain. So first thing to note is that they do not apply indexation to cost base in those countries. So it's a substitute, right? And the second is whether that's actually fair and appropriate from a revenue perspective. I think the OECD recent report that Dr. Walpola has referenced demonstrates there has been a shift in policy thinking given the high levels of sort of asset growth and inequality in populations. The second thing is the comment I made earlier, Senator, that we're not so much talking here about competitive mobility, capital mobility, which is something that the corporate tax rate is relevant to, right, for business investment. What we're talking about for CGT is actually people moving from one country to another. People are mobile, of course, but much less so. And so I'm less concerned about the effects on mobility and changing investment of this proposal.
So you wouldn't concede that this puts Australia at that this would disincentivise innovation, Dr. Walpola?
Yeah. No. And no. I just wanted to...
Yes or no?
No.
No.
And just one further point. Our capital gains tax system, even the proposed one, has generous aspects. And further to Professor Stewart's comments, fully agree that deferral and taxation on a realised basis is an advantage. And in terms of comparing us with other countries, and this is in the OECD report, we allow indefinite offsets for capital losses. By comparison, many other countries don't, including France, Spain, Japan and Sweden.
Final two questions. Ms. Stewart, given your visiting fellow period at the Treasury, I think for 8 months, can you point to any policy outcomes, policy initiatives from the government directly related to your advice and participation at the Treasury?
So when I was visiting professor at the Treasury, I was not engaged on any particular reform proposal. However, Senator, you may or may not recall, there was an inquiry in January 25, and I think it might have been Ms. Diane Brown or someone who appeared before Senate Estimates, did say that I had been part of the team involved in the tax rate cuts, the change of the tax rate cuts, and also in respect of research on the Vanderstock matter, which was to do with the electric vehicles and the electric vehicle charge in Victoria. But I was not involved in any particular reform proposal for this reform.
Finally, I've heard it said that the art of taxation consists in so plucking the goose as to obtain the largest possible amount of feathers with the smallest possible amount of hissing. Has the government got the balance between feathers and hissing right?
Look, I would direct you, Senator, to the issue of transition.
I'm just conscious that I think you talked about ambitious reform in your opening remarks. I'm just wondering, should they have gone for more feathers?
I think Dr. Walpola said that she would have supported more ambitious reform. I may or may not have said that. I was pleased to see the change. Look, I don't think there should be more feathers, to be honest. I would like to see the next tranche of changes. I would support a review of the small business CGT concessions. In my view, they are worthy of attention and more attention to the taxation of labour income, tax rates on labour income, and the taxation of corporations and the corporate tax rate.
That might depend on whether there's a goose left.
That might.
Thank you very much. Thank you very much, Chair. I appreciate that.
Thank you, Senator Smith. We have one final follow-up, and we are running late now. So, Senator O'Neill, if you could be very swift,
Just one
I would
question.
be much appreciative.
Thank you. Just going back to the WATO and your comments to Senator Pocock, that was one of the items that you thought was a significant improvement, and you noted, in contrast to a lot of the commentary, which is sort of setting one Australian against another, capital against Labor, high wage earners against lower wage earners. You, in your opening statement, I believe, talked about the reduction of a tax on all workers, low and high wage earners. Why, in your view, Professor Stewart, is that a good outcome in contrast to the way it might be characterised by some?
So, thank you, Senator. I referred to this issue of rebalancing and compromise in this overall package of reform. The rebalancing away from labour income towards taxing capital gain more highly is appropriate to me. So, you know, most Australians earn wage income, and those who earn high wages in general are being paid, you know, in respect of their skills, merit, and their contribution to our economy. I think it's appropriate that we should be sort of recognising that. Rather than indexing tax thresholds to inflation across the board, I rather like the solution that targets that tax cut to labour income. It adds a great deal of complexity to income test a tax cut like that. It tends to generate higher effective marginal tax rates up the distribution if you try to phase out a tax cut or deliver it only to low earners. That actually could, we haven't mentioned gender inequality, but that actually could end up generating higher tax rates on second earners, many of whom are women. So there is some advantage in a kind of the universality aspect of that. It's simpler, although it looks complex because it's an offset. It's actually simpler than some kind of income testing of other benefit for workers.
Thank you, Chair.
I'm going to leave it there. Thank you so very much for joining us, and we will take a.
I have just one more question.
Sure. Yep.
Professor Stewart, there was a report in the
question?
Financial Review on March the 7th, 2026, which suggested that you might have been involved in, this is the report's characterisation, a secret report examining tax treatments and distributions from trusts. Is that media report correct?
So I was out of the country at the time, so Senator, I'm not sure that I'm familiar with that, but I was asked to.
So I can help you with your memory, perhaps. The media report, just so we're clear, the media report states a confidential report for the department, i.e. the Treasury, prepared by tax academic Miranda Stewart, raised concerns trusts were being exploited to minimise tax. Is that an accurate media statement?
So I did a range of work with staff in the Treasury, with various team members, looking at various different aspects of the income tax law, including trusts.
While you were visiting academic?
Correct.
For the 8-month period to September 2025?
It was 8 months in the period November 24 to September 25.
Mm-hmm.
Correct.
What was the nature of the range of work that you did?
So I was invited to work on assessing the strengths and weaknesses of the income tax law over that period with the team.
So that statement that I read out to you from the media report is an accurate statement?
So I do not know what that report is being referred to, Senator. So.
It's a confidential report, apparently. So I don't know what the name of the report is either. Do you recall the name of the report?
No, Senator.
How many reports were you involved in, or did you lead the writing of?
I was involved in several different papers and reports, and I gave about 8 educational seminars and did a number of sort of educational tasks with different members of the revenue group.
On notice, could you provide us the details of that work?
Yes, Senator. on the assumption that I'm not breaching any the appropriate. For
and
the
we will
committee.
ask the Treasury to confirm their confirmation and support of this particular request when we see them later today.
Okay.
Thank you.
Thank you, Senator.
Thank you very much. Okay, now we will suspend for a very short moment while we swap over witnesses. Thank you. Representatives from the Financial Advice Association Australia and CPA Australia. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full names and the capacity in which you appear today? And we'll start on my left.
I'm Jenny Wong, Tax Lead at CPA Australia.
Eleanor Cassipedes, Chief of Policy Standards and External Affairs at CPA Australia.
Chris Freeland, CEO of CPA Australia.
Sarah Abood, CEO of the Financial Advice Association Australia.
Phil Anderson, General Manager, Policy Advocacy and Standards at the Financial Advice Association of Australia.
Andrea Forbes, Policy and Advocacy Consultant at the Financial Advice Association of Australia.
Thank you very much, everyone. I'd invite a representative from each organisation to make a short opening statement, and at the conclusion of any remarks, I will invite members of the committee to ask questions. And I note that we do have a copy of the CPA Australia opening statement that we can incorporate and table. I'd like to go first.
Thanks, Chair. Thanks for the opportunity to appear today. CPA Australia represents more than 176,000 members working across business, public practice, government and academia. Our members will be responsible for applying these laws in practice and advising those affected by them. We recognise the challenges Australia is seeking to address, including productivity, fiscal sustainability and intergenerational equity, and the important role a tax policy can play in responding to them. Our focus today is not whether this reform should occur, but on whether this measure, as currently designed, will operate effectively in practice. From our perspective, the issue is not simply one of implementation. It goes to the design and operation of the measure itself and whether it can be applied consistently and deliver outcomes as intended without creating disproportionate complexity or unintended consequences. There are material gaps and unresolved issues which, if left unaddressed, will affect how the measure operates, including the development of key legislative instruments that determine who is taxed, at what rate and on which assets, the interaction with existing parts of the tax system, for example, how the new rules apply to deceased estates, CGT rollovers and private company sales, and the compliance burden on taxpayers and their advisors, which is substantial. And you'll see in our submission we've estimated amount for compliance costs, which is materially higher than the Treasury estimate. Taken together, these issues create real uncertainty about how the law will operate in practice and whether it can be applied with consistency and confidence. We have set out a series of practical recommendations to assist in that regard and be pleased to take the committee through those in more detail. I want to stress that our approach is constructive. Our aim is to ensure the law, if enacted, is clear, workable and can be applied with confidence. Our focus is on working with the committee and government to ensure the law operates effectively. Thank you, Chair, and we welcome your questions on our submission.
Thank you very much.
Thank you again for inviting us to be part of this review. We're very appreciative of the opportunity. The Financial Advice Association of Australia, or FAAA for short, is the largest professional association for financial planners and advisors in Australia. Our members have a long-standing interest in all aspects of policy that ensure Australians are better off and financially resilient. We provide professional training and development for our over 10,000 members, as well as enforcing professional standards. Our members advise Australians across their broad financial affairs, and that includes superannuation, investments, debt, cash flow management, structures, aged care and insurance, and I'm sure I've forgotten something, but the holistic financial affairs. The evidence shows that Australians who receive professional financial advice are better off and more resilient than those who don't. We're bringing this broad perspective to the committee today. In the time available, we haven't been able to consider every aspect of the bills, but we have flagged in our submission 2 key areas that we, along with some potential solutions. First, we've addressed some potentially unintended consequences of the differential tax treatment of residential property, and in particular established residential property inside and outside super. We've also suggested some improvements to the design of the CGT and the negative gearing changes. What we know for certain is that more Australians will need access to professional financial advice to navigate these changes. We're concerned that unadvised Australians will be more vulnerable to scams, fraud and unlicensed finfluencers as they seek to navigate these very wide-ranging tax reforms. At the same time, we have a shortage of professional financial advisors. Our numbers have halved since 2019 to just over 15,100 today. Very happy to discuss these matters further with the committee.
Thank you very much. I will go to Senator Walker first.
Thank you. I just have one question for the Financial Advice Association. I know in your submission you talk about how you accept the overall intent and the need for these reforms to support younger Australians and address housing affordability. Can you provide your views on how these changes overall will make the system fairer for young people?
Well, as I understand it, the policy intent is to make it easier for young people in particular to afford, in particular, their first home. And it's certainly our hope that these changes will achieve that.
We're specifically focused on the fact that it reduces competition for the purchase of property, because investors will have less incentive to be purchasing existing residential property.
Okay, thanks.
Thank you. And more incentive to do what?
So the differential tax treatment we're talking about is a reference to the fact that because the tax situation hasn't changed in super, which we are supportive of, by the way, it's created an environment where it's now much more tax effective to hold an established residential property in your self-managed super fund than in your personal name. That is, we think, an unintended consequence of the changes, but we are concerned because there has been misconduct in that area, with consumers being pulled into these schemes by property spruikers in particular, people who aren't licensed, people who may not have the best interests of that consumer at heart. These schemes can be very high risk. So if you are investing your superannuation in a single property and you're highly geared, then it doesn't take much to go wrong for that strategy to fall over. We think the strategy should be available. We're not suggesting it's wrong in all circumstances, but we do think some attention needs to be paid to that change in incentives that this legislation creates.
Thank you. Thank you, Senator Chandler.
Thank you very much, Chair. Thanks everyone for coming along today. Mr. Bird, just to dig into some of those issues that you were fleshing out in your opening statement, you mentioned the reduced number of financial advisors that are currently in Australia now versus 7 years ago. Are your members going to be in a position to properly advise your clients before the start of these changes, given how few of them there now are?
Yes, so I think more time is a bit of a theme for us, both in terms of the consultation itself, but the time to help average consumers and taxpayers adjust to the changes. We would certainly like more time if that's available.
But is there also a concern that there aren't going to be enough financial advisors to provide the advice required to comply with these changes?
So yes, in short, so existing financial advisors will need to re-advise most of their existing clients, and that will give them less capacity to advise more consumers. You know, we're in a situation now where I think we have something like 700 Australians retiring a day.
Wow.
So the demand for advice is much higher than our capacity to supply it at the moment.
Yeah.
And yes, the demand from clients has already started to ask questions of what does this mean for me, what should I do differently, and the budget changes had broader implications outside of this building, including with respect to trust.
And look, I'm sure the phone runs hot most years around budget time, but I suspect for you guys it would have been running particularly hot on the 12th of May this year. Would that be correct?
Yes, that's absolutely the case. So members are dealing with consumers literally every day about the changes and the potential implications for them. Everything from remodelling their retirement planning to talking about their estate planning, whether that should be delayed and so on. Yes.
It might not be a question you're in a position to answer specifically, but in terms of the compliance cost to businesses from having to get further accounting advice, financial advice in relation to these changes, have you done any modelling to estimate what that increased compliance cost would be?
The short answer is no. It's something we'd like to have the time to do, but we haven't done that yet.
Because it's such a short time frame between getting the legislation and us having this inquiry and considering it.
I'm sorry, before you go on, I think CPA has done some modelling though. We haven't done that in our sector.
Wonderful. Yet. Can we come back to that CPA when I ask you guys some questions very shortly? Your submission back to the FAAA also says that too much of these reforms is subject to the discretion of the Minister, and you've recommended, I understand, that greater certainty is provided before this bill is passed in the Parliament, because obviously there's a regulatory piece that will occur after this bill is passed. The Treasurer has continually said that ministerial discretions are common in legislation, but are the types of discretions in this bill common?
Look, I think there are two key areas where we have concerns about ministerial discretion. I think there's something like eight areas in total, but the two that we think could be problematic are firstly the definition of a new build. Leaving that to ministerial discretion could be problematic because it could give people insufficient certainty about whether buying a particular type of property will enable them to access the more generous treatment or not, and also uncertainty in case that changes later. Yep. So, I believe our suggestion is that that probably should be in the primary legislation. The other area where we have concerns is on apportionment, and Phil, I know you've looked into that.
Yeah, so the element of apportionment of the capital gain pre and post 1 July 2027, I think that's a point that's going to be of particular interest to advisors helping their clients with understanding what their capital gains tax obligations are.
Just so I'm very clear on your position, in terms of legislation versus regulation, are you concerned that regardless of what happens with this legislation that we're inquiring into, there's too much uncertainty over the regulation element generally? Or is it your submission that you would prefer to see some of what will end up in regulation actually in the primary legislation so that we can be looking at it now?
Yes, in summary. So those two key elements we think should be in the primary legislation. Right. There are other aspects of ministerial discretion in the bill, but those are the two that we think would be most important.
Because you don't think it should be subject to ministerial discretion, you think there needs to be a clearer definition around
I think the uncertainty that it would create would get in the way of the policy intent of these bills.
That's useful. Yep. Thank you very much. I might just turn to the CPA so that we don't run out of time. Can we go to that compliance piece first of all? How much have you modelled that this is going to cost for businesses?
So the, albeit done in a short space of time, estimate is materially higher than the Treasury estimates, and I'll ask my colleague Jenny perhaps to go through the figures.
Thank you.
Yeah, so our estimate of the annual compliance costs is 295 to 542 million, and that's before the transitional valuation obligations, which we've estimated to be 675, 825 million as a one-off, costs falling in 2026 to 2028. And the reason, so from 2027 to 2028, every single CGT return for a pre-2027 asset involves a two regime calculation. You've got a deferred gain under the old rules with 50% discount, the current period gain under the new rules with indexation, and for property investors, you've also got the separate 5-step minimum 30% tax calculation on top of that. And for property investors with post-budget properties, negative gearing, you've got to track that negative gearing quarantining, and that grows over time as more properties entered into the rental market. So essentially our costs are based on the additional steps a tax practitioner needs to take in complying with these new rules. And essentially our modelling was based on publicly available data from the ATO taxation statistics, tax time lodgement data, market rate data, and where we've used professional judgment rather than direct data, we've actually said so. But what we're asking is for Treasury to publish and be transparent about the disaggregated estimates so that Parliament can compare methodologies.
So Treasury's estimate is about 88 million year on year. Those numbers that you've just given me would suggest it is significantly higher than that.
Yes, that's
that
correct.
Would be correct. Have you got a year on year figure?
Yes, $295 to $542 million per annum.
Wow. That is, we will have to dive into that with them this afternoon, I think, because that is a massive discrepancy. Just looking at the ministerial instruments, and I guess this is following on from the questions that I had to the FAAA. How can accountants advise clients when major parts of this regime are still unfinished or unknown?
Well, it does create compliance and administrative difficulties. Taxpayers and advisors and the ATO will be required to interpret and apply the regime where key concepts are not yet defined in Parliament. And some of it goes to the heart of the core policy design. What is new residential dwelling? Who's taxed, at what rate, as opposed to administrative detail. And in addition to that, there are also issues with the current CGT regime and how that interacts with the Tax Act, and the Treasurer's already given indications there's more to come. So there's gaps in that regard as well.
Is the practical reality of these reforms that advisors are being asked to explain a tax system that the government hasn't finished designing?
Yes, that's correct.
Yeah. Thank you, Chair. Your submission also provides that every Australian holding a CGT asset on 30 June 2027 may need to establish market value at that date. So what does that mean for the everyday taxpayer, and what does that mean for financial advisors? How costly is it going to be to get a CGT, or get a valuation rather, on a CGT asset?
Well, it depends on the category of the asset. So if it's an asset that's listed on the stock exchange, you probably could easily get that value, market value. But the majority of the assets, if you're looking at business goodwill, for example, or anything that's unlisted, goodwill will depend on forward earnings expectations, and you can't derive that from any sort of market. You have to determine the market value for that and seek expert advice.
Even if it's just a shareholding, do we know exactly what that valuation has to look like? Like if I have shares that I want to sell on 1 July 2027, what evidence am I going to need to show the taxman that I had a valuation done on the 30th of June?
Well, if it's listed on the stock exchange, I presume the value of that is available on 1 July 2027. If it's unlisted, then you'll have to separately go and get a valuation done.
Yeah.
And if I could add, not to speak for the tax office, but they do have a lot of stringent rules around the documentation around valuations, and therefore there is an expectation, especially for unlisted assets, that there will be a methodology undertaken by a professional valuer, and our cost estimates of that are quite conservative. So there is that expansive documentation element as well.
And sorry, just so I'm clear, do we know that the same rules are going to be applying under this new regime that you've just referenced?
So it's really around the documentation requirements that the ATO has for all transactions.
Sure.
And so just really being able to step the auditors through how the value has been done, because of course I'm sure the ATO will be looking out for overvaluations of the cost base. And so therefore any questions the ATO may ask, every business owner or anyone with an unlisted asset will need to be able to prove to the ATO that it is a true market valuation, and that takes a proper methodology with extensive documentation.
Yeah, but is that methodology and what that documentation needs to look like relevant to this new scheme currently defined?
So, so what you're potentially referring to, Senator, is the Minister's power to create a more simpler formula based on an alternative to a market value. That's not in the law. It's not. Yeah. It's in a legislative instrument that has not been written yet.
And just more generally, I think the evidence-keeping requirements that the Tax Office has, yes, they do have administrative guidance on their expectations. So it's a carryover. What we're saying, though, is that a broader range of people are going to need to get this evidence to demonstrate on the 30th of June 2027 that they have a market value, because that's the amount that will be able to access the 50% concession and starts the cost base for the future indexed gains. And so it becomes a critical component from a tax perspective.
Yeah. Yeah, all good. Thanks, Chair.
Thank you. Senator McKim.
Thanks. Good morning, folks. Firstly, to the Financial Advice Association, you mentioned scams and influencers in your opening comments. Since the budget, there's been a flood of advertisements on social media marketing self-managed super funds as, you know, variously a budget loophole, the ultimate tax haven, turn your retirement savings into long-term property wealth. Do you have concerns about that kind of advertising, and do you see any similarities there to the spruiking that went on in the Shield and First prior to the Shield and First Guardian collapse?
So, yes, we are very concerned about that type of advertising, and our members have raised this as something that they're particularly concerned about as well. That element of social media advertising that amplifies these issues and gets in front of more consumers, and the algorithms that kind of relentlessly pursue people once they've clicked on one is something that we're very concerned about, because those people are not getting, by and large, professional advice that's in their interests. The strategies may be good, they may not, but if people are not being advised into them, they also don't have any recourse if something has gone wrong. And that is of deep concern to us, yes.
Thank you. And do you have a view on whether self-managed super funds should be able to borrow to purchase investments, and in particular the limited recourse borrowing arrangements that are available to them to purchase residential properties?
So that's one of the things we have suggested needs a look. I think the change in this legislation, we're not suggesting that the kind of perverse incentive that's been created be dealt with in this legislation, but we're suggesting that action needs to take place outside of this legislation, and that is one of the areas that we're suggesting should be reviewed. Limited recourse borrowing arrangements can create risks when there are a high proportion of the cost of the asset that the person has bought. And in superannuation, we have the additional issue of contribution rules. So if someone is in a position where the interest rate on their arrangement goes up and they're not able to contribute enough, either because the rules stop them or because they've lost their job or something of that nature, that could bring the whole thing down, and that could take out someone's in-time retirement savings. So yes, we think there needs to be a review of LRBAs. We're not suggesting they be banned. We suggest that they should be looked at and those requirements be tightened up. We have suggested that property development in particular is an asset class that is inappropriate for someone to take in a self-managed super fund, and that you shouldn't be able to buy into a property development via your super, because that's just an added layer of risk that, in our view, is too much.
All right, thank you. I'm just interested, I know everything will vary on a case-by-case basis, but in average terms or approximate terms, how long would it take for someone, if they decided today that they wanted to set up a self-managed super fund and then secure a limited recourse loan to purchase a property?
Oh, that's a good question. I don't know the answer to it. We can get some information for you if we can take that on notice.
Yeah.
It will depend upon whether they get financial advice as part of the process. if they do get financial advice and they get a statement of advice, then it's more likely that that's a matter of weeks rather than it happening over a shorter period of time.
So, Mr. Anderson, are you suggesting if they don't take financial advice, it would be quicker than a matter of weeks to set up a self-managed super fund and enter into a limited recourse loan to purchase a property?
Yeah, it would be much quicker, and it would depend upon who they go to. If they go to someone saying, I've made my decision, I want an SMSF, implement it for me, and they've got someone else to help them with identifying the property to purchase and to put the LRBA in place, then that can happen relatively quickly. But the key thing there is if they've identified a property and they want to go ahead quickly to put it in place, then it can happen quickly.
Yeah, and in any event, in your view, more quickly than a matter of weeks. Is that right?
Yes, we would like to have a look at that in terms of how long the time.
There'll be data that we can access in terms of average establishment time. So if we can come back to you on that.
Sure. If you could come back on that, and also as part of that process, if you do have the data, if someone already has an SMSF, how long would it take to line up a limited recourse borrowing arrangement in order to borrow a property if the data's there? Thanks. That'd be really helpful. To the CPA, you've raised concerns about ministerial discretions, and thanks for that. You've laid them all out very clearly for the committee in your submission. Does the lack of definition and the need to make assumptions about a future treasurer's future decisions make it difficult to provide clear advice to your clients?
Yes. And referring to the earlier question, our members have been receiving many calls. We have many tax agents. So beyond just the financial advice, particularly in the business space, personal taxation. So in that sense, not having clarity, and for Parliament not to have clarity around what the full set of reforms actually looks like, who's in, who's out. And then our view is that delegated legislation has a particular purpose, but the primary legislation really should set out the whole package, that there's a common understanding, and to leave questions open as to what is a new residential dwelling, it becomes very hard to give advice. And we understand, that there are multiple tranches coming, but there's no timeline. There's no clarity around what's happening. We understand the Treasurer will be releasing a paper on the small business concessions, but to be asked to pass a bill with lots of delegated legislation that can be changed by the Minister from time to time through a disallowance process is quite unusual. It's not something we normally see. And we do have concerns about the increasing use of delegated legislation across all of the bills.
All right, thank you. You've alluded to this, but the Treasurer has publicly flagged that there is going to be subsequent legislation that's going to deal with some of the things that kind of fall out of the framework legislation that the committee is currently inquiring into. Do you think the Parliament should consider removing some or all of the discretionary powers that are in the primary legislation and potentially legislate those definitions in the subsequent tranche?
Certainly for the new residential dwellings, so you refer to the GST Act where it's clearly articulated what the definition is, so that would be one that we would recommend is in the primary legislation, as highlighted by the FAAA, the apportionment method as well. That is something that taxpayers require certainty over, but certainly we've also called out that regardless of whether you choose apportionment or the actual mechanical calculations, taxpayers will need to assess whether they're better or worse off using either. So once again, for advisors, it's about really saying, well, what is the apportionment method so that people can move forward on their transactions. Even things like qualifying income support payments, given you can receive 1 day of support payment income and that brings you in or out from year to year, those are things that we believe that Parliament should actually scrutinise and have embedded in the bill.
All right, thanks. One of the last question for me, Chair. One of the discretionary powers would allow the Minister by disallowable instrument to, for example, reapply a 50% capital gains tax discount to any asset class. Does that cause you any level of uncertainty in terms of the advice that you might give to your clients?
Yes, and I think that it provides, I mean, it's uncertain for everybody, including the Parliament. So if things can come in and out at any given time, depending on what the budget might look like in a given year or a concession that needs to be given, we understand the need for administrative flexibility, but at a policy level, it's critically important for everybody in Australia to actually understand what is this package, who is it targeting, who's in and out, and how does that connect to the objectives that the government's trying to achieve. So in that sense, those sorts of changes really should go through Parliament rather than through delegated legislation.
Thank you.
Senator Bragg.
Hello. Nice to see you all. I just have a couple of probably silly questions, but I'm just trying to work out just some portfolio-based examples of what might be some of the tax consequences, given we have so many learned tax experts here. We'll be able to get all the answers, all the questions answered. So this whole so-called tax reform has so many different permutations for individuals compared to different company structures, depending on what kind of company you might be, foreign company, domestic company, trust, whatever. It's almost like it's been invented to try and help certain people or certain institutions perhaps get a leg up, but I'm not really into conspiracy theories. That might be one for a novelist in future, perhaps. But so I think the simplistic tax examples that I'm really interested in, I guess, come down to an individual investing in a share compared to a fund, maybe a super fund, investing in a share. So what would be the tax rate if I buy well, let me just get some basics first. So if I buy some Telstra shares as a person, what's the minimum tax rate I pay?
30%.
30%. Okay. But if I buy those same Telstra shares, or the super fund buys those shares, what do I pay?
I think that's generally 10%.
10. Okay, so 10 versus 30.
33% discount.
Yeah. So that's a significant difference. I think that's been well established and agreed by the Treasury. I think what's been less well understood is the ability for an individual to build a portfolio compared to a company that has been set up to invest for the purposes of investment. So a managed investment provider, let's say a listed investment company, might go and buy a basket of shares on the ASX. Some lose, some win, right? So you have some losses, some gains. The company, as I understand it, will be able to net off their losses against their gains, right? The MIS. Yes? You have to say, otherwise the transcript doesn't record your nods.
It's like a widely held trust.
Yeah, so let's say it's a managed investment scheme. Let's do a really dumb example, right? Let's say we've got the, we probably better not use Wilson. Let's use another one. What's another well-known? Let's say Colonial First State has an Australian shares fund, right? They go and buy Telstra, BHP. I mean, Australia's got a pretty sick economy. We've got the same big companies we had 100 years ago. We're probably the only country like this. But let's say we've got AMP, BHP, and the banks in this Colonial First State Australian shares fund. Okay, so some make gains and some make losses. Can Colonial net those gains off against the losses?
Yes.
Okay. Now, what about if I'm a punter and I go and buy BHP, AMP and the banks? Can I net off my gains against my losses if I make losses?
Yes.
I can under this new system.
So the bill itself does have capital loss ordering rules, and we've called that out in our submission. And so deferred losses or losses, there's the step process that Jenny articulated. So it really, there's also some interaction there with which losses you apply when and what the tax impacts of that are.
And these would be nominal or real?
in a company structure, it will be nominal.
What about a punter, a person?
Then they will be subject to these rules. They have to index and it will be real.
They can use real?
So they'll be taxed on the real gain.
No, but can they offset real losses?
No, sorry, the nominal losses.
So they can only offset a nominal loss?
Yes.
So
There's no indexation on
okay. So this is the point I want to get to. Sorry to bore you with this laborious line of questioning, but what I'm trying to work out is the actual point of arbitrage for a person versus a managed investment scheme. Because it sounds to me that if you're a managed investment scheme investing in the same underlying shares, you can net off your real losses, but a person cannot.
Yes, and I think that really what you're highlighting is where are the opportunities for increased arbitrage and differentials between different investment types. And there have also been questions raised around how distributions from those managed investment trusts actually get taxed in the hands of the recipients. So we've only had 11 days to work through the bill, and our members are working through the outcomes depending on the various structures. But yes, the point is made.
So the point is that it encourages intermediation.
Depending on the facts and circumstances, but as a general hypothesis, yes. In the same way that there's now a greater incentive to go towards, for example, self-managed superannuation funds for certain investments.
I mean, you know, people are not as stupid as the Prime Minister thinks. People are actually quite intelligent in the main, particularly younger people. So it will create an incentive for financial intermediation. Now, I'm not against professional fund management. I'm not against anyone, really. A lover of all people. But that's what it does. It actually supports more layering and more intermediation means lower taxes in some cases. That's what it means.
Yes. And, you know, we have the view that individual Australians should have choice about how they build their wealth.
They'll have less choice because of this.
And that the incentives need to encourage innovation, savings, capital investment to drive the economy, and disincentives towards that are challenging, and they need to be thought through. Do we fully understand what the behavioural shifts will be, what choices will be available to individual ordinary Australians, and what are the impacts of this, which is why we have recommended a longer-term consultation process and to do it with exposure drafts and white papers, which hasn't occurred in this instance.
I think that's probably all I have, Chair. I don't wish to badger these witnesses too much. I just wanted to get to that point. I think you've answered it well. I have to say this. I mean, it's a shame we weren't able to have more people come and give evidence about these sort of things, because I think it is very regrettable that individuals will now be effectively forced into using layers and layers of intermediation just to get a better tax outcome. I mean, it seems bizarre to me that if you're an individual, you get a worse outcome than if you go and use a professional manager.
Sorry, just on that point, can I clarify though that both a company and an individual can claim a nominal loss against a gain in the same way?
So a company can claim a loss, a nominal loss. Currently doesn't benefit from CGT discount. And for an individual, they can also claim a nominal loss, based on those four categories Eleanor mentioned. Yep.
Thank you.
It's the real losses that are not available.
Yes, they don't get the benefit
That's right.
of indexation on the losses, but yes.
But they're both being treated the same way. Yeah. Okay, I need to rotate to Senator Pocock. You're on the line, I think.
Thank you, Chair. Thank you very much for your time this morning. I'm interested in one of the recommended changes in your submission where you talk about the need to preserve the grandfathered treatment when property transfers occur due to death or divorce. Can you elaborate on this, please, or give us an example of how this would work?
I think that was one that we raised. A specific reference in the explanatory memorandum talks about the treatment of a jointly held asset and whether if there is a forced change of ownership post 1 July 2027, we're asking about the consequences. So we envisage that there could be a forced change of ownership after that date if, for example, a investment property is owned by a couple and one of those in joint tenants, and one of those people passes away, and their 50% is transferred to their other spouse. The other point we had concern about was with respect to a divorce settlement. If there's a change of ownership of an asset as a result of a divorce settlement, if it's a pre-budget day asset that was validly able to do negative gearing, what was the consequences afterwards if there was a change of ownership because of a divorce settlement?
Okay. And what's your current reading of the legislation?
And I'd welcome CPA Australia's input on this, but our read was that it was uncertain. The explanatory memorandum suggests that a change of ownership that happened as a result of a transaction from with respect to a joint ownership would lead to it being considered as new ownership. So you might have one party, one person who owns 50% prior to the death or the divorce settlement. That would be pre, and then the other 50% that they acquire as a result of that death or divorce would suddenly have the other half being a post commencement date asset. But
I agree with that analysis.
Thank you. One of the options Senator Jackie Lambie and I had looked at and got costed a couple of years ago now in potential reforms to negative gearing was limiting it to one property. I'm interested in your views on what the respective advantages or disadvantages of that over what's being proposed in this legislation.
Sorry, is that question with respect to both negative gearing and capital gains tax treatment?
Yes.
And sorry, Senator, just to clarify, pardon me, were you thinking about saying that the more beneficial treatment for new builds would be limited to one property? Sorry, I'm not sure I understood the question.
Generally, it would be one property, but a greater discount for newer builds. Just interested in your views on just eliminating it first, just limiting it to mum and dad investors. You know, I mean, 70% of property investors only have one property, but obviously there's a small minority who own a huge number of properties.
I guess, Senator, we are aware that that is one of the things that has been discussed as a potential alternative change to this regime. It's not one that we have looked at closely to consider the pros and cons of.
Fair enough. You talk about ensuring that the WATO is available on a proportional basis to lower income workers with mixed income sources. I was interested if you could expand on that please, and what that would look like.
Yeah, so the legislation talks to the fact that it may be available, but it's subject to ministerial discretion. We think WATO, as proposed, is a good thing, but we're conscious that there are some people who will have salary and wages that is less than the tax-free threshold, and we're just seeking to argue that they should be able to access the WATO on a pro rata basis.
Mm-hmm. And you wanting the sort of WATO measures embedded in legislation, is that so you can deal with those sorts of uncertainties, or is it so it can't be adjusted as some sort of electoral campaign sweetener? And as it's currently structured, would the WATO changes be a disallowable instrument? Do you have a view on that?
Well, the legislation proposes that basis for working out whether there would be a proportional availability of it would be through ministerial discretion. And as with everything that is put in place through ministerial discretion, it is subject to, through a legislative instrument, it's subject to disallowance in the Parliament, but it's also subject to sunsetting, so it could be changed in the future. So our argument to say put it in the primary legislation is A, to give certainty now and to give ongoing certainty about how it would operate.
Okay, thank you. I mean, not all delegated legislation is subject to disallowance, but I appreciate your input. Thank you very much, Chair.
Thank you. That concludes our session with these witnesses. Thank you very much for your evidence today. And the committee will now suspend for a short break, and we will return at 11:45. start. We good to go? Yep. Great. I now welcome representatives from the Urban Development Institute of Australia, the Real Estate Institute of Australia and Wilsett Asset Management. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full names and the capacity in which you appear today? And we'll start on my left.
My name's Charles Dowd. I'm here with UDIA National, and in a personal capacity I lead a national construction development organisation delivering housing across the spectrum, from social housing and affordable housing right through to high-end luxury owner-occupier housing as well.
Andrew Mino, I'm the Head of Policy and Government Relations for Urban Development Institute of Australia.
Jacob Kane, President of the Real Estate Institute of Australia.
Yeah, Jeff Wilson, Chairman of Wilson Asset Management.
Thank you very much. I now invite each of you to make a short opening statement, and at the conclusion of any remarks I will invite members of the committee to ask questions. And I note that we've got a tabled statement from Mr Wilson that we can incorporate into the records. Yep, Mr Mino.
Thank you very much for the opportunity to give evidence on behalf of the housing industry. It is crucial for negative gearing and CGT discounts to remain on new housing for supply. The negative gearing and CGT tax changes, however, need to be clarified with industry before passage to ensure that we have the investor confidence we need to boost rental supply. Objectively, the tax changes disincentivise existing rental over new rental, but they do not actually create more supply. The new dwellings built will objectively be more expensive than existing housing, which puts upward pressure on rentals. This will be made worse if the rental investment pauses for any material period of time. It's crucial, therefore, that the bills do not inadvertently delay rental investment, but the bills currently create some concerns for industry. Firstly, the tax changes tend to undermine investor confidence through a lack of certainty from reliance on ministerial discretions that can easily be changed, unclear parameters for things like the meaning of new residential premises, and limitations of ministerial instruments. Investors cannot commit funds unless they are going to have ongoing certainty as to negative gearing and CGT discounts applying, and equally developers can obtain value or feasibility for a project until they have an expert willing to confirm the dwellings they build are eligible for negative gearing and CGT for market purposes. The bill needs to be reconsidered without haste. 2, tax changes create greater tax complexity due to significant departures from existing tax definitions, approaches and procedures. Industry experts are actually struggling to identify the differences and determine how the bills will work in practice. Thirdly, tax changes discourage delivery of housing supply in the short to medium term by increasing risk on feasibilities. A, by significant additional complexity, which increases red tape, increases costs and increases resources to manage tax compliance. And B, number of critical requirements for negative gearing eligibility rely on a legislative instrument which is yet to be drafted. We need clear requirements and frameworks that should be included within the legislation itself. These can be solved, but we recommend that government allow sufficient time to review and amend the bills before it is enacted, including the need for ministerial discretions. And secondly, provide ongoing post-assent implementation consultation with industry to consider any inadvertent drafting problems and simplify compliance before 30 June 2027.
Thank you very much. Mr Kane.
Good morning, Chair and Senators. Thank you very much for the opportunity to appear today. As you've heard, my name is Jacob Kane and I'm the President of the Real Estate Institute of Australia. The REIA is the national peak body and voice for the real estate profession across the country. Our submission makes a simple point. Australia's housing crisis is fundamentally a supply crisis. Housing affordability will not be solved by reshaping tax settings in a way that reduces rental investment, adds uncertainty and risks slowing the delivery of new homes. Today, more than 7 million Australians live in rental homes. The government's own modelling estimates these reforms will transition only 75,000 of them into home ownership over a decade. That's effectively equivalent to 1 in 100 renters. The other 99 will be left in a rental market with fewer homes and higher rents. We recognise the policy intent of these reforms to encourage investment into new supply, but the independent modelling commissioned by REIA, Master Builders Australia, the Housing Industry Association and the Property Council, shows the practical effects may in fact be the opposite. On the tax changes alone, the modelling estimates 14,032 fewer dwelling starts over the first 4 years. Construction output down by $1.9 billion, GDP down by $1.374 billion, and construction employment lower by more than 2,000 full-time equivalent workers by 2930. Even after including the government's $2 billion housing support program, the combined impact remains negative. 8,742 fewer dwelling starts over 4 years, rents higher, GDP lower, and construction employment down by almost 4,000 FTE workers. And that is the core concern here. These reforms do not build more homes. They disrupt and damage investor behaviour in a market already facing acute supply shortages. REIA's position is not that Australia's housing tax system should never be reviewed, but it should be reviewed holistically across federal, state and local settings, and with one test above all others. Will this increase housing supply? On that test, we do not believe these bills in their current form receive a pass mark. Thank you.
Thank you. Mr Wilson.
Thank you, Chair and Senators. Thanks for the opportunity of appearing today. My name is Jeff Wilson, founder and chairman of Wilson Asset Management. We manage approximately $6 billion on behalf of more than 130,000 Australians whose savings are invested in productive Australian and international businesses. For more than 45 years, I've invested alongside entrepreneurs, family businesses and listed companies that create jobs, innovation and economic growth. Markets, as we all know, markets respond to incentives. Now, when direct investment in shares and capital growth becomes more costly, capital does not disappear, it moves elsewhere, often into vehicles like ours. Wilson Asset Management will be a beneficiary from the movements of capital if the legislation, as drafted, passes in its current form. We could simply stay silent and benefit from these changes. Instead, we are here because we believe these proposed changes are not in Australia's long-term national interests. I appear today not simply on behalf of Wilson Asset Management, but on behalf of the more than 130,000 Australians we represent and the millions of Australians who aspire to build a business, invest in their future, save for a home and create opportunities for the next generation. Australia's prosperity has always depended on a simple idea, that if people work hard, save carefully and take considered risks with their capital, they can build a better future for themselves and their families. We believe this legislation weakens that social contract. The government has framed these reforms as a housing measure and a matter of intergenerational fairness. Respectfully, the legislation reaches far beyond housing. It affects shares, private business and every other asset class in which Australians have invested their savings and built their retirements. To be clear, Wilson Asset Management has no objection to the tax reform of unproductive assets, such as housing. We object to the taxation of productive capital in a manner that discourages investments, entrepreneurship and economic growth. Our concern is with reforms that weaken Australia's long-term productivity capacity. The technical design of these reforms also creates unintended inequities for Australians who invest directly in Australian shares. The legislation before this committee represents one of the most significant changes to Australia's capital gains tax system in a generation. It also represents one of the most significant policy decisions affecting investments in productive Australian business in a generation. It will change behaviour. It will discourage risk-taking and it will reduce the capital available to the businesses that create jobs, innovation and economic growth. Changes of this magnitude should strengthen productivity, increase business investment and improve Australia's long-term economic competitiveness. If we make productive investments less attractive, we should not be surprised if we get less of it. The economic consequences of these changes are straightforward. When you tax the returns of risk-bearing capital more heavily, fewer people take risk. Fewer risks taken means fewer companies built, fewer jobs created, and a smaller productive economy. Capital is mobile. If Australia becomes a less attractive place to invest, capital will flow elsewhere. Australia needs more entrepreneurship and more innovation, not less. Australia is a country built on aspiration and on the belief that those who work hard, save carefully, and take considered risks with their capital will be rewarded. We believe this legislation places that aspiration under direct threat. Good tax reform should reward aspiration and strengthen our economy for future generations. Australians deserve a tax system that rewards people who have a go, not one that discourages them from trying. Thank you, and I look forward to the questions.
Thank you very much. We'll go to Senator Bragg first. Senator Bragg.
Oh, thanks very much. Just a couple of questions to Mr Wilson. Your testimony is very interesting because effectively what you're saying is that this is actually going to work out well for your business and for your cohorts or fund managers because it gives you a massive advantage as a professional manager against individuals, doesn't it?
A significant advantage, yeah. Yeah. I mean, there's 7.7 million individuals in Australia that own shares in their own name, but because of the non-netting basis, and I know that's been talked about, they'll want to put their money with fund managers like ourselves. Like we have 9 listed investment companies, and we'll be a major beneficiary.
So it seems like there are a couple of things that really give fund managers a leg up in this new world. Yeah. One is the tax arbitrage of 30% versus potentially 10% if you're a super fund. Another one is this idea of not being able to net off the real losses, isn't it?
The netting off the real losses is a significant leg up. Like every investor would look at their portfolio now and say, like if they have 10 shares, say the banks, a few other things, and you'd say, well, hey, I should sell them all. Well, you've got to work out timing. Well, if you're in the old system, then you sell them before June 30 and then put all your money in one fund. Like, whether it's an ETF or a listed investment company like we manage or someone else. Yeah, so it'll be very positive for the fund management industry, which we get paid for. Like we charge a management fee and a performance fee, so we do very well out of it.
But, I mean, it seems to me to be a strange outcome for the national government to be effectively saying to people, well, you actually should be using layers and layers of intermediation. Yeah, you're actually incentivising people against investing themselves.
Yeah, and it really is disappointing. And I think at the inquiry yesterday, various people were quoting various figures, and I think there was a figure that share ownership's declined since 1999. From I think it's around 40-odd% or 41% to about 38% now. What everyone forgets is in 98 it was 32%, and 97 it was 20%, and 91 it was 10%. So share ownership, we had a period of significant growth in share ownership, with the demutualisation of various companies. And I would say with this legislation, the market, and maybe we'll come back to that a little later, the market's about $3.3 trillion, the Australian equity market. The top 10 companies are about 1.1 trillion. So the rest of the companies, what you're going to find, and I can explain to you why you'll find that all the money will go to the top companies.
So is this going to be the biggest change in behaviour? I guess.
Oh, 100%, enormous change in behaviour. It hasn't been modelled anywhere. Enormous change in behaviour. And I can explain why. But
please.
Oh, okay. So let me do this simple. And it's really important. You probably all need a pen and a piece of paper and write it down just to understand it. And in terms of what this legislation will do, you've got a situation. Say, you're probably too young, but maybe my well, I'm too old. Someone's 20-year-old son or daughter, say, has just finished university, or as a uni or has just finished school, and has been working and has got some money. So say they've got $10,000 to invest. So they invest that $10,000 into a company. And what I'm going to take you through, initially I'm going to talk about dividends, and then I'm going to talk about capital growth, because pretty much what this legislation does is put a big neon sign above Australia and say that we hate capital, and we hate capital growth. But I'll take you through how I get to that conclusion. So that young person has got $10,000, invests in a company, and say that company, so they did well, and say that company made $10,000. And it was $10,000 of profit. And we all know, the corporate tax rate's 30%. So of that $10,000 of profit, 30% goes as company tax, and so they've actually made $7,000. Now, that $7,000 can be paid out as a fully franked dividend because it's the tax has already been paid on it, and so that $7,000 gets given to the son or daughter, the 20-year-old. They put in their tax return, and they get that $3,000 back because it's a franking credit. There's no double, Paul Keating brought in no double taxation. So that's from income. They've made $10,000 and they get $10,000. They keep the whole $10,000. Now, let's look at the other side. Let's look at capital for that person that effectively is paying very little tax. Because it's capital, under the new system, what happens is, of course, the company makes $10,000. It still pays $3,000 tax. So the capital has gone up in value by $7,000. But say if then they sell the shares, so they make the $7,000, now they've got to pay a minimum of 30% tax. So 30% of 70 is 21. So they pay 51% tax. So the person that, whether it's the young person that's effectively on a zero tax, personal tax, or it's the old retired person, the difference, if they get income, a fully franked income, they pay no tax. If they make capital, again, they pay 51% tax. So why would you? And that's the zero tax payer. Let's have a look at the 47% taxpayer. So the 47% taxpayer, the same thing. The company's paid $3,000 tax. So the 47% taxpayer gets the $7,000 dividend. They're on a 47% tax rate, so they've got to pay the $1,700 top up because 30%'s already been paid. So effectively, they've got $5,300, but they've paid 47% tax. That's with income. That's for the 47% taxpayer. And then for capital with the 47% taxpayer. So the $10,000 is made, the $3,000 of tax has been paid, and say they make that $7,000 of capital gain, under the new system, and we'll come back to inflation in a minute, under the new system they pay 47% tax on that. So that's 32.9%. So plus they've already paid 30%. So effectively the 47% taxpayer is pretty much paying 62.9% tax. Under the old system, of course, they're paying half the 32.9%. So they're actually paying they're paying 30% plus 16.45, so they're paying 46.45% tax. So under the old system, the high taxpayer, it's about the same as what they pay on their income tax. Under the new system, it's 62% against, it's significantly more. So broadly, everyone, no matter if it's the person that doesn't pay any income tax, or the person that pays 47% income tax, doesn't want to make any capital gain.
Bizarre.
In real terms. Zero.
8 minutes.
Okay.
Yeah, so broadly, what does that do? That'll change everyone's behaviour.
So people, why do you say people will flood to larger companies?
Well, just that. Because that example I gave you, just making 10,000, you get the benefit of inflation. So if a company's, it's a $100 million company, and it's sort of, so 3% of 100 million means that your total profit is, that $10,000 is, in real terms, you're making no money in real terms. So broadly, what you want is you want big dividend payers that have no growth, or growth that's around in line with inflation.
Because you want the franked income.
But you want the franked income because you're getting, like, the benefits. You're paying 30 or 40% less tax.
So what does it mean for small companies?
Oh, that's the end of small companies. Like, effectively, all the money will go to Rio, BHP, the big banks, the top 10 companies. That's where all the money will go, and anyone below that, like in terms of the cost of capital, go through the roof.
Great.
Like, it's a disaster.
Rotate the call. Senator McKim.
Oh, yeah, thanks, Mr Wilson. Thanks very much for your engagement on this issue over a couple of inquiries now. And I do note that you've made it clear that you have no objection to the tax reform of unproductive assets such as housing. Can I just be clear that that means that you don't object to the changes in capital gains tax arrangements in relation to housing?
Yes.
That's correct.
Position. Yes.
Yep. Thank you. But you obviously do have a concern in relation to shares.
Yes.
I just want to put to you that when
or shares or Australian businesses, effectively.
Yep. Thank you. When the capital gains tax discount was introduced, the stated goal was actually to get more people investing directly into Australian companies. I think a reasonable assessment of the primary effect of that change was that was not the primary effect, and in fact the primary effect was because of the interaction of the CGT discount with negative gearing, was to drive a whole bunch of capital into property speculation. Would you agree with that?
To me, I wouldn't necessarily agree with it, only because you've actually got to look at what happened over that period of time. I mean, we're picking points in time, and I mean, the great thing about statistics, they can all lie. And back in the early 80s, like, there was very little share ownership in Australia. Share ownership did increase significantly, and you look at share ownership in the UK, from back in 2000, it was about 30%, and now it's down to 18%. So we've done significantly better than the UK. But to me, there could have been the share ownership with all the demutualisations, with CSL, with CommBank, with Telstra, that drove a lot of interest. You look at what's happening with SpaceX in the US.
Let's not go there.
No. The reason I'm going there is because that'll create.
It's a Ponzi scheme, that one, Mr. Wilson.
But that'll create share ownership that you never had before.
Oh, I think it's a bad thing, because in Ponzi,
well, it could well be.
I don't want my shares going into a Ponzi scheme. Thanks very much.
No, but it could well be. But in theory, it's something exciting that people, like Commonwealth Bank demutualisation, AMP demutualisation. So it's hard to adjust for the end of demutualisation and the drop in share ownership. So it's not necessarily linear. Sorry.
Okay. No. I appreciate the point that you're making. So it's your contention that that the primary effect of the introduction of the capital gains tax discount was not to drive capital into property speculation? You think the bigger effect was to drive capital into share?
No, not necessarily. Not necessarily. Yeah.
You think the bigger effect was to drive capital into shares? No. So you accept the contention that the bigger effect was to drive capital into property speculation?
Yes, but I'm not. Yeah. You should ask the property
expert.
No. But you see, I'm the share expert.
No. I understand that, but the point I'm coming to, and this is I guess my question to you, Mr. Wilson, is if that's the case, that the primary effect was to drive capital into property speculation, and a primary driver of the housing crisis that particularly young Australians are suffering through today. If that is the case, and I think you've agreed with that contention, don't you think that reining it in would actually result in more Australian savings being put into things like companies and shares?
Not at all, because I mean, well, the tough thing is it may be, but it'll be the wrong shares.
All right. And that's the point you were making earlier to Senator.
100%.
Right.
But in theory, I mean, and what I proposed at the last time we met was that to have it tax neutral. So whatever the profit, the discount was dropped for in property, increased it with operating Australian businesses. Because what we want to do, if we've got a productivity problem, then we actually want to improve productivity. So we want, you know, as Jim Chalmers says, we want patient, we want deep capital. We want patient long-term capital. So by, like, to me, it's nearly illogical to say if what we bought in back, you know, whenever it was in 99, drove money into shares, money into property, speculation more than shares, so we're going to drop both the same amount, then in theory it should have exactly the same effect. So it'll have exactly the same amount of money will go into property at the expense of shares. So it won't achieve at all what, if that's what you're trying to achieve.
All right, thanks for that. Look, we've got a situation at the moment, and this situation will remain the case even if this legislation passes, and I guess this is a proposition to the panel, where someone who goes to work every day as works in hospo or works as a nurse or a cleaner or a teacher are paying significantly more tax on their income than someone who makes the same amount of income, flipping investment properties or buying and selling shares. Does anyone here find that unfair, or is it the general contention of this panel that income derived from capital investments should receive such significantly favourable treatment, tax treatment, compared to income generated from labour, from working?
I mean, from my perspective, it's all about risk reward. Like if I go and start my own business, then 19 out of 20 companies that start their own business go under. So if I go and start my own business, I want to get somehow, if I'm going to take that enormous amount of risk and probably work for so many years and sweat equity, et cetera, I want to get a better reward. Otherwise, I just stay.
So you're comfortable, Mr. Wilson, with
there must be a different. There must be for people taking risk. Like, I mean, that's how markets operate. If you take more risk, then you get more reward. And if my risk is, if I have less risk, then it's less reward. So I think there should be a differential between the two.
Working's a pretty risky thing to do, isn't it? Like, some people die when they go to work.
Well, but
whether I go
to work for a salary or go to work and taking my risk capital, and unfortunately, like, the saddest thing is, a friend of a friend committed suicide last week. Had his own business, went under.
Yep.
Killed himself.
Anyone else got a view on the relative tax rates of capital versus labour?
The simple reality is we have strongly supported the idea of broad-based tax reform using the whole of state and federal apparatus to create a fair and equal system. That doesn't mean cherry-picking and picking winners by focusing in on one tax, which has actually, by dint of circumstance, created a jeopardy, because those very same people that you're talking about are now going to face higher rents. And it's not a debate. They simply will, because new property is more expensive than an equivalent existing property. And I'm not saying it to be, whether it's pejorative or positive or not, it just simply is. And unless these bills, either everyone decides, you know what, we're just going to build supply because we're in a housing crisis, and housing crisis needs supply or measures to allow for increase of supply. Unless we do that, the only other option you have, ironically, is to go out there and build more rental property that is actually of an affordable nature for middle-income Australia, because they are the people that are going to be hurt most by these changes. Because if we pause on investment, if the investors don't get the certainty that they need, and they have to pause for a month, 2 months, 3 months, the demand growth continues, irrespective of what happens with supply, and that rental increases still further, and you get a much worse situation.
All right, thanks. If your contention is that governments should resume constructing large amounts of dwellings, we're in furious agreement. Thanks very much, Chair.
Thank you. Senator Smith.
Thank you very much. Mr Wilson, you're a co-signatory to a submission made to the inquiry from Future Generation, which identifies some of what you call the unintended consequences to charitable and philanthropic giving as a result of the government's proposed changes. Can you just explain briefly to the committee why you think there will be a decrease in charitable and philanthropic giving, and can you put a quantum around the scale of that negative impact?
Can I take that on notice?
You can.
The only reason I take it on notice because I'd hate to give you the wrong figure.
No, it's a very, very important. It's a very, very important issue.
It is a large figure.
It's a very, very important issue. Philanthropy Australia has called it a donation tax. The Australian International Development Network, just one of many charities and not-for-profits to be impacted by this, has drawn to our attention the negative consequences. Can I ask you another question then? You identified 2 possible remedies that the government could, on page 2 of your submission. You identified 2 possible remedies that the government could implement. Are they remedies, in your mind, that are easy to do, i.e. in the form of an amendment to the bill when the Parliament debates this in just 2 weeks' time? Or do you think that they require extensive consultation for 12 months, 18 months, 24 months?
I'm not sure if I'm going 18 months or 24 months consultation. But as we all know, I don't know if I'm allowed to say this, but...
Well, why don't you say it, and then we'll make a judgment.
Well, to me, this is a bit of a farce, this hearing, because I know a lot of people that have put in...
Well, in a cost of living crisis, here is a government that is making it harder for charities and not-for-profits to respond to a cost of living crisis. Whether it's intended or unintended, we're yet to see. I'm just curious to know with what speed the government could bring forward an amendment to correct what is a very, very significant harm to the community.
Well, in theory, you wouldn't want the bill to be passed until that's been corrected.
Because the consequence is so serious.
Correct.
Thank you.
I mean, it's billions of dollars, but
that is exactly the case.
Yeah.
Others have sought to identify it. It is a huge sum of money, and the consequences will be real and immediate to many organisations.
Yeah.
Thank you.
You've finished your questions?
Yes.
Yeah. Okay. Thank you. I've just got a couple. Maybe I'll go to Mr. Kane, given. We haven't got you on the hand side yet. There's been, I think you and also the UDIA spoke, very much about our challenges around housing supply and really needing to address that. I think everyone would understand the observation that the government's approach around housing supply is much broader than the subject of the 2 bills that we're talking about today. But the government is investing $6.3 billion in the last mile enabling infrastructure, with more to come as it finalises deals with the remaining states under the 100,000 homes for first home buyers program. Just wondering if you could talk about your thoughts on that investment.
Look, we have broadly supported all of the initiatives and projects that the government has announced over the past couple of years, particularly around delivery of new homes and for those targeted segments as well. The point we would make and the argument that we would continue to push is that the investment is insufficient at the current rate of delivery, and there are other conditions that I suppose that sit behind failure to reach those targets at this point in time. They relate to, the red tape. I know colleagues of ours who spoke yesterday pointed to some of the cost impositions in terms of delivery of new homes, somewhere in the vicinity of 40 cents in every dollar being related to some local, state or federal government tax or impost. Those are the areas we strongly believe that need to be addressed prior to consideration of changes like those proposed in the bill here, because ultimately, as the Treasurer said only a couple of weeks back, supply is the main game in solving this affordability crisis. In terms of unlocking delivery of new homes, we need to tackle those red tape issues, the resourcing issues, and the cost of delivery of new homes.
Mm-hmm. So, but if we're to delay, can't we walk and chew gum at the same time? Because if we delay, then aren't we delaying the unlocking of new supply of housing while we, are putting in additional investment to address some of the issues that you've just raised?
Yeah, look, it's a fair point in terms of we need to be able to do everything, everywhere, all at once in some respects. I refer back to my sort of opening comment around that the test for policy should be at this point in time. Ultimately, does this increase supply? And anything that has a downward impact, a negative impact on the delivery of supply, should be reconsidered, or it needs to be countermanded or counteracted by additional policies that support that. And I think that our modelling again shows that even though that's a fantastic announcement with regard to that $2 billion infrastructure fund there, it doesn't do enough to mitigate the negative impacts of the changes proposed in this bill.
Mm-hmm. Okay, I guess we can always do more. This is a significant challenge, and yeah.
A wicked problem, absolutely.
Yeah. Oh, did you want to add something?
Yes,
please.
Senator. We're in a housing crisis. The only thing that matters that gets you where you need to go is initiatives that build supply or make sure that supply is created by getting things out of the way, such as regulation, such as building infrastructure. Mm-hmm. UDIA National has been absolutely unequivocal in our support of both the Coalition and Labor of any initiatives that are going to build infrastructure to unlock housing. It is a low-hanging fruit and an absolute necessity, but it's really important to understand, and I do actually appreciate the remarks of Mr. Kane and concur. The reality is what we've currently got in front of us by Treasury's own admission and government's own budget statements actually reduces supply. So it's not a supply measure by any stretch of the imagination. What we actually need is supply measures to go forward. And I don't think that this bill hinders the creation of or unlocking of houses for infrastructure as it currently stands. What we would say, however, also, and I would like to pass off to my colleague because he has real-world coalface experience on this, the infrastructure and the housing that's going to be unlocked is the housing that currently is in either proposal or is housing that may not necessarily relate to investment. You need an investor to buy a new dwelling in order for there to be a rental. So the fact that you've got that, and while we wholly support it, and we've been on the record saying that the $2 billion that you were talking about could unlock as much as 160,000 houses if it's done in the right way for gaps across state and local, but it doesn't necessarily unlock rental property. But I'll pass over to my colleague here.
A lot of our delivery, and it is the, I guess, MO of local and state governments is around transport nodes and in higher density environments. Mm-hmm. And I can tell you with the majority, if not all of the feasibilities that we look at where projects are not feasible, removing all or some of the infrastructure cost doesn't really move the dial. The feasibility challenges are much bigger than just the cost of infrastructure for those projects. So that's why we're advocating, I suppose, for a broader reform because of the cost of delivering new housing as it relates in particular to the amount of local, state and federal taxes that are paid in new housing.
And I guess some of those issues raised are kind of outside of the scope of the inquiry of this, but I take your point. Mr. Mino, just yes. On the point that you made, I think you said up to, did you say 160,000 homes could be delivered? Was that based on the $2 billion infrastructure fund if it was delivered in the right ways?
Correct.
And so what is that forecast based on?
Because I think based on our own analysis. I know you've got Treasury analysis.
Treasury forecast is 65,000.
We work very closely with the Minister for Housing. We've actually worked closely with all sides of government, and we enjoy a level of confidentiality with everybody. But we've also been providing exactly the same information to everyone on this point because it is so crucial. And that is that with the $2 billion, we have got analysis that tells us that if you use all existing funding that is sitting at state and local level, and you ensure that you are only using the gap for that funding, that you can get up to 160,000 houses rather than 65. Now, the reality is this currently is working on local only, so it may not be necessarily as high as that, but you know,
when you say local only, sorry, what do you mean?
Well, it's for local infrastructure, right?
Yep.
So what we were saying is you have to be opening it up to more, but you know, it remains to be seen because you know things can change, as we undoubtedly know. So we may be able to push further towards that 160, right? Something to aim for. Yep. But the reality is I would encourage you also to talk to the Minister for Housing because we've shared all of the data in relation to that.
Yeah, okay. Thank you very much. I think that concludes our questions for this panel. So I really appreciate you all coming and your time. So we will suspend for a short moment until we invite our next witnesses up. Thank you. Welcome representatives from the Australian Council of Social Service who are here with us in person and the Australian Council of Trade Unions online. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full names and the capacity in which you appear today? I'll go to the ACTU representatives first.
My name is Joseph Mitchell. I'm the Assistant Secretary of the Australian Council of Trade Unions.
Thank you.
My name is Thomas Greenwell. I'm the Senior Economist at the Australian Council of Trade Unions.
Thank you very much. And here in the room?
Peter Davidson. I'm the Principal Advisor at Australian Council of Social Service.
I'm James Hall. I'm a Senior Advisor at ACOS.
Thank you very much. I now invite you to make a short opening statement, and at the conclusion of any remarks, I will invite members of the committee to ask questions, and we might go to the ACTU first, just given you're online. If you could fire away.
Thanks so much, Chair. Thanks for the opportunity to appear today. I'm joining you from Wurundjeri country, the people of the Kulin Nation, and pay my respects to elders past and present. Australia's housing system is no longer delivering housing security or fairness. For the last 2.5 decades, house prices have outpaced wages. Home ownership among young people has declined. The capital gains tax discounts and negative gearing have been key drivers of these outcomes. Since 2001, home ownership rates across the board have declined. Before the introduction of the CGT, a house costs about 6 times the average income. Today, it's doubled, nearly doubled, to about 11 times. In 2001, home ownership rates started to fall, declining by about 5 percentage points. And this has been most acutely felt by young people, with those aged 25 to 34 seeing a decline that has taken their home ownership rates back to where it was in the 1950s. The capital gains tax discount and negative gearing have worsened inequality. This year's budget papers set out that those tax concessions overwhelmingly benefit those on high incomes. Meanwhile, those who work to earn a living shoulder a greater responsibility for making sure that the services that Australians rely on are funded out of their wages. This is why the ACTU, the union movement, is recommending passage of these bills. The reforms proposed take action to address declining home ownership for young people while also reducing distortions in the tax system that fuel inequality. These bills also contain 2 important cost of living measures for working people: the Working Australian Tax Offset and the $1,000 instant tax deduction are welcome measures to address the financial strain that many working people are experiencing to rebalance the tax treatment of wealth and work within the system. Australian unions have a history of supporting tax cuts aimed at low and middle income Australians that enhance the progressivity of the tax system, and we commend these tax cuts for funding the relief and winding back regressive tax concessions that benefit speculators. Australian unions acknowledge that Australia cannot fix the housing crisis through tax reform alone, but the tax settings are a big part of the picture. They must change if we want a fairer housing system for all, including for future generations. We support these bills as an important step forward to this goal and strongly commend them to the committee and to the Parliament.
Dr. Davidson?
Thank you, Chair. ACOS strongly supports these reforms to the taxation of personal investment, which have been a long time coming. While the transitional arrangements differ from our own proposals, they are the most far-reaching, progressive personal income tax reforms in a generation. The present system is unfair. It's unfair that an investor on $200,000 pays tax on capital gains on their shareholdings or property at 23.5%, while a middle wage earner on, say, $70,000 a year pays 30% tax on their next dollar earned. Nor is it fair that investors can deduct expenses on their rental properties against their wages every year when the capital gains are only taxed years later and then at half the normal rate. The system is inefficient. The current tax treatment of investment income privileges speculation in asset values over productive investment, lifts the cost of land and housing beyond the reach of the vast majority of young people and those with modest incomes, and has raised household debt levels to among the highest in the world. It deprives governments of the revenue they need to provide the services and supports we rely on. ACOS does not support more tax cuts via the WATO on top of the 3 already announced over the last 3 years. Instead, revenue from reforms of investment taxes should be devoted to closing long-standing gaps in essential services and income supports. The budget makes the largest ever cut to social expenditure via the NDIS and projects that real per capita expenditure growth will fall to 0 across the forward estimates. That, in our view, is not sustainable. Now, my colleague and I will briefly deal with 3 questions, and we're happy to table a statement if we run out of time. Firstly, why CGT reform should extend beyond housing, and that's been an issue of controversy. Secondly, the benefits of the reforms for housing, and thirdly, why another tax cut shouldn't be legislated at this time. Why should CGT reforms apply to all assets? Well, the reason is simple. Tax should not distort investment decisions unless there's very good reason to do so. Arguments to exclude shares, crypto or other financial investments from reform, in our view, confuse increases in the value of these assets with productive investment and share markets with the real economy. Crypto, for example, produces nothing. Share and financial markets are prone to irrational speculation and harmful booms and busts. When the CGT discount began in 1999, it was supposed to bring Australia towards the frontier of the dot-com boom. But that boom busted a few years later, and the discount inflated a property boom instead, and history may repeat, we don't know. The CGT discount encourages a certain type of investment, yielding large and fast returns in the form of capital gains rather than ordinary business profits or rents. In other words, speculative investment. Now, speculative investment can support innovation and growth, but using an across-the-board tax break on capital gains to support growth is like using the wrong fertiliser. The result is more weeds than the crop you want to grow. A much better approach is to support innovative startups and research and development directly and well before they produce capital gains. Any CGT carve-out for those businesses should be carefully targeted. If we're talking about startups, there are 400,000 to 500,000 new businesses every year. Less than 1 in 10 is likely to grow above the $2 million turnover threshold for which they're eligible for the existing small business CGT discount. And only a small minority of them, probably well under 5% of all new businesses, could correctly be described as new ventures attracting investment to test a major innovation. And finally, from an equity standpoint, shares are as unequally distributed as investment property. 2/3 of the value of investment property, shares, business and financial assets are owned by the wealthiest 10% of households. And I'll turn to James to deal with housing.
So I'll speak briefly to how the reforms will deliver 5 key benefits for prospective homeowners and renters. So first, they make home ownership more affordable, reducing home price growth by 3 to 5% based on independent modelling, and that's significant. It matches or exceeds the impact of the combined efforts of all governments to build 1.2 million new homes over 5 years, which is expected to reduce prices by just 3 to 4%. Second, by winding back the investor tax advantages, the reforms shift ownership of housing from a vehicle of wealth accumulation to being a home to live in. So right now, investors are buying twice as many homes as first-time buyers. Over a decade, an extra 75,000 would-be renters will own their home instead of investors, reversing 10 years' worth of a decline in home ownership rates, which has mostly impacted young people. Third, the reforms could improve rental security. They remove tax incentives that encourage investors to churn properties, selling frequently to capture tax advantages from short-term property flipping for quick gains, or repeatedly re-leveraging to maximise negative gearing, and which are a common reason then for renters having their leases terminated. Fourth, on rents, while the reforms have little impact on rents market-wide, there is some evidence they could modestly improve rental supply and moderate rental growth at the lower end of the market over time, where affordability issues are most acute. This is because there's research suggesting investment tax breaks have skewed investment towards the higher value rental properties where there are larger tax benefits, which has come at the expense of lower value rental properties with typically lower rents. Finally, on housing, the reforms make government spending on housing fairer, shifting away from where it's not needed. They reduce expenditure on property investor tax breaks, which currently exceeds spending on all other forms of housing assistance combined. They're not the whole solution to the housing crisis, but they're a critical part of it, alongside investment in social housing, home energy upgrades, homelessness services, and limits on rent increases. So I'll just finish by explaining why we don't support the income tax cuts in the bill for 2 reasons. First, on revenue. So Australia is a relatively low taxing country with below average public spending in the OECD as well. Our estimated growth in federal expenditure is less than the long-term average of this country, and our fiscal challenges are a revenue problem. They're not a spending one. We need more revenue to fund essential supports and services, and the investment tax reforms help. They raise around $40 billion over a decade. But if all or most of that is dedicated to income tax cuts, the underlying revenue pressures remain and they'll grow. And then finally, on equity. The tax cuts deliver nothing to around 5 million people, 1 in 3 adults, because their incomes are just too low to pay income tax. That includes 4 million people receiving income support. A person on job seeker, about $21,000 a year, or 43% of the minimum wage, has seen a real increase of only around $1,000 under this government. Meanwhile, someone on $200K a year will receive more than 5 times as much from these tax cuts, the 4 combined, amounting to nearly $5,800. So we heard earlier, and we often talk about being pro-aspiration. Whose aspiration? You know, how about the aspiration of people on the lowest incomes whose aspirations are immediate and basic? You know, a decent job, a secure home, 3 meals a day, and a life with dignity. And so if we're serious about that aspiration, it must be across the board, and targeted support is needed to help those who need support the most, and not delivering costly tax cuts that leave them behind. Thanks. Happy to answer questions.
Your extensive statement covered off on some of my questions, which is great. So that reduced the number of questions. But I have a couple for the ACTU. I'm not sure if you were listening in to the previous panel of witnesses, but we heard, if not, we heard some interesting observations around the level of risk taken by investors in capital versus the level of risk taken by workers. And I just wondered if you, what your view is on that. If you heard that conversation, basically the argument was that capital investors take on more risk than workers, despite the fact that I think Senator McKim identified that a number of workers work in quite high-risk industries, and the consequences of them going to work sometimes can be death. And, you know, just your observations about, you know, balancing those two risks. And, you know, I guess in addition to that, the question around fairness about workers on average typically paying higher taxes than someone that earns their money from capital gains or family trusts, and that question of risk, if you could.
Yeah. The current tax settings, the Howard era tax settings, are just really unfair for working people compared to people who earn their money through capital income. It isn't right that a person who earns their money through rent, or a person who earns their money just through waiting for returns to trickle in from their large portfolios, gets to enjoy tax benefits compared to workers who go to work every day. You know, your reference to Senator McKim and issues of safety at work is really, really important. A lot of workers do take enormous risks every single day in the workplace. You know, when it comes to a lot of industries, they are dangerous. They're dangerous to our health, they're dangerous to our lives and our livelihoods. And it is not fair that that risk is not recognised. These measures that the government has put forward do a very good job of finally ending the imbalance of a tax system that favours wealth over work. And that is a really important principle to pursue.
Thank you. In the interest of time, I will keep just one more question from me and then we'll rotate. One of the benefits of the $1,000 instant tax deduction for work-related expenses, which I think you said in your opening statement you support, is that it simplifies the process of preparing a tax return. I wondered if you could talk about, you know, the importance of simplifying that process for workers and how much it will save individuals in compliance costs.
Yeah, look, the vast majority of people don't claim more than $1,000 in their tax deductions. And if they do, they're claiming it on things where it is hard to keep the receipts, hard to figure out exactly what proportion of expenses you need to allocate to it, whether it be a phone bill, whether it be other things that you had to purchase in order to do your job well or do your job over that year. By simplifying it to a $1,000 instant deduction, you make workers' lives easier while benefiting them as well. It's a really good deal for working people. In addition to that, the government's put forward the $250 working Australian tax offset, which to provide a tax cut for people who earn their income from labour rather than all income is a real recognition of how imbalanced the tax system has been for working people over the last couple of decades.
Thank you. I'll go to Senator Smith now.
Thank you very much, Chair. Thank you very much for your participation today. Just to the Australian Council of Social Services, could you just give me a sense of who you represent and the size of the membership that you represent?
Yes, we We directly represent a network of around 4,000 organisations that are community-based NGOs, and indirectly a much larger number through the membership of peak bodies of ACOS. But our primary focus is the needs of people on the lowest incomes, people at risk of poverty, as distinct from the interests of community organisations only.
Mm-hmm. Great, thank you very much for that. Would it be an unfair consequence, whether intended or unintended, would it be an unfair consequence of the government's proposals if it was to lead to a reduction in the size of charitable giving to community organisations, not-for-profits and charities?
Senator, we're aware of the concerns that have been raised in a number of submissions around, I think specifically the minimum 30% CGT rate. Firstly, for context, we're not concerned that people who are wealthy might become less wealthy as a result of tax increases and therefore less inclined to donate to charity. The community services and income supports on which people on the lowest incomes rely predominantly and correctly come from government. We shouldn't be relying on philanthropy to fund essential services and income supports, though philanthropy has an important role, an important supplementary role. Going to...
So just, Mr. Davidson, Dr. Davidson, just so I'm clear, you're not concerned that as a result of these reforms, rich people may decide to give less to worthy causes?
No, I didn't say that.
Sorry, that's what I heard.
I said we're not concerned in general terms that, this argument could be made in regard to any tax increase that affects people on the highest incomes. But
people of modest means also give to community organisations, not-for-profits and charities. Am I correct?
Yes, they do.
People with more modest means, that's right.
And more so to community services than wealthier people, proportionally, actually. Going to the specific concerns that have been raised here, our understanding is that a legitimate concern has been raised that imposing a minimum rate of tax on that stream of income, capital gains, may wash out or displace DGR deductions, and that there may be an inconsistency in the treatment of deductions for capital income compared to donations by wage earners, for example, and that's an issue we're watching, and we think from media reports it's an issue the government is watching as well in discussion with charitable organisations, major charitable organisations, and we'll watch that carefully.
So of the 4,000 organisations, community-based NGOs that you said that ACOS represents, none of them have raised any concerns or raised any queries with you about extensive media commentary, submissions to this inquiry?
No, not directly with us. Indeed, a number of our members are asking us, should we be concerned about this?
And what do you say to them?
As I just said to you, it's an issue we're watching.
But Philanthropy Australia has already developed a position. They've said it's a donation tax. The Communities Council of Australia, led by David Crosby, the chairman is none other than Tim Costello.
Yes.
Have written saying that there will be negative impacts. organisations like the Australian Council for International Development. This is the peak organisation that supports foreign aid projects across the world, have come out and said that there will be negative impacts. And you're telling me that of the 4,000 organisations that the ACOS represents, people are just asking some general queries. You've got a watching brief.
Those concerns have not been explicitly raised with us by our members.
In your submission, you state that many people are under financial pressure due to higher living costs, weaker incomes growth, high rents and interest rate increases. If there was to be a negative impact on the community organisations and not-for-profits that are supporting those people under financial pressure that you've identified in your submission, that would be a bad outcome of the government's reforms, correct?
Well, we don't know that that's the case.
Are you confident it's not the case when Philanthropy Australia, Communities Council Australia, the Australian Council for International Development, Mr Jeff Wilson from Wealth Generation and others are pointing not just to concerns, but some have been able to quantify the impact?
In any major tax reform, there will be a range of views, and we read all of these carefully, but there are contrary views also that, in particular, that government needs sufficient revenue to fund the income supports and essential community services.
Even if it punishes the very not-for-profits and community organisations that are trying to provide relief and dignity to those people on low incomes that you say ACOS represents?
We don't accept that that's proven.
So it would be a totally reasonable, fair outcome of the government's reforms if it was to, consciously or unconsciously, intendedly or inadvertently, punish community organisations and not-for-profits?
It would be an inadvertent impact, I would expect.
And one you would like the government to correct?
We would prefer... We wouldn't like to see the gift deductibility incentives substantially weakened. At the same time, as I indicated earlier, we're not concerned as a general proposition that if well-off people have to pay more tax, that the impacts on philanthropy outweigh our concerns about revenue adequacy.
What if the consequence of these reforms was that well-off people and people of modest means were to be impacted?
I think it's
in regards to the impact on their charitable giving.
I think it's very unlikely that people of modest means will be adversely impacted. People on an income support payment, pensions or allowances,
which is not what we're talking about,
are not directly impacted, and they can earn up to $60,000
well, there must be some
a year if they're a couple.
There must be some impacts, Dr. Davidson, because the government has conceded. The minister responsible for charities conceded last week at the National Press Club that the government had done modelling. You only model if you know that there's going to be an impact.
You're at 9 minutes, Senator.
Thank you. So perhaps, Dr. Davidson, you might like to take the line of questioning on notice. I'd be very, very interested in the formal view of the Australian Council of Social Services. It would be indeed the most interesting of times if the Australian Council of Social Services stopped standing up for community organisations and not-for-profits. Thank you very much.
Thank you. Senator McKim.
Well, thanks very much, and can I acknowledge the engagement of both ACOS and the ACTU with this issue over 2 Senate inquiries now, so thanks to both organisations for that. Firstly, to ACOS, as you've said, Dr. Davidson, you've got an interest in representing low-income people. They'd overwhelmingly be renters. How do you think renters are going to fare under the changes contained in this legislation?
Do you want to get that? Sure. So, look, in terms of the impact on rents, we agree that there's little impact on rents across the market because rents are mostly determined by what tenants can afford given net rental demand and supply in a segment of the market. And mostly the research we've read is that landlord financing costs have little flow through to rents. When negative gearing was abolished, for example, for 2 years in 1985, there was no clear impact on rents. They grew in some places where there were low vacancy rates, but fell in other places where vacancy rates were higher. It's also true that investors don't contribute much to supply. Only 1 in 8 investor loans are for new construction. And since there are grandfathered elements of these changes, any marginal reduction or impact will be spread over time and could be offset. So I guess there's different factors pushing and pulling, but one, as I mentioned in the opening statement, is that there is some evidence actually that the investor tax breaks have skewed investment towards higher value properties at the expense of lower values ones. We haven't modelled it, but it's a piece of research we wanted to draw to the committee's attention.
All right, thanks, Mr. Hall. That's helpful. There's been obviously a lot of commentary about the proposed changes, a lot of claims made recently, and Senator Smith's been pursuing one line of that, which you've responded to. But are there any claims out there that you think are overblown in terms of criticisms of this legislation, and if so, which are they, and how do you think they're overblown?
Thank you, Senator. I think that despite all of the noise, especially around the extension of the investment tax measures beyond housing, people are increasingly confirmed in their view that the current investor tax arrangements undermine housing affordability, are designed to undermine housing affordability through competition for home ownership between investors and prospective homeowners, and also by, as my colleague mentioned, by making rentals less secure because investors flip properties in order to take advantage of quick capital gains. I think it's also true that there remains in the community a widespread concern about the inequity in the tax treatment of investment income versus wages and other income. I think despite all of the noise, those concerns remain out there. I guess some of the disappointing things about the criticisms of the investment tax reforms are, firstly, the notion that lots of young people will be adversely affected. I think some of the examples that have been given are just really out of touch with the lives of the majority of young people. I mean, amongst young people under 25, young adults under 25, half of them aren't paying income tax. Their income's too low. More of them are employed part-time than full-time, and they're struggling to get into the housing market. So for the current generation of young people, their transition to secure full-time employment and secure housing has been delayed. And these are the big concerns for young people, not will my investment attract a higher rate of capital gains tax. Well under 1 in 5 young people under 35.
Fewer than 5%. of people under 35
Sorry.
report capital
1 in
gains
20.
or use negative gearing. It's a very small number.
Gearing.
Yeah.
And so I think much of that evidence has been misleading and out of touch, as I say. And secondly, this view that that investment in financial assets, whether it's crypto, other financial investments or shares, is equivalent to productive investment in the real economy. I mean, we should get real here. The share market is subject to massive booms and busts that are often unrelated to what's going on in the real economy. We may well be in the midst of one today. We may well be in the midst of an IT investment bubble as we speak, and one that reaches as far as the planet Mars. Crypto is completely unproductive. Shares increases in share values can promote productive investment, especially at the more risky end. We accept that proposition, but a large part of the speculation in quick capital gains in shares is just that, purely speculative, and there is a case for reweighting investment incentives towards longer term investment, patient investment, and real profits, investment that yields real profits. You can argue one way or the other on that, but we think the system is excessively leans towards the speculative, quick and large capital gain end of the spectrum.
Thanks, that's helpful. The government's modelled that the changes will result in about 75,000 dwellings over and above what would have happened anyway, will shift out of the hands of property speculators and into the hands of owner-occupiers. And a question for both ACOS and the ACTU. Firstly, my assumption is that both organisations would support that as a good social benefit. And secondly, given the grandparenting arrangements that the government has determined on negative gearing, do you think that if those grandparenting or grandfathering provisions were not in place, would that result in a more allocation of housing going from property speculators into the hands of owner-occupiers? Might start with the ACTU on those.
Thanks, Senator Kim. So the ACTU absolutely supports the intent of the bill, which is to get more people into their first homes. You know, the fundamental inequity of the current system is that it provides a greater help to property investors buying their third, fourth and fifth home than it does to a first home buyer trying to get out of the rental market. And by relieving property investor demand, by taking away the tax incentives that have lit a fire under house prices for the last couple of decades, it will help more people get into their homes. In terms of negative gearing, grandfathering, we acknowledge that not everyone negatively gears for the entire length of the property. It's not something that happens permanently, and there will be a washing through of the system of those negatively geared properties, and acknowledge that if a person does want to negatively gear, they've got to contribute to supply by buying a new home. Those are pretty sensible, measured approaches that the government has taken here.
All right, thank you. ACOS, any reflections on those?
So to your first question, yes, we definitely support the shift of ownership from being investors to occupiers. The primary purpose of homes should be for living in, and they've been too much shifted towards an asset for wealth accumulation. On the grandfathering question, we proposed, and it's been our policy position for some time, a 5-year transition rather than grandfathering of negative gearing, and we think that would have a greater impact on public revenue and accelerate the shift from investors to owners over the shorter to medium term. But these reforms are still really important steps in the right direction and will have substantial impact, particularly over time, as existing properties that are negatively geared move out of the system, which can take around 5 to 7 years. And so we know that investors, their average loans are about $100,000 greater than first-time buyers and have grown at 10% faster than first-time buyers' loans. So because of the tax breaks, they have a competitive advantage at auction, and that's why we've seen such a big fall in home ownership rates by 3 to 4% over a couple decades and 7% for younger age groups.
Thank you. And just finally, a quick one for the ACTU. How have the current arrangements, and in particular the current 50% capital gains tax discount, impacted the ability of working people to afford housing near where they work? And do you think that the changes might improve the capacity of working people to be able to afford to live closer to the places that they work?
It's been devastating to so many people, that increasing amount of the time spent stuck in traffic or stuck in transport between their home and their work. It is a massive cost to those working people to spend hours commuting to and from work each day, with some workers completely locked out of their communities. You have, teachers who can't afford houses in regional areas or can't even find accommodation in regional areas. You've got cleaners who can't find any houses or accommodation in the northern beaches, or retail workers who have to commute for more than an hour just to get to their shift in Sydney. All of these are huge issues. And if we do the right thing, and that is take away the tax incentive for property investors to get all the up at auctions, then those workers will be in with a shot of being able to live near where they work. It's not going to be everything, and we know that there is going to need to be an increase in the supply of affordable and social housing, an increase in construction of that as well. But by at least taking away the accelerant that is poured on top of this fire, you will give workers a fighting chance.
Thank you. I'm going to Senator Pocock now, who's on the phone.
Thank you, Chair, and thank you for your time. I know we're pressed for time, so I might just go one question to each witness. So firstly, for ACOS, I'm keen to ask about your position on the WATO, which differs to most other submitters. My concern with the WATO is that it's not targeted, and it comes in context where the government has failed to increase supports for people on safety net payments during the Middle East crisis. You're arguing that people on job-seeking youth allowance need direct increases. Is that correct? That's where you'd like to see revenue generated go towards?
Among other things, yes, Senator. And as we've pointed out, 1 in 3 adults don't have sufficient income to pay personal income tax, and therefore to benefit from further income tax cuts. And for context, this isn't about a blanket objection to income tax cuts, but under the present government, there has been one of them announced in practically every year since the Albanese government was formed. Mm-hmm. And we just can't keep going down that path, given the state of the budget, which, as is well known, is under strain, under pressure from the growing cost of the essential services and supports that people need. Those budget pressures won't go away. But yes, we would submit that the folk who are under the greatest pressure at the present time through higher costs of living and stagnation in incomes, the folk on the very lowest incomes. Youth allowance is $423 a week, I think. Job seeker payment, $409 a week. People on that level of income are just living hand to mouth from fortnight to fortnight. They won't benefit at all from the WATO.
Mm-hmm. And my reading of EAC's last report is that a gradual increase in safety net base payments over 4 years would cost basically the same as the WATO. Is that correct?
That sounds about right. Happy to take that on notice. But the cost is relatively modest because you're targeting the people who have the least. Our income support system, especially working age payments, are very tightly targeted. And as the OECD, the IMF and others have argued consistently, at a time of cost of living pressures and higher inflation, governments should target support to those with the least, those under the most pressure.
Great, thank you very much. Just finally to the ACTU, given we're talking about the need to raise more revenue, does the ACTU still support a 25% gas export tax? Yes, we do. Great, thank you very much. Thank you, Chair.
Thank you.
Thanks so much.
Thank you. Senator Little had just a couple of follow-ups.
Yes, thank you. This is for ACOS. Dr Davidson, I want to talk about people who are on low incomes, even if that's temporary, not people who are on some form of income support payment. These might be people who have determined that they want to go part-time, they want to care for children, they want to take a career break, they might be sick, studying, all sorts of reasons, including those people who are retired. Is there a reason why they shouldn't be, or they should be hit with the 30% tax break? They're still low income earners, even if it's only temporary.
Yes, the people who may be affected by the 30% minimum tax rate are, by and large, they may have a low taxable income. That doesn't mean they don't have a capacity to pay income tax. I mean, for a start, if you have just received a capital gain, you're on the face of it in a position to pay tax. You've just received $10,000, $20,000, $30,000 or whatever in gains from the sale of an asset. So they're in a very different position to the people I was just talking about, the folk on job seeker or youth allowance who have on average less than $200 in the bank. Once you exclude people who receive $1 in some form of income support in a given year, we don't think there'd be many people who are going to struggle to pay that 30%. Not many people who only have, for example, a part-time wage are collecting substantial capital gains from investments. Not many of them, people of working age. More people with low taxable incomes post-retirement have substantial capital gains, but that's in part because superannuation is untaxed. And I think the intent of the minimum 30% tax, which we support, is to prevent a situation where people can gather substantial capital gains on substantial investments over their working life and then wait until they retire and their marginal tax rate is close to zero, and then realise, then sell. And that's a legitimate integrity concern. We fully understand why the government has taken that path.
Thank you. Thank you very much to both witnesses. That concludes our questions for you both. So the committee will now suspend for a lunch break and we will return at 2 p.m. I now welcome representatives from the Tech Council of Australia, the Australian Investment Council and Oz Biotech Limited. I understand that the information on parliamentary privilege and protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full names and the capacity in which you appear today? And we will start from my left. So we've got a couple of people on teleconference. Mr. Brash.
Yes, Sebastian Brash, Senior Policy Manager at the Tech Council of Australia.
Thank you. Ms. Cornick?
Yes, Kate Cornick, CEO of the Tech Council of Australia.
Thank you.
Natalie Prasad, CEO of the Australian Investment Council.
Jenny Wheatley, Director of the Australian Investment Council. Rebecca Cassidy, CEO of Oz Biotech.
Vanessa Waddell, Chief Strategy Officer of Polyactiva.
And Chris Nave, Managing Director of Branding Capital.
Thank you very much. I will invite you to make a short opening statement, and at the conclusion of any remarks, I'll invite members of the committee to ask questions. And perhaps we'll go to the Tech Council of Australia first, whoever wants to go there.
Thank you very much, Chair, and to the committee for the opportunity to be here today. The Tech Council of Australia represents startups and scale-ups in almost every sector of our economy, including health, education, energy, agriculture, cybersecurity and beyond. As a sector, tech is now the second largest in Australia, contributing nearly $250 billion to GDP and employing nearly 1 million people. I'm 5 weeks in my role as CEO of the TCA, having previously led the Victorian Government Startup Agency. Over the last decade, the number of tech startups in Victoria increased fourfold. Their valuation grew 20 times, from 7 billion to 139 billion, and they created nearly 67,000 new jobs. There are few industries that can claim this growth, but realising it isn't easy. Having helped thousands of Australians, working Australians, with entrepreneurial ambitions, I've seen the risks. Risks taken by founders who leave stable employment to build a company. Risks taken by investors who back them early before they know they're profitable. Risks taken by employees who forfeit secure income for equity, hoping a future exit will reward their work and help them create a better future. In Victoria, our data showed that only 1 in 4 founders actually managed to raise capital in the first place to get their startup idea off the ground. When they do get investment, global data shows that 70% will fail, 25% will return the investment to the investors, and only 5% will actually create a return on investment. Productive risk-taking must be rewarded. We acknowledge what the government wants to achieve with its broader tax reform package, including housing affordability and a fairer tax system. But the proposed CGT reforms will see early-stage startup equity taxed more heavily than the passive assets the reforms are meant to target. We support broader concessional capital gains treatments that incentivises the creation and scaling of truly innovative high-growth businesses. The concession should be set when the equity is acquired and run for the life of the investment, providing certainty that when productive risk is taken, that it will be rewarded. This is consistent with peer innovation economies. Without a technical adjustment for startups, Australia risks becoming an outlier. While most founders may not begin their startup journey with the government's tax settings front of mind, if no change is made, they'll quickly learn the hard way that talent and capital are mobile. If you cut the after-tax rewards for founders, employees and investors, the negative impact quickly compounds. Investors back away. Fewer founders will get the capital they need to grow, or they move overseas to more attractive innovation ecosystems. They will find it harder to attract skilled employees from safe jobs in stable firms. That's a poor outcome for budding entrepreneurs, but it's a poorer outcome for Australia, for our productivity, for jobs, and for our ability to build new industries that will assure the success of our economy for future generations. Australia has challenges: flatlining productivity, declining R&D spend, stagnating per capita growth. At the same time, we're preparing to undergo significant transformation through energy transition and the impacts of new technologies like AI. Our ability to mitigate and, importantly, capture the opportunities will depend on our ability to foster new, high-growth, innovative businesses that can develop scalable products and services with global appeal from here, Australia. Let's not give them a reason to forfeit before they're even out of the starting gate. Thank you.
Thank you very much.
Thank you, Chair. Thank you for the opportunity to contribute to the committee's work. It's good to appear alongside the Tech Council and our AusBiotech colleagues whose work is complementary to ours. The Australian Investment Council is the peak body for private capital investors, venture capital and private equity funds, superannuation and pension funds and other institutional investors. Collectively, the Council's members support 700,000 jobs, back 2,200 companies, mostly SMEs, and add $120 billion to the economy each year. These are the people and organisations that allocate capital and invest it into startups and unlisted high-growth companies. Companies that are supporting national priorities, rebuilding resilience, underpinning a more dynamic and competitive economy, and ensuring that we keep making things in Australia. Companies such as Sustainable Packager Biopack, phone mounting manufacturer Quadlock, and total artificial heart developer Bivacor. Investors in companies like these do more than write a cheque. They put financial and human capital to work to build founder and team capability, develop product and expand into new markets. These investments deliver competition and choice in our economy. We agree that tax settings are a lever for government to increase the supply and affordability of housing, and there's been an extensive national discussion on this topic. At the same time, Australia's economy is not growing at the rate needed to sustain living standards. Just 6 months ago, the Productivity Commission stated the most important driver of productivity is new ideas, and investment, both public and private, fuels innovation and growth. Productive risk sits at the heart of these two statements. It is the third type of earnings, alongside personal exertion and owning assets, and it was somewhat overlooked in the framing of the CGT changes. Productive risk requires ideas, talent and capital, 3 legs of the one stool. If any one of these legs are broken, the stool falls over. There are 2 issues that put this dirty stool at risk. First is a zero or low cost base, which is an issue for both technology and non-technology businesses. Indexation is of no benefit. If you index a zero cost base, you end up with zero, resulting in a far more punitive outcome than for other taxpayers. Second is Australia's competitiveness relative to peer countries. Under the changes, CGT rates will be between 30 and 47%. 47% is about twice that of the US and the UK. Relativities matter. As a middle power economy, Australia does not set the global market, yet we compete against G7 economies for capital and talent. The impact on these weaknesses and the role of tax settings should not be underestimated in a world where capital and ideas are mobile and talent has choices. Canada recognised this last year when it cancelled CGT increases in, and I quote Prime Minister Carney, recognition of the vital role that builders and small business play in shaping Canada's future. In Australia, the CGT discount has underpinned venture and growth capital policies which have been supported by the Parliament over the past 2 decades. For example, the Venture Capital Limited Partnership Program and its early stage version have, since inception, channelled more than $36 billion of investment, backed more than 3,000 companies and galvanised more than 16,000 investors. It is an example of the tax system as a driver of desired behaviour that is a feature of tax systems all around the world, not a distortion. In this case, the desired behaviour is taking productive risk that grows the economy, strengthens it and keeps our best assets on shore. Thank you, Chair. We're here to answer the committee's questions.
Thank you. Ms Cassidy, I see we've got your statement as well circulated, so we can incorporate that.
Of course. Thank you. So, Chair, Deputy Chair and Senators, thank you for the opportunity to appear today. Life sciences, including biotechnology, medical technology and health tech, contributes to the health of Australians, our economy and our sovereign resilience. Life sciences already employs around 350,000 people in Australia. It is valued at more than $250 billion and has cumulatively been Australia's largest value-add export industry outside primary industries since 2016. The proposed changes to capital gains tax and their intersection with proposed changes to the research and development tax incentive will drive these numbers and this contribution down. The process to deliver new health technologies to patients is rigorous by necessity and well known to take more than a decade. Cochlear, for example, took more than 15 years. Along the way, founders face extraordinary scientific and clinical risk. For those who do succeed, most remain pre-revenue for well beyond a decade, while continuing to invest heavily in local Australian R&D. The current CGT framework rewards risk in this non-revenue environment where capital is locked up for many years and success is far from guaranteed. The proposed changes would weaken that incentive at precisely the point when Australia needs more people willing to start, fund and scale innovative life sciences companies right here. They specifically risk weakening employee equity arrangements, which are the only way that some Australian life sciences companies can compete on salaries with their peers overseas. The CGT changes, combined with proposed changes to the research and development tax incentive, create a double threat and a policy environment that supports the science in Australia, but not necessarily the commercialisation of that science and the jobs that comes with that activity. Together, these new tax pressures would deeply impact both sides of the life sciences equation: the capital needed to start and scale companies and the cash flow needed to keep them here. Our members are already telling us that they are reconsidering where future investment, clinical trials, manufacturing activities, intellectual property and headquarters will be located. Today, I am joined by Chris Nave, the founding partner and managing director of Brandon Capital, one of Australia's leading life sciences venture capital investors, and Vanessa Waddell, Chief Strategy Officer at Polyactiva, a Victorian-based biotechnology company developing world-leading therapies for eye conditions. We are grateful for your time today and welcome any questions you may have for us.
Thank you very much. We'll go to Senator Chandler first.
Thank you, Chair. All of my questions today can be answered by each of you, so I'll try and keep them as pointed as possible. When did you each first hear about these tax changes from the government? We might go to the Tech Council first, given they're online.
Thank you very much. So I actually started my role the week directly prior to budget, and the very first meeting that I had was within the Tech Council on this issue, and we certainly brought it to attention of government prior to the budget.
Thank you. AIC?
Yeah, thank you, Senator. We became aware of possibility of the changes being more broad-based through media coverage and media, and we raised issues related to our sector with government upon receipt.
Prior to the budget?
That was prior to the budget,
Prior
yes.
to the budget. Biotech?
We became aware of the changes and the impacts on our sector on budget night.
Yep.
Yes.
That's okay. I thought that would be the case
Yes.
with you. Thank you. Perhaps then to the Tech Council and AIC, what consultation was undertaken with you before the budget announcement, or did you have to proactively raise your concerns with government? Oh, sorry, Tech Council first.
We had written to the government, so we did write a letter to government before the budget.
We provide, upon hearing or sort of reading about media coverage, we provided information to the government prior to the budget.
And was there any response to your letter from the Tech Council or the information that the AIC provided to the government before the budget was handed down? The Tech Council first.
Before the budget was handed down, we did not enter into a consultation with government. We met after the budget.
And AIC?
Yeah, we didn't enter into a consultation with government until after the budget.
Okay. Treasury has said that the CGT discount overly benefited higher risk, higher return businesses. I think particularly the AIC might be best placed to answer this one. Does that align with your understanding of the investment landscape in Australia?
Sorry, Senator, do you mind repeating the question?
Of
I was
course.
scribbling notes at the same time.
That's okay. So Treasury have said that the CGT discount, as it previously existed, overly benefited higher risk, higher return businesses. Does that align with your understanding of the investment landscape in Australia?
I probably wouldn't think about it in a relative sense in that way. If I look at what the CGT discount has done, particularly for the venture and high growth sector in Australia, and certainly over the last 20 years, the entire policy architecture for venture and growth investment has been predicated on the CGT discount. And as a result of that, and as I had mentioned in the opening statement, it has driven we started in the early 2000s, post .com crash. We pretty much had no venture capital sector in Australia at that time, and through policy settings that have been supported by Parliament over the last 20 years, we now have a sector in which, at least through the venture capital and the early stage venture capital limited partnerships, have channeled $36 billion of capital into the venture and growth sectors. I would argue that if we didn't have that policy support, we wouldn't have companies like Canva or Employment Hero with us today.
Oz Biotech might be well placed to answer this next question. If the government is serious about productivity and innovation, should it be increasing the tax burden on successful risk-taking?
Well, from the perspective of biotech, which is an inherently high-risk, high-reward sector, I would say that we exist in a highly competitive global environment where we have countries globally and many of our peer nations actively competing to retain and attract life sciences capability and the investment that comes with that, the highly skilled job creation that comes with that as well. It is important that Australia creates a holistic policy and taxation environment that supports more of Australia's growing biotech, medtech and health tech companies, and we do have more of them in Australia now, more of those companies being able to stay onshore. Absolutely. Chris?
And Senator, if I may, as the largest life science investor in the country, to talk about it over-benefiting innovation investors, I think is actually the wrong way to look at it. So the risk of failure is so high in the technology sectors, including biotech, that when I think about an investment, I don't think about my maximum return. The reality is for every 10 investments I make, 5 of them will go to zero. I'll get no return. And if I'm lucky, 2 or 3 of them, I might get my money back. And so I need that one investment or maybe 2 investments that generates return to generate a higher return to make the overall scheme works. Whereas property, for instance, even in a property downturn, I've still got something to sell. What CGT has done is it's actually attracted capital to these innovation sectors. Without that reward, when you actually do get a winner, my real concern is we'll see a fleet of money running away from these high-risk sectors when you compound the risk and also the timelines that it takes to generate a return.
I might ask this one to the Tech Council, although I note, Mrs. Cassidy, you foreshadowed this. How does Australia stack up compared with our international peers as an attractive place for high-tech investment?
I think over the past decade, as Navleen referred to, there's been legislative changes and development in the architecture in Australia that's really encouraged a flourishing venture capital system. And right now we are certainly holding our own, and we've seen the ecosystem develop quite substantially over the past decade. But we do have concerns that if the CDT changes go ahead as proposed, that we would be an outlier, and Australia would certainly look very different compared to peer economies that we would consider the US, the UK, Singapore, etc.
Ms. Cassidy, did you want to add something?
Just, Senator, for life sciences, I think what we are seeing globally is that a number of our peer nations, as I said before, are actively seeking greater life sciences capability in their markets. And many of those markets are actively using tax incentives, grant funding, patent boxes, procurement preferences for technology, as well as investor incentives to attract life sciences companies. So the UK has its patent box regime that taxes qualifying R&D income at 10%. Singapore offers a range of targeted R&D incentives, accelerated capital allowances and highly competitive personal tax regime, of course. And the United States offers the federal R&D tax credits, state-level incentives and a deep pool of specialist venture capital as well. We would be happy to provide more information on some of those incentives to the committee after if required.
Are any of you aware of any modelling that Treasury or the government might have done regarding the impact of these changes on the competitiveness of your sectors?
We are not in life sciences aware of any modelling from Treasury on the impact of these changes on our sector.
Anything from Tech Council?
And for us, we're not.
No, didn't think so. Thank you very much, Chair. Have you done any modelling of the impact of these changes on your sectors?
We have done a small amount of modelling just on the impacts that we would expect to see, and our submission did include this data as well, on a few scenarios to illustrate the potential impacts. On the scenarios that we modelled, we saw an increased tax burden of 92% for founders, 107% for employees on employee share plans, and 77% for investors.
And look, we certainly know that from any company that has or anyone that has a zero or a low cost base, when you move from effectively what is a 23.5% tax rate based on the top marginal tax rate to 47%, that is going to be a more punitive impact than on any other taxpayer under those changes.
Yeah. Anything from the Tech Council on that?
We presented some data in our submission on the impact, and we've certainly done some very high-level modelling scenarios, but we have not done a comprehensive model.
Great. Just finally, would you support a further set of inquiries, and I'm happy to hear everyone's views on this, a further set of inquiries to land better tax settings to support investment in Australian tech companies before these changes that we're inquiring into today are passed?
We do believe that further consultation is absolutely required on these changes, Senator.
AOC?
I mean, the process is a matter for government, and we work with what we are given in terms of the process and the timeframes that are involved.
This has been a pretty quick timeframe, though, hasn't it?
Look, it has been a quick timeframe. I would say that having been in public policy for a long time, I've seen policy consultation processes that have gone 8 weeks, 6 weeks, 4 weeks, 2 weeks over the course of the last 20 odd years that I've been in public policy. So I would sort of provide that context around that answer.
Sorry, Mr. No.
As an industry participant who is not a member body, so perhaps I can speak more freely, to me it doesn't make sense. The unintended consequences of these changes are damaging emerging industries that are going to create the future jobs and income for the country. So I think more time to think about these impacts, I think, is essential.
The Tech Council?
We've been having positive conversations with government that have been positive. Government's sensitive to our issues, and as Nadine said, there is we're expecting the consultation paper to come forward from government, and we await that.
So, just quickly, when do you expect that consultation paper to come forward? To the
If that's to the Tech Council, yeah, we're waiting. We're following what's in the media. We understand the public statements that have been made, but we don't have any advice on exact timing for that. But we are certainly waiting for it.
So you haven't been given any indication from the government as to when that consultation paper will be delivered?
No, we have not.
Even though the Parliament will most likely deal with these legislative changes at some point in the next 2 weeks. Wow. I'll leave it there. Thank you. Senator McKim.
Thanks very much. Good afternoon, folks. Thanks for your time. Just firstly for AusBiotech, can you just talk the committee through how biotech and medtech and health tech companies differ from other startups, and not just in the context of the way capital gains are taxed, but also in terms of R&D tax settings?
Absolutely. Thank you for the question, Senator. There are a number of unique aspects of biotech, medtech and health tech companies. The first, of course, is the very long timeframes that are absolutely required by necessity to produce products that help and save lives. These products go through well over a decade of research, preclinical testing, clinical trials across multiple phases, regulatory approvals, market access approvals. The timelines are long, but they are long by necessity, which means that the vast majority of our companies remain pre-revenue for very long periods of time. A biotech company can invest $50 to $150 million in R&D over more than a decade before generating a single dollar in revenue, for instance. This is unlike other sectors in many ways. There is a case study in our submission in relation to Argenica Therapeutics, which illustrates clearly this is a company that was founded in 2019. It is conducting phase 2 clinical trials today, with first expected revenue in 2034, which is 15 years after incorporation. The investment risk for our sector is high and sustained, I think, as Chris has already spoken to. The probability of a therapy entering clinical trials and then eventually reaching market is 7%. 7%, yes. It does vary across disease and technology types, of course, but on average, investors and founders are usually are regularly scientists, medical scientists. So they accept that risk specifically because they believe in the products that they are creating in many instances, of course, but also understanding that when products do come to market, there is also high reward. The potential capital requirements for biotech also come very late. So when we talk about biotechs undertaking research and development activities after 10 years. We're actually talking about their most intensive phases of R&D. So this is when companies are undertaking late phase clinical trials, stage 2B, stage 3 clinical trials. They are large scale, they require clinical manufacturing. I think, as Chris has said multiple times in other forums as well, this is the period when these companies are working out where they're laying down their clinical manufacturing as well. So there is, in the later stages of development, high intensity R&D, which also has high job creation and high productivity. It does mean that the government has for a very long time recognised the difference of our sector. The 2025 National Health and Medical Strategy Issues paper pointed to average 17-year timelines. The Medical Science Co-Investment Plan from 2024 talked about a decades-long process. So the uniqueness of our sector is well understood by government. The double impact of the CGT changes and the RDTI changes, including the proposal to include a new 10-year limit on the refundable R&D aspect, RDTI, is particularly problematic for our sector, given those long timeframes by necessity.
All right, thank you. That's really helpful. I just offer the Australian Investment Council and the Tech Council the opportunity to respond to that question, if you wish.
Senator, I think there's probably a couple of things. One is, and I think I echo Rebecca's comments that the issues, and there are some particular issues for biotech, particularly around the length and the duration of development. I do think it's also really important to focus on, we've talked a lot about the zero cost base issue for tech companies in particular. It is not just a tech company issue, and a great example of that is companies that are in distress. That also have zero or low cost bases, and a really great example of that is Toll Global Express, which was a logistics business owned by Japan Post. It was in distress. Under its previous ownership, there was no way to structure that company out or return it to some form of profitability. It was acquired by a strategic investor, and as a result of that, it saved 8,500 jobs around the country, is trialling hydrogen trucks. But, I go back to what I said in my opening statement, Senator, is that this is not just, whether it's in biotech or in tech or in software or in some of these businesses, this is not just putting cash into a business. It is actually providing a human capital support as well, so whether that's strategic support and the like.
Yeah, thank you. I will come to the issue of companies with zero or low cost base shortly, but I just wanted to see if the Tech Council wanted to respond specifically in regards to biotech and health tech.
Thank you. And we completely agree with the comments from Oz Biotech and that Rebecca made. We would also add that there are other areas of deep tech that have exactly the same challenges, where there's deep technologies, extended time frames, need to develop and manufacture product. We certainly see that in the quantum space, for example, and we see it across almost every sector of the economy, including in climate tech. We spoke to Climate Salad only last week about some of the challenges they have about very extended time frames for some of their deep technologies. I'd also share concerns around the research development tax incentive, and we have consulted with our members and shared similar concerns, particularly around the 10-year timeframe that's being applied to the refundable offset, as well as the proposed removal of supporting R&D activities. Thank you.
All right, thank you. That's helpful. The issues around the proposed indexation adjustment on companies with zero cost base or low cost base have been fairly well ventilated in the public debate, and I think they're reasonably well understood to this committee, including by virtue of the submissions that have been made. What actual proposals would you put to this committee that would mitigate or avoid some of those issues but still result in a fair tax treatment or an equitable tax treatment for capital gains? Yeah, happy.
Senator, I think that there is we do have an existing, policy framework and architecture that has been phenomenally successful in growing startup, scale-up and growth businesses in this country. is by no means perfect, of course. No set of policies is perfect, but the track record would suggest that it's been highly effective in terms of not only just backing companies or start-up and scale-up companies, but also in terms of bringing capital into this sector. The competition for capital is pretty fierce out there, and it's not just a geographic competition. It's also an asset class competition as well. So if we are, as a country, if we're wanting to see companies start here, build here and stay here, we do need to see capital coming into this particular part of the sector. And I cited the Venture Capital Limited Partnership and the early stage version of that as being really good examples of successful policies that have had long-term support by government. The employee share scheme rules are another excellent case in point. I think, as Rebecca mentioned in her opening statement, in some cases it is the only way in which start-up or small companies can actually compete with the larger companies for high-quality talent. It's another good example of some of the existing policy architecture that's been very effective.
Right, thank you. Biotech.
Senator, I would just say that with regards to specific definitions and solutions, it's clearly very complex. We have, with our members, been thinking about different characteristics of the innovation sector and life sciences that set it apart a little. We have had conversations around existing definitions as well, including the R&D tax incentive eligibility criteria, R&D intensity criteria, as well as innovation tests. But our view is very much that these need to be worked through the correct modelling with Treasury to avoid unintended consequences.
All right, thank you. Tech Council.
Thank you. We agree with what's been said. I think the biggest challenge is actually identifying who the target audience is. And for us, as I said in my opening remarks, we're focused on innovative, high-growth startups as a category. There is certainly international examples that we can look to, but we don't want to preempt the government's process, and we are waiting for the consultation paper, as I said earlier.
Okay. All right. Thanks, Chair.
Thank you. Senator Pocock. Are you still there, Senator Pocock?
Thank you, Chair, and thank you for your time this afternoon. I was just wondering if any of you have had input into the paper that the Treasury is reporting on the release this week about a workaround for tech and biotech startups.
I can go on behalf of the Tech Council. We have certainly met with government, but we have not had direct input into that paper, nor have we cited it.
Senator, could you please repeat your question? You weren't quite clear.
Sorry, apologies for that. I said we have had conversations with government.
No, the Senator, Kate, sorry, we couldn't. Senator Pocock, we didn't quite hear his question in full in the room.
All right, sorry. I was saying, have you had input into the paper that the Treasurer is going to release this week about a workaround for tech and biotech startups and small businesses with low or zero cost base?
We have been continuing a range of conversations with government over the past few weeks. With regards to any particular input into the paper, I could not. We're not aware of that. Yeah, I'm not aware of that.
And Senator, from the Australian Investment Council, like my colleagues that have already provided answers, we've been engaged in conversations with government about the issues and the impacts, but not aware of to what extent any of that feedback will be in any policy paper.
Yeah.
Okay. Thank you. And then just as part of that, has anyone been asked to sign NDAs as part of consultation?
No.
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 Okay, great. That's good to hear. And for the Tech Council, what percentage of your members are smaller scale startups and what percentage are bigger, more established tech companies?
I'm afraid I will have to take that on notice because I've only been in the role for 5 weeks. I'm not deeply familiar with the membership base yet, but we do have representation across the board, and we've certainly hosted roundtables with different segments, including our smallest of startups as well as scale-ups. So we have a representation, but we will certainly get you the precise breakdown.
Thank you. And in terms of startups, why do you believe that the early stage innovation company can't provide a framework for protecting investment in those businesses?
So the early stage investment company regime we certainly see is a very useful mechanism. It's been in place. We don't feel it's broad enough, and we've certainly spoken to a number of companies as well as venture capital funds that are not using it. Some of the key issues that we have identified is that in Australia, about 70% of first-time investments happen through a safe note, and that's an agreement for future equity. And those particular agreements are not allowed to be counted as part of the ESIC regime. So 70% of investments that are taking place in the environment that ESIC is targeting don't count. There's also a requirement to achieve certain milestones within the time frame. So in order to be eligible for ESIC, you have to be under 3 years old and have spent under $1 million. There are plenty of companies, including in the biotech industries, where those companies either they overspend on the $1 million target, or they're over 3 years old before they seek their first investment. So the scheme is a useful scheme, but it is by no means exemplary of the entire early stage ecosystem. So while we see that it is a useful marker, it is too narrow, and it certainly wouldn't satisfy us in its own right as an individual marker of an innovative company.
And is that expansion of ESIC, the Early Stage Innovation Company framework, something that you've put to government?
We have not directly put that to government through the Tech Council. We did, with another hat, I was a member of the strategic examination of R&D. We produced our Ambitious Australia report last year, and within that we did encourage an expansion of the IC regime. But we certainly recognise that an expansion of that regime could be a good thing, but whether that would go broad enough would be a question that we would continue to have. And we certainly see that there are a lot of companies that do not qualify for that regime, that we would need to see it quite significantly expanded before we would be satisfied that it would provide a sufficient carve-out for innovative high-growth companies.
And on the third review, Robin Denham took a slightly different view recently, saying that Australian startup founders need to stop whinging about government policies and focus on building globally competitive companies for the artificial intelligence era. What do you make of that?
Well, I do agree with Robin that while most founders don't start their startup journey thinking about government's tax settings, the reality is they do make a difference to early stage founders, and I think it's certainly something that I know Robin and I share and discuss through the third committee at great length, the importance of having a really vibrant early stage ecosystem, including making sure that we've got supportive environment to support investment, so that investors are choosing to back Australian companies, so founders get the capital they need to grow, so that they can go and hire the employees that they need to scale, so that we create success. That success will then end up flowing back into the ecosystem, and therefore we set off a flywheel, and that was set out very clearly in the third review.
Mm-hmm. Thank you. And just finally, given the Treasurer flagged that there were potential changes for startups for tech and biotech, is it a concern that it doesn't sound like you feel like you've had direct input into whatever workaround is potentially going to be announced?
From our perspective, we feel like we've had a very positive consultation with government. We have not seen the final outcomes of what's in the consultation paper, and we wait for that, but we certainly hope to see that the information we've been sharing is encapsulated. And as I say, we wait to see that paper before we can comment on that.
Do you know when that is?
I'm afraid we don't.
Okay. Thank you, Chair. Thank you very much for your time.
Thank you. Mr. Nave, I think, has wanted to add something else.
If I could, Senator, I just want to make, I guess, 2 points. The first around ESIC. I've been investing in biotech companies for over 20 years in Australia, and we have not been able to utilise ESIC in any occasion. And I've invested in over 68 Australian companies during that time. It's not fit for purpose for biotech, one, because of the capital caps, but also the short time frame to remain eligible. So I just want to make the point that it is not fit for biotech. The other point I wanted to address is the concept that founders are complaining about tax changes. I would suggest that it's not founders complaining tax changes, it's founders really concerned that this will see a flood of capital leave the sector. And the only thing that enables founders to develop their technologies is access to capital. And so maintaining incentives for capital to stay in the innovation sectors is essential for them to continue to grow.
Thank you.
Well said. Thank you very much.
Thank you. I've just got one question. I think the Tech Council, you alluded to this in an earlier answer to Senator McKim in talking about some of the approaches from overseas. I think it was with regards to investors with a low or zero cost base. I just wondered if you could, noting I think what you said in terms of the consultation paper coming, etc., could you just talk a bit about what those approaches are that we could potentially consider or learn from?
Yes, absolutely. There's different schemes, and I note that my colleagues have also touched on this in their applications as well.
Yeah.
We've certainly looked at the United States. They've got a qualified small business stock scheme, which exempts up to 100% capital gains. In Singapore, there's actually no CGT regime, same in New Zealand. In Canada, they have got a lifetime capital gains exemption on qualifying small business shares, and that sees an effective tax rate of between 24 and 27%. And in the UK, the business asset disposal relief provides 18% for founders and qualifying shareholders. So there are certainly schemes that we can look to overseas that drive competition, and I think it was Rebecca at AusBiotech noted that the competitive landscape and that many countries are really working hard to build industries in life sciences, but also more broadly in quantum, in AI, robotics and other areas. So we are working in a globally competitive landscape, and it is very important that Australia is seen as being highly competitive and is able to attract, retain and grow businesses that are going to lead to a future prosperity for all Australians.
And Chair, if I may add to that, the programs that Kate is talking about, and agree that they have been very effective in their respective jurisdictions, operate alongside headline tax CGT rates that are actually, are competitive, far more competitive than what we would be moving to in Australia. So as I said, in the US, the headline CGT rate is 23.8%. In the UK, it's either 18 or 24%. And so you do need to sort of look at these two things together.
Yeah, we've heard some commentary about that throughout the last day and a half. But thank you. That was all from me, and I overlooked you also tabled your statement earlier as well, so we will incorporate that into the
Thank you, Chair.
Hansard. So I think we have concluded with this panel. So thank you very much for your time in coming today. We appreciate it. And we'll just suspend for a short moment while we invite our next group to the table. Thank you. I now welcome Mr. David Turner and representatives from Think Forward and Eucalyptus. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full names and the capacity in which you appear? And I'll start on my left. We do have Mr. Thomas Walker on the phone. Do you want to go first, Mr. Walker?
Yes. Good afternoon. My name is Thomas Walker. I'm an economist and the CEO of Think Forward.
Thank you.
Good afternoon. My name is David Turner. I'm a lawyer who advises startups and small businesses and a small business owner. I appear in a personal capacity.
Thank you.
My name's Tim Doyle. I'm the CEO and one of the co-founders of Eucalyptus, and I'm appearing in a personal capacity.
My name's Jay Lubrink. I'm growth manager at Eucalyptus and appearing in a personal capacity.
Thank you very much. I now invite you to make a short opening statement, and at the conclusion of any remarks, I will invite members of the committee to ask questions. And I think we do have opening statements circulating for, I'm not sure which.
Mr. Walker and Mr. Turner.
Okay, so we'll incorporate those into as well. So who'd like to go first? Maybe Mr. Walker, given you're on the phone. Is he making the statement or?
Yeah. Separate.
No, that's right. Sorry.
Yeah, I can go.
Yep, please.
Thank you, Chair. Think Forward supports the bills before us today. Think Forward is a non-partisan organisation run by younger people, founded in response to a growing awareness that younger Australians face a growing fiscal burden and rising intergenerational wealth inequality, and a frustration that little has been done about it. We support the bills as it improves the long-term structure of our tax system and advances intergenerational equity, which we define as the sharing of wealth, public investment and opportunity across generations. More specifically, the bill over the long term raises much needed revenue by winding back overly generous and expensive tax expenditures, and there's money freed up for essential public goods and services. Secondly, the bill changes the tax mix from work to wealth and reduces the income tax burden pressure on younger generations. This is critical as younger generations hold a much smaller share of Australia's wealth and predominantly rely on work, not investing to get ahead. Younger workers trying to set up their lives unjustly face higher effective tax rates than people much wealthier than they are. Thirdly, it's an important step in preventing wealth inequality from worsening and stopping this ratcheting effect where the already wealthy can continue to buy up more assets, subsidised by taxpayers, pushing up prices, housing in particular, and locking out the people who follow. Importantly, we believe the bill is a step toward a system that supports the long-term aspirations of most younger Australians, because we believe the best way to support the next generation of great Australian workers, carers, entrepreneurs and businesses is to reward work and effort and invest in Australia's people, not give blanket tax breaks that overwhelmingly benefit the already wealthy. There are specific issues we have arising from the rules in the bill, notably the generosity of the grandfathering arrangements that we would encourage the Senate to look at. Ultimately, we believe the debate about this bill, though, should reflect the kind of society we want to be rather than it descending into a discussion of short-term winners and losers. For our long-term national prosperity, we have to reward productive contributions and provide genuine equality of opportunity, not the ongoing privilege of inherited advantage, passive asset ownership. We believe the Senate must pass the bill to protect Australia's egalitarian values and the ideas of a fair go. Otherwise, we risk irreversible damage to the social contract and continuing cohesion as inequality continues to grow. The less fortunate continue to subsidise wealth accumulation and less money is available for public investment in the things we actually need to build a good life. Thank you for the opportunity to appear today, and I'm very happy to take questions on our submission.
Thank you. Mr. Turner.
I thank the committee for the opportunity to give evidence today. I'm a lawyer and small business owner. I advise Australian startups and small businesses at each stage of their life cycle, from setup and structuring to equity and debt capital raising, and perhaps later, even an exit in the form of an acquisition. Some have said that the proposed capital gains tax reforms are an assault on aspiration that will have a deleterious effect on the motivation of Australians to start high-growth businesses. Those claims are inconsistent with my own observations as an advisor, a business owner and founder in the startup ecosystem. My observation is that ambitious people are motivated to take on the risks of entrepreneurship because they are inspired to tackle a problem they care about deeply, or to seize a big opportunity to which they are uniquely well suited. My observation is that a concessional rate of capital gains tax payable on exit at some uncertain time in the future, if it ever even happens at all, is not a first-order concern that would meaningfully affect the behaviour of most founders. But that some founders may be discouraged from starting a business if they believe that they lack the resources to survive its difficult early years, which is why I commend measures such as the proposed loss refundability scheme, the loss carryback scheme, the R&D tax incentive and the permanent instant asset write-off, each of which offer upfront cash flow support to startups and small businesses. I humbly say that those personal observations of mine are consistent with empirical evidence.
A 2025 OECD working paper, which reviewed the data and literature on the taxation of capital gains globally, found limited evidence that tax breaks materially affect the rate of entrepreneurship entry at all, and that other tax system features such as upfront supports for new ventures may be more effective incentives than relief that only materialises when a business is sold. So far as investors are concerned, as you all have heard many times over the last 2 days, an important principle of an efficient tax system is the principle of tax neutrality, that our tax laws should not pick winners and losers, and investors should be encouraged to allocate capital according to the rate of return, not the rate of taxation, so that capital is allocated to the most productive investments. Departures from that principle should be rare and carefully considered. The CGT discount overcompensates some asset classes for inflation and undercompensates others, and it more generally prefers capital income over labour income, which has produced distortions in our tax system. The proposed cost-based indexation approach ensures that tax is paid only on real, inflation-adjusted gains and more consistently taxes income from all sources. Consistent with the goal of producing a neutral tax system that taxes only real inflation-adjusted gains on capital assets, I look forward to discussing complementary measures for founders and employees of startups and small businesses, whose cost base may be close to zero and for whom cost-based indexation therefore does little to ensure that tax is paid only on real gains. I look forward to assisting the committee with inquiries on those matters. Thank you.
Thank you. Mr. Doyle?
Thank you for the opportunity to present today. So my name's Tim. I started Eucalyptus 7 years ago in 2019. Over the last 7 years, we've grown it to be, I think, the largest digital health startup in Australia. We recently sold the business for US $1.15 billion to a US competitor.
Is that billion or million?
Billion. And I think the notable part of that is it was also one of the largest payouts ever from an employee share scheme. So hundreds of millions of dollars flowed back to early stage staff members in the business, and indeed every single one of our Australian staff members who stayed more than a year benefited from that scheme. And so I'm here to make a relatively simple and relatively narrow kind of proposal, and that is that genuine employee equity in early stage companies should be exempt from the new CGT arrangements. My view, and perhaps this is unpopular in the startup founder class, is that the most important part of scaling a startup is actually early team. I think we aren't short on founders. As the previous speaker noted, founders tend to do things out of an irrational desire to change the world rather than to produce a tax outcome for themselves. And I certainly fell into that. I think I could have gone and taken a job, which probably would have done better in the short term, but was very motivated to build something in this country. And the thing that I was motivated to build was a place where young Australians could come, particularly out of professional services firms, take a bit of a risk and build something great that was internationally competitive. And I think the reality is we were able to build something that moved digital health in this country forward, move Australian business internationally forward, and kind of give a lot of young Australians a chance to succeed on an international stage. And so I think the best thing that we can do as part of these changes, or any carve out here, is to protect those employees, because quite often they come last in the stack of people that are cared about in startups, because you have investors protecting themselves through their share arrangements, and then you have founders protected through their board seats and things like that. And so I really do think it's important that we protect employees, because my view is that employees 10 to 50 are what actually matters to startup scale. It's an underrepresented part of the narrative because you don't often hear their voice, but I think it is extremely important, and it's a huge difference maker between us and Silicon Valley. In Silicon Valley, what you have is you have tons of been there, done that talent. In Australia, we have tons of high potential talent, but the reality is straight out of university, many of them go to law firms, many of them go to government, many of them go to consulting firms. And I think if we can create a situation where that talent is incentivized in whatever way possible to join innovative young companies and take risk, I think you have a couple of things. You first have the chance of greater returns for those people. You have the chance of these great innovative companies being built. And I think you don't really run any actual risk to the number of founders and the behavior of those founders. I actually think, to be honest, if I could have attracted more talent into my business earlier, I think we would have done substantially better than if it was easier to raise capital or a better tax situation for me. There was just no scenario where I was leaving Australia, but I think if I could have pulled more people out of McKinsey, more people out of Allen's, more people out of Mallison's, I think we would have been a better and faster growing business and ultimately delivered better returns for everyone involved. And so it's a relatively simple ask for me here. I want kids graduating out of university to be more keen to join Eucalyptus than they are to join McKinsey. And so anything we can do to make that happen, I think, will be a positive movement for us. Thank you.
Thank you. We will go to Senator
Thank
Little.
you. Yeah, just a couple of questions. Mr. Doyle, what you've said has been raised earlier in the day about the need to incentivise through shares, through that kind of offering. Can you elaborate a little bit more on, other than that, what is it that you can offer employees to actually retain them in companies, get them to explore new ideas, and perhaps even go off on their own and build another company?
For sure. So the things that our seed deck's publicly available online, so you can see that if you like. But I think what you can promise to young people coming out of university to join a startup is, firstly, you have to convince them to take less salary because you just have less capital than a grad job at a 3 of the big 4 accounting firms currently. But you can offer them the opportunity to rise quickly, to work in new fields. And so, for example, if you are, there is no senior AI talent in Australia at the moment. Everybody is learning on the go. And so you can offer a talented person the opportunity to rise quickly. And that opportunity is often the path to acceleration in their career. You can obviously then offer them the opportunity to work on hard problems at international scale. So we have a 130-person team in London, of which probably 50 are Australian. So there's this opportunity to succeed internationally, to build a brand for yourself, to accelerate your career, that I think is pretty compelling when you can get it right.
Okay, thank you. I've got a question for Mr. Turner, if you can just give me 2 seconds. I just want to ask you about your submission. It notes that some of the specific problems with applying the proposed new CGT rules in relation to founders and early employees who have invested sweat equity. Can you briefly run through that issue and what options you'd suggest for addressing it, and whether this is just another issue for a tech business, or are there others where it would apply more generally?
Certainly, thank you, Senator. My thoughts on this issue largely echo Mr. Doyle's. So the difficulty with founders, and indeed with early stage employees of startups, is that they often are substituting wage income for equity in a speculative endeavour. For founders, that's often all of their wages, and for employees, it's a substantial part. I've heard the argument, as I put in my submission to the committee, that well, since those founders and employees are earning that equity through labour, it ought to be taxed as labour income. I can see some force in that argument. The difficulty with it is that that income is substantially deferred. So that income is deferred until a liquidity event. That liquidity event may never happen at all. For founders, they're to a greater degree in control of their own destiny regarding that eventuality of that liquidity event. For employees, they're largely along for the ride. And so had they accepted a job at McKinsey at their full market salary, they might have had the opportunity to invest that excess wage income in an asset class which would benefit from cost-based indexation. On that intellectual basis, I support a measure to compensate employees and founders for, in effect, the lost cost-based indexation on wages foregone. Mm-hmm. My submission made 2 points about that. One was the eligibility for that sort of concession, and one was how it might be achieved. So far as eligibility, I think in an effort to reduce regulatory complexity, one of the existing definitions of a startup business ought to be used. Perhaps, given the focus of my submission and Mr. Doyle's, a useful one to examine is the definition of a startup business for the purposes of a concessional employee share scheme, which is already used to determine a concessional approach to capital gains tax for early stage employees. That requires a business to be under 15 years of age, to be below a certain rate of turnover, to be an Australian business, and for the interests to be ordinary shares or rights to receive ordinary shares in the future. So far as the actual mechanism for making that concession, I'm afraid, as I said in my submission, that's a difficult problem, and I don't have any easy answers. There are proposals for income averaging, but I think that could substantially overcompensate for inflation, given the size of the liquidity event that might occur at the end of that 5-year period. My submission proposed a mechanism by which early stage employees and founders could accrue foregone wages as an indexable cost base, but I think that is an extremely difficult, practically, task to achieve practically.
Okay, thank you.
Thank you. Senator McKim.
Thanks. Just a couple from me. Firstly, thanks to you all for your time and your submissions. They've raised a number of really interesting issues. Just firstly, Mr Walker, if I could, to you, your opening statement talks about the generosity of the grandfathering arrangements. Can I be clear? Are you suggesting they're too generous?
Yes, Senator McKim, I would argue that the amount of revenue that has been left on the table is far greater than we could have raised if we made the grandfathering less generous, and it locks in a level of advantage and wealth inequality based on someone's birth year and getting into investments at the right time, which is now denied to younger generations, which I think has caused some issues in terms of younger generations accepting the changes, because it looks like something's been taken away from them while older, wealthier people are protected.
Yeah, thank you. That's clear. Can I also ask you to reflect on this? Treasury's modelling suggests that about 75,000 homes will end up in the hands of owner-occupiers as opposed to property speculators as a result of the current proposal from government. Would you think that if the grandfathering arrangements were made less generous, that number would increase? In other words, that more than 75,000 homes would transfer from being owned by property speculators into the hands of owner-occupiers?
Well, I think there's a balance to be met between, not causing a rush in the market, which could have unintended consequences. But I think by allowing negative gearing to be continued on indefinitely, and a lot of properties will become positively geared, of course, but that supports people staying in the market for longer than they would have done if we had some sort of sunset clause, which would have sped up the transition to a more equitable housing system that encourages first home buyers over investors. The bigger picture, I think this bill continues to double down on sort of an investor-led response to the housing crisis, which I think doesn't meet the urgency of the situation. I would just prefer the money, whether it's the grandfathered funds or the exclusion of new builds from the bill, to just be invested in great public housing that is affordable to many more Australians.
Thank you. Mr Dorr, thanks for your contribution and congratulations on the success of your business. I might just start by observing that you might share more in common with politicians than you realise, because an irrational desire to change the world is actually why some of us got into politics in the first place.
It's far less profitable.
But I wanted to ask you specifically, do you have a concrete proposal that would address the issues that you raised with the committee today?
Yes, I think our proposal agrees with the thrust of the change. I think we just believe that the employee share schemes, as they're currently designed, would be a much more attractive proposition for staff if we could get to a CGT exemption for that group. And so what we would effectively see is if you joined in the current ESS scheme, you would see some portion of those gains, I think we talked about up to $10 million, exempt from CGT. And I think that would make the proposition of not only Australians joining Australian startups extremely attractive, but also bringing talent back from overseas extremely attractive. I think an unfortunate truth in the Australian startup sector is the ease at which Australians can get to America at the moment means we lose a lot of our best AI talent, kind of technical talent, to the US. And so anything we can do to make it attractive for those people to move home and work for our high growth startups, I think would be hugely beneficial to the success likelihood of those startups.
Maybe if I could jump in there.
Yeah, of course.
I think the details around the policy design could be subject to further consultation, but I think this kind of a carve out runs with the grain of the reform, right, which is to try and shift our tax base over time from that's more punitive on income and labour to that of capital. And so we think that there's kind of a win-win here opportunity in that it would also address the kind of structural issue that we have in startups, which is attracting enough talent to go through that post-Series A scale-up phase. And so, I think there was very wise comments from a bunch of the economists yesterday around principles of a good tax system that we should aspire for, and tax neutrality being one of those.
And so I think, yeah, that we should definitely keep the kind of broader economic goals in mind of the nation. However, you know, this would cost a rounding error for the budget. We think, like, for young people, as a young person myself, a big you know, factor for me joining Eucalyptus was to join such a high talented team and have a stake in a business that's contributing to our national prosperity as well. So yeah, we think this is a relatively, like, from a fiscal perspective, pretty neutral carve out, and one that I guess behaviourally would try and incentivise the kind of behaviours that we'd want to see from young people entering the economy.
So just last question from me, Chair. I mean, just so I understand the point you're making, you're suggesting that you're in a competitive employment ecosystem, both in terms of international versus domestic, but also purely domestically in terms of competing with, you know, the McKinseys of the world, and you think it would place, you know, businesses like yours or similar to yours in a more advantageous position in that employment ecosystem and have the capacity to attract more talent if you were to provide for a more generous regime on employee share.
For sure. And I think a lot of the debate in the last couple of, because many of my cohort know how to use social media quite well, has focused on kind of the interests of founders and the number of founders. I actually think that is largely a secondary concern to how many, the corpus of great talent that is able to join and drive the growth of great companies.
Yeah, thanks. That's clear. Mr. Turner, did you have anything you wanted to add there?
Just so far as the concerns expressed on social media around the rate of return for founders, in my opening submission I suggested that upfront concessions for startups that support startups with capital and cash flow might be more effective incentives for entrepreneurship entry than a discount which only bites if and when you sell that business. At the percentage, a 1 percentage point change in the likelihood of success in a startup is infinitely, or well, not infinitely, but far, far greater in impact than a 1 percentage point increase in rate of return. The rate of return is already very, very high. The challenge with starting a startup is that it's very unlikely that you succeed. If the trade-off is that there is a smaller payoff at the end of the journey in return for a greater likelihood of success in the form of upfront incentives, then that looks after the interests of founders as well as employees.
All right, thanks. Thanks, Chair.
Thank you. Senator Pocock.
Thank you, Chair. Thank you all for your time this afternoon. If we can start with Think Forward. We've heard a lot of commentary that young people oppose these changes because it means that they can't access things like negative gearing to try and break into the property market or use shares to build wealth to then buy property. Are these concerns widespread in your view? I understand you've done some surveys of young people.
Thanks, Senator Pocock. Yeah, I think they're quite widespread. I wouldn't say they're the majority by any stretch, but there is definitely a lot of younger people who are investing in shares or crypto or whatever it might be to try and save for a house deposit, for example. I mean, I did that myself, and I think it's actually a reflection of the structural issues that younger people face, that we're turning to ever increasingly exotic sort of speculative instruments to try and catch up with house price growth. And so I think that's the issue, that we can't double down on that system as the solution. Instead, we really need to support longer term structural reforms like this bill that hopefully over time patiently brings house prices more in line with sort of wages growth, and making sure that people can feel like they have that opportunity to buy a home or get ahead or start a business without these kind of needing to speculate on assets to get ahead. But in the survey work that we did several years ago now, there was majority support for reforming CGT and negative gearing as a way to even up the tax system between older, wealthier Australians and younger Australians trying to get ahead in life.
Mm-hmm. And I know that you also argue strongly for more government investment in affordable housing and a government-led program of housing construction. Were you disappointed that the budget didn't include more direct investment in housing?
Yeah, I'm disappointed. It's something that comes up consistently in our survey work with younger generations, and we can see that this investor-led solution to the housing crisis isn't working. This bill is not going to suddenly bring down house prices to the level that would make them affordable to lots of younger Australians. And there would be a lot of negative equity concerns around that as well. And I just think we've reached a point where direct public investment in housing that is affordable and high quality and treating it like essential community infrastructure like roads or schools or sports ovals is exactly the kind of approach we should be doing, as opposed to, as this bill does, doubles down on encouraging private investors into the housing market in the hope that enough homes are built, in the hope that maybe they'll be more affordable at some time down the track. I think we just need to be a lot more direct than that.
Mm-hmm. Okay, thank you. I know we're pressed for time, so if we just ask a couple of questions for Mr. Doyle. Congratulations on your success. I was interested in following up on what you were saying to Senator McKim around attracting talent and sort of keeping Australians here or luring Australians back to Australia to work in startups. Do you have any sort of amendments that you think would fix this? What are the things that the Senate should be doing?
Yeah, I think the proposal that we've put forward around carve-outs for ESS actually will go a long way in this space. I think if you're an Australian working in the US in a high-growth startup or an at-scale technology company, you're in a very tax disadvantaged position at the moment. There's like a lot of punitive parts to that, and so if we can create a situation where the likelihood of returns from a risk perspective and then also the tax treatment are equal or superior in Australia, I think we're going to see. I think there is something like 800 Australians working across the major AI labs in the US. I think even a small portion of them coming home to businesses like Heidi Health or Lorikeet would mean that the likelihood of those businesses succeeding increases well in advance of the 1% kind of proposed by Mr. Turner.
Okay, thank you. Are there any other things that in terms of this legislation and the CGT changes you think we should be doing for startups?
I think actually in the budget generally there was quite a lot of good thinking around how to incentivize the creation and scale of startups in this country. So I think without wanting to add increased complexity, I think if we can keep this thing simple and well implemented, then I think we'll go actually a remarkably long way to changing the calculus for startups in this country.
Mm-hmm. Great, thank you very much for your time. Thank you, Chair.
Oh, well, can I thank you for coming to give your evidence today and to give it so lucidly. Your experience in the startups is very valuable because you've certainly been used by many other witnesses as a reason to put the brakes on this matter, and that's not the sense that I'm getting from you. And I thank you for the clarification, because if anyone has the expertise, I think it might be you over other commentators. Could I go to your submission, Mr. Turner, with regard to pushing back on a number of pieces of misinformation about the changes that are proposed? Can you speak to some of these, such as, like, what is the evidence, for example, from the last time Australia had indexation, and what that says about the impacts on investment and productivity?
Yes, certainly. The social media coverage, as Mr. Doyle and I have already referred to, has been, perhaps it's risen to the level of hysteria about the level of disincentive that this would create in our tax system for establishing new businesses, which ignores that for a period of nearly 15 years we operated under a system not so dissimilar to the one that is proposed by this bill. In that period, labour productivity and GDP grew at a faster rate than they have in the period since. Now, I say that in my submission, and I'm a lawyer, not an economist, so there will be witnesses more qualified than I to speak on these matters, but I say in my submission that I don't suggest that performance is attributable either to the discount or its absence, or cost-based indexation or its absence, merely that there are much more important factors to labour productivity and GDP and the prosperity of our country and young Australians' desire to establish startups than the CGT discount.
I think you said earlier in shorthand, it's not a first order concern. As you're starting, you're not going, okay, I'm about to think about getting this startup together and let me see what the tax implications will be on a potential profit in 15 years. That is not what you're thinking as you're commencing this journey.
Precisely, and I, speaking from experience, I've never had a prospective startup founder in my office tell me that the reason they're there is to benefit from the preferential treatment of capital over labour.
And you could have gone to Singapore at any point in the last 15 years.
Precisely. If you were going
Sorry,
to
could you just say that again, Mr. Doyle?
didn't-
If that was your, no, this is quite helpful to fill it out, right? Because you're experts.
Yeah.
So your point was
you could have gone to like as a founder, you could have gone to Singapore for a discount at any point in the last 15 years. You know, it's been CGT free for quite a long time,
Right.
And so that was always available, and yet hasn't really moved. I don't know of a single Australian startup that has moved to Singapore.
Yeah.
Okay, so we haven't had a flight of our talent to a zero capital gain jurisdiction. And I noticed in your opening statement, Mr. Doyle, that you said there's no way I was going anywhere other than Australia. I mean, let's just celebrate the Socceroos, but a whole lot of other Australians who are proud of the country and do things. What was your motivation for staying here when you could have jumped to Singapore?
Well, our company is a bet on Australian talent. It was a bet that Australian talent was available, underpriced, underutilized, and could be driven into creating things that would be globally competitive and globally recognized. And I think that bet has been validated. And so, speaking from my own personal experience, it's a pretty strong argument for building here.
Right. So its capacity is extant here, and it's just not being used as well as it could be.
For sure.
And it's not because of tax.
Yeah, because there's less competition for the talent, right? If I go and start my business in Silicon Valley, I'm fighting 20 of the 30 biggest companies in the world for that talent. That's just not the reality here. And so there is an opportunity to start here and attract talent here that doesn't exist in many places around the world, because we train, UNSW trains fantastic technical talent. There are universities around the country that do that. And so our ability to bring them into our business, use them productively and scale the business is, I think a big advantage of building a business here.
Okay.
And I'm sure Mr. Doyle would have succeeded anywhere in the world, but for many founders, there are natural constraints to their ability to pick up their lives and move to another jurisdiction, not only personal and family ones, but also professional ones. They may be in a position to commence a business in Australia because of their professional network, because of their knowledge of the market, because of their connections to customers. They will face great difficulty operating a business with customers, staff and suppliers 12 hours away by plane.
Okay. That's actually very helpful. And just on the disinformation piece, I'm sure that you know a few smart people in Australia. Clearly we could do with a great startup to deal with disinformation and misinformation. It's just a blight on democracy. And I think the current debate has actually shown how distorted some of the messaging has become across all media platforms.
Yeah, I agree with you completely. I actually think Senator Pocock is the example of the antidote here. I think it's about you all publishing more content. If you guys make more content, then we'll have more honest and transparent content out in the ecosystem. And
I hate to be challenged in that way with an area that I don't feel I'm particularly talented in, Mr. Doyle, but somebody might be who wants to come and do that for me. If I can go to the contribution that you made, Mr. Walker, think forward. So just making sure that you can hear me properly. You also pushed back on people using financial anxiety of young people to oppose reform in the way that I indicated. This group here. Oh, are you still with us, Mr. Walker?
Yes, I'm here.
Great. In the way I indicated at the beginning that, founders and thought leaders and successful entrepreneurs in the startup sector are being constantly referred to and used as a tool for arguments that you oppose in your own lived and primary evidence. You indicate that this colonisation, if I can put it that way, of young people and driving financial anxiety is something that should not be done, and its mobilisation to oppose reform is disingenuous at best and perhaps dangerous in another way. So can you speak to why these changes, in your view, will actually be fairer overall, and why that's good for young people and for future generations?
Yeah, absolutely. So we called our organisation Think Forwards because we really wanted to focus on big structural reforms that would make our lives better in the longer term. Because lots of younger Australians do feel a sense of financial anxiety. They worry about the future. Many young Australians no longer think that hard work and effort pays off. And so we think, and we believe that the tax system is a driver in a lot of that, a cause of that financial anxiety, and that people can't get ahead because our tax system has been eroded. The progressivity of our tax system has been eroded in such a way that, wealthier older Australians are paying lower effective tax rates than younger workers. We're told constantly that there's no money in the budget to invest in the things that people need to do with their lives, these kinds of things. So taking that bigger picture, even though in the short term, some younger people who might be investing in shares or rent vesting might be worse off, we're really calling on younger people to think of that big picture. But yes, there is of course people who are using that financial anxiety to try and protect their own, I guess, tax breaks and concessions. And some young people genuinely worried about what these reforms mean, because they are using shares or investing to build their wealth. But fundamentally, we believe that these reforms are really great for the long-term future of younger generations because, they do three things. They raise more revenue by winding in these very expensive, not very well targeted tax expenditures that benefit the already wealthy. They even up the tax system between younger workers and older wealth holders in terms of effective tax rates paid, and they hopefully will stop this intergenerational wealth inequality from growing any further, where those with wealth can take advantage of these tax breaks to grow their wealth further, while those without access to wealth don't have access to these concessions. Real wages are really growing. We're sort of seeing a K-shape in our economy happen where, those who are already ahead pull further ahead, and those who are just starting out in life are loaded up with housing and student debt, and real wages aren't growing fast enough, and their outcomes are declining. And so that bigger picture piece is what we're really calling for people to consider and not get pulled into this sort of short-term winners versus losers debate, because we need to think about the future and the prosperity of our nation as a whole.
One on notice. There was a response by Mr. Lubbering to Mr. McKim around a 10 million figure. It seemed arbitrary. I just want to invite you to provide on notice where that number comes from. So you don't need to answer now because we're moving on, but it would be helpful to get the frame that you're operating from with the selection of that number. Thank you. Thank you.
Senator Smith.
Thank you very much. We were able to ask, previous witnesses about the extent to which they have been involved in consultation around their ideas with the government. Can you provide us with any information about your level of consultation and engagement with the government, starting with Treasury officials? Have you engaged with Treasury officials around any of your ideas?
No one from Treasury. From the Treasurer's office, as is, I think, I posted on LinkedIn about the changes, which is kind of the extent of what I'm capable of doing, and got.
Mr. Doyle, you won't be surprised to know I've done a bit of research.
Good, I'm glad.
So I think that is it's a very humble statement of yours.
Yeah.
But you are capable of more than just posting on LinkedIn.
Yeah, well, Jay might argue against you there. And so
you would like to just for those who perhaps haven't been keeping up.
Yeah, so I received a call from someone in Jim Chalmers' office the day after I posted on LinkedIn, actually, asking for clarification on what I meant there and would I be interested in being involved in a further consultation process at some point in the future.
And your answer was?
Yeah, I would be. Be, yeah.
And who was it from the Treasurer's office that reached out to you?
I'll have to take that on notice. I can't actually remember the name, but I'll pass it on.
You cannot remember the name of the Treasurer's office official that reached out to you?
No, I can't. It wasn't someone I'd met before, so.
Right. So you're familiar with Labor Party staffers?
Familiar? No, I wouldn't say I'm familiar with Labor Party staffers.
Not now?
No.
Okay.
Yeah,
that's probably not necessary, Senator O'Neill.
Yeah,
I'm sure Mr. Doyle has a connection. So, did you agree to participate in a consultation process when you were invited to do so by the Treasurer's office?
I did.
Yep, and what? And has that process begun?
No, that process has not begun.
And so, what form will that consultation take?
I actually have had no contact since that, apart from the invitation to appear here. Since that.
Oh, so the Treasurer's Office invited you. Oh no, we invited you, or the Treasurer's Office
invited you? Us, yeah.
Yep. And the Treasurer's Office invited you to participate?
No.
Here? Right. Did the Treasurer's Office talk to you about participating here at all?
No.
Okay. Mr. Turner, what's the extent of your involvement with Treasury officials, Mr. Chalmers' office, representatives of Dr. Chalmers' office in terms of consultation processes?
I participated in the Treasury consultations.
Oh.
Yes.
What are those Treasury consultations?
There was a video conference with 3 Treasury officials whose names, Senator Smith, I have to say I can't recall, and I'd have to.
You can take it on notice. Yep. What date was that?
I don't know. I can check if you like.
Yes, please. Yep. It's a very privileged position you have, because if my memory serves me correctly, when we've asked other people about the extent of consultation between the government, when people use the word government, I prefer to be much more precise. There's the Treasurer's offices, the representatives of the Treasurer. There's the Assistant Minister for Competition, Charities and Productivity and other matters. Then there are officials from the Treasury. So we've been able to ascertain that, Mr. Doyle, you received a phone call prompted by a LinkedIn post from the Treasurer's office, and you're going to confirm with us who that was. And Mr. Turner, you've been able to confirm with us that you participated in a consultation or a discussion with 3 Treasury officials.
Yes.
And what date was that?
On the 21st of May.
The 21st
of May.
21st of May. And was it just one consultation, or?
It was just the one.
Just the one. And how many people participated in that with you, or were you privileged enough to have a one-on-one with 3 Treasury officials?
It was just me in that call.
That's very privileged.
Is it?
Yes, it is.
Okay.
Trust me, it's very privileged. You don't have the names of those 3 Treasury officials?
I do on the invitation, if you'd like that.
Yes, please. Yep.
Tanuja Doss, Jonathan O'Bannon, and Rob Preston.
Great, thank you very much. And I think Mr. Preston is appearing later today, so he might be quite illuminating. Any other witnesses had any engagement with the Treasurer's office or Treasury officials around consultation?
Not me, but I would say that I mean, this is an apolitical kind of submission that we've put forward, and I'd be happy to appear in front of any committee of any.
So just to be clear on that, you are speaking on your own behalf, or are you speaking as representatives of others?
They both said at the beginning they were speaking as individuals.
Great, just to confirm.
In a private capacity.
The government has suffered a noticeable slump in political support as a result of the budget. A drop to 29%. Issues around trust, issues around broken promises. Mr. Doyle, given your previous campaign experience, what advice would you have to the government?
Yeah, it's a good question. I've actually put most of my time into running this business, to be honest. I don't have any advice for the government.
Now, that's right. Now you do. Now you do. That's right. That's right.
I mean, perhaps maybe worth thinking about the primary support of the Liberal Party at the same time.
Sorry?
Perhaps thinking about...
Don't you worry about that. You leave that to me. I'm very, very experienced parliamentarian. You can leave that to me.
About anything to do with politics.
I just think in the interest of full disclosure, I'm not doubting, Mr. Doyle, I'm not doubting in any way. I'm not doubting in any way your commercial success, acumen and foresight. Not at all, and congratulations to you.
Thank you.
But I just thought perhaps full disclosure, because I went to your biography, which is on the website, and it talks about your political campaign strategy and work with the Australian Labor Party, and congratulations to you. It was in 2016, not so successful, but I just thought in the interest of full disclosure.
Probably worth clarifying. Yes, I was a paid consultant for Ogilvy Group as an advertising agency. I've never
I thought it was Harris Partners.
Harris Partners was owned by Ogilvy Group.
Right, yep.
I've never participated in any form of Labor Party membership campaigning apart from my.
So what does that mean then? So what does that mean on your website?
I ran ads basically as a paid consultant.
Right.
And very unsuccessfully, as you pointed out, to the
Yep.
point where the Assistant National Secretary of the Labor Party at the time attempted to fire me, unfortunately. So I wasn't cut
and
out for this role.
congratulations to you, because you found a wonderful career after
Thank you,
politics.
thank you.
A
I
wonderful
appreciate that.
career after politics. Thank you very much to Mr. Doyle, and again I congratulate you on your commercial success.
Thank you.
And you will
very
provide
much.
some information about the Treasurer's representative from his office
Of
that
course.
reached out to you. Thank you.
Okay, I think that concludes our questions for this panel. Thank you very much for your participation, and we will now suspend for afternoon tea and return at 3:45. I'll welcome representatives from the Australian Tax Office and the Department of Treasury. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. The Senate has resolved that an officer of a department of the Commonwealth or of a state shall not be asked to give opinions on matters of policy and shall be given reasonable opportunity to refer questions asked of the officer to superior officers or to a minister. This resolution does not preclude questions asking for explanations of policy or factual questions about when and how policies were adopted. Officers are also reminded of the Senate order specifying the process by which a claim of public interest immunity should be raised. A copy of the order is available from the Secretariat. For the Hansard record, and as we go through the question and answer, because everyone is on the line, I would ask that you please state your full names when you speak, and for the first round, if you could also talk about the capacity in which you appear today.
Thank you.
Yeah, all right. I'll let you guys work out how you introduce yourselves because we cannot see any of you.
Thank you, Chair. So, Will Day, Deputy Commissioner of Taxation for Policy Analysis and Legislation, and I am joined by three of my colleagues who will introduce themselves now.
Yes, hello, Larissa Evans, Assistant Commissioner, Policy Analysis and Legislation.
Sandra Roussel, Assistant Commissioner, Policy Analysis and Legislation.
Justin Dearmas, Assistant Commissioner, Tax Council Network.
And from the Department of Treasury, Diane Brown, Deputy Secretary, Revenue, Small Business and Law Group, and I have 4 colleagues with me.
Shane Johnson, Assistant Secretary, Tax Analysis Division. Will Preston, Assistant Secretary, Tax Analysis Division.
Sorry, from Dr. Johnson onwards, can you perhaps speak a little more clearly? It was a bit muffled.
Rod Preston, Assistant Secretary, Tax Analysis Division.
Chris Leggett, Assistant Secretary, Law Division.
Richard Ma, Assistant Secretary, Personal and Indirect Tax and Charities Division.
Okay, we'll see how we go. Do you either of the groups have a short opening statement to make?
We're happy to go. Sorry, you go, Will.
Thank you. I was just going to say, Chair, we stand ready to assist the committee in any way we can, obviously within the confines of our role. No, we weren't proposing to make an opening statement.
Mr. Day, Ms.
Chair, we're not proposing any opening statement either. Happy to go straight to questions.
Okay, we will rotate in 10-minute blocks. I will go to Senator Chandler first.
Thank you, Chair. Thanks all for calling in this afternoon. I can see from the Treasury organisation charts that between January 2026 and April 2026, 3 branches were created in the Tax Analysis Division. Is it fair to say that these teams were the principal architects of the tax changes within Treasury?
Senator, the tax changes were developed within my group. A number of that work was done in that Tax Analysis Division, but work was also done in other parts of the group.
Is it fair to say that the work regarding these tax changes commenced in January 2026?
The capital gains and negative gearing were done in this group, in the Tax Analysis Division. The Working Australian Tax Offset was developed in the Tax Analysis Division. The instant tax deduction, which is, I think, Schedule 4 in the bill that you're talking about today, that was done in Personal Income Tax and Charities Division.
Sorry, that didn't answer my question, Ms. Brown. My question was, is it fair to say then that these tax changes, the work to make these tax changes started in January 2026 when these new when these new branches were set up within the division?
Sorry, Senator. I think, as the Treasurer said, the work started towards the end of the 5. But by January 26th, we decided we needed to restructure to support the government's work.
Okay. Well, that's not a great deal of time between when you would have first begun to advise the government and undertake any analysis of the impact of these changes. When did you know the final policy specifications from the government, and how much time was there to consider the broader economic impacts of these changes on productivity and economic growth?
So, Senator, we're always looking at the operation of the tax system. It shouldn't be surprising that we would have been talking to the government about the operating tax system on an ongoing basis. Sorry, now I've forgotten your question.
The question was, when did you know the final policy specifications from the government, and how much time was there to consider the broader economic impacts of these changes on productivity and economic growth?
Senator, that specifications would have been to the government, and that would go to cabinet processes. But cabinet can be an process, but I don't think I can say anything more than that.
On what date then, can you tell me where were the final specifications of these tax changes costed by the Treasury? I assume it would be fair to say it was at some point in April or May.
I think that goes to cabinet processes, Senator. The budget processing is normally a matter of cabinet.
Okay. We've heard a few times today about the consultation paper, I believe, that will be provided to industry on the changes, because obviously much of the detail of these changes is still unknown. And everyone seems to be watching and waiting very patiently. Can you tell the committee when that consultation paper will be available?
So, Senator, the issuing of the consultation paper is a matter for government, but the government has made some public statements as to relation to timing. I believe they've said it will be released soon, but unfortunately it is a matter for government as to release date for any consultation paper. We have been in consultations with industry, some discussions before budget, a lot of discussions after budget.
Yes.
So we've been in a position to advise and prepare government for the release of the consultation paper.
We'll come back to what those consultations look like in a moment. But the paper itself, can you tell us if you've provided a draft to the Treasurer's office that's just waiting to be released?
So we don't normally go into those types of discussions, but I can assure you there has been conversations between ourselves and the department and the Treasurer's office around what we're hearing in consultation, the kind of feedback we're receiving, possible suggestions for how changes could be made. That conversation has been going on the budget.
Okay. In the consultations that you have been undertaking, has Treasury requested any stakeholders sign non-disclosure agreements?
No, I was just checking with my colleagues. No, we've had no confidentiality deeds requested or required to be in the budget.
We heard earlier today that the CPA estimates compliance costs of these tax changes of $295 million to $542 million per year, plus about $675 million to $825 million in one-off transitional costs. Now, I know that Treasury's estimate in compliance costs is about $88 million per year, which I understand has been taken from the Greens inquiry that didn't necessarily relate to these specific policy settings. Does Treasury disagree with CPA Australia's regulatory costing estimate?
Senator, I might just correct your question there. The compliance costs are based on the proposal as proposed by government. They were based on what was proposed, not taken from the Senate inquiry. So the compliance costs are estimated in the letter to the Office of Impact is our assessment of the compliance costs for the measure proposed by government. That was worked out.
Ms. Brown, sorry, just before you go on, it is a bit difficult to hear you. Is there a way that you can bring the phone to your mouth a bit closer or something like that? It's it's not the best quality sound.
Sorry, Senator, is that a bit better?
Yes, slightly.
I'll try and speak slower as well. Can you repeat the question again?
So the question was around the regulatory costing. There is a big disparity between the $88 million that Treasury has estimated and the hundreds of millions of dollars that the CPA has estimated for compliance costs.
Yeah, we have looked at the CPA's compliance costs. I agree there are various ways in which to calculate compliance costs. In calculating the compliance costs, we did, however, follow our usual procedures and prepare the costing in accordance with guidance from the Office of Impact Analysis. We did try to understand the number of people affected, and to do that we did access tax data. We did consider the operation of the Act, including the extensive valuations. We also considered the systems that could be adopted by businesses and also had regard to ATO development tools to assist with the calculations. So on the basis of that, we made our calculations, contemplating what we thought would be the way in which people could incur compliance costs.
Okay, so you're standing behind the $88 million, even though the CPA came in here today and said it would cost more than 10 times that potentially.
There are, as I said, compliance costs can be difficult to estimate. There will be differences in the model. For example, I think we understood that valuation may not be necessary on 1 July 2027 in every case. The law will provide people to use an apportionment method. Will also allow people to make valuations at a different date, that reflecting the value of 1 July 2027. And as an example, I think the CPA took a different view to how valuations could be considered.
You don't think the CPA would be pretty well positioned to know exactly how valuation should take place and how much it would cost?
I think they do have a value perspective, Senator, without a doubt. We did engage with the ATO, who would also understand the business approach. And we have obviously a bit of an inside knowledge of the operation of the Act, or an advanced knowledge at this stage.
Thank you. Yeah, we'll rotate, Chair, and keep going.
Yeah, okay. Senator McKim.
Thanks. Good afternoon, folks. Just got some questions for the people from Treasury. Have you done any modelling on how long you expect the grandfathering to wash out of the system, or to substantially wash out of the system?
Senator, I might see if my colleague, I'm happy to answer that question.
Thank you.
Shane Johnson. So in our modelling, we do have assumptions about how long those provisions would take to wash out. Essentially, what we see is, typically people remain negative urine condition for, on average, somewhere between 6 to 7, 8 years. Some people will actually go longer depending on the asset, but we see a significant portion of people kind of washing out in that kind of 6, 7 year period, but there will be some others that will struggle, but the majority come through in around that period.
So the average investment property holding time is currently about 9 years, Dr. Johnson, is that right?
Yeah, it's normally around that period. We've seen numbers around that length of time. That's right.
Okay. We've seen some financial analysts saying that these reforms will increase the attractiveness of exchange-traded funds because losses and gains are netted out. Our superannuation system already has a problem with passive herding. Do you think these changes might increase the urgency for reform of the performance test?
Senator Diane Brown here. The government is currently consulting on the performance test.
Yep. Yeah, no, I'm aware of that.
I haven't thought about whether these change. I'm happy to give that some further thought. My colleagues may have comments, but I think the performance test is really being looked at to ensure that there aren't any unnecessary impediments or barriers to investment.
Okay, thanks. If you could come back on notice, Ms Brown, that would be helpful. During the work that Treasury did on this legislation and the advice that you provided to the Treasurer, did you consider including changes in relation to self-managed super funds, in particular the limited recourse borrowing arrangements that SMFs are able to enter into, in particular for residential properties?
Senator, as you'd be aware, superannuation taxation arrangements were changed very recently as part of the better side of the super concessions. So no, we weren't looking to change the taxation arrangements for self-managed super funds here, other than through. We weren't looking to change the taxation arrangements. We are aware of the issue of limited recourse borrowing. It has come up in the context of both system stability and also the effect for individuals. But I don't think that necessarily these changes will alter that. There are constraints in super as to how that would, we think, work, not encouraging further investment necessarily through super, but it's something we want to keep under review.
Ms Brown, are you aware of a surge in online ads that are spruiking self-managed super funds at the moment? And in particular, we've seen ads that describe SMSFs as the budget loophole. These are all post the budget, by the way, this surge. SMSF's the budget loophole. SMSF, the ultimate tax haven. Turn your retirement savings into long-term property wealth. Do those kind of ads cause you any concern? And would you accept that that these changes have provided a precondition for that surge in this kind of advertising?
So I don't have anyone here from my retirement income and superannuation division, but we have had conversations about that scrutiny, and they are aware of the scrutiny. So as we say, there are constraints to super, how much to contribute to super. Any increase in the fund size will obviously, after a better target of super concessions, trigger a higher tax liability. But it is something, I think, given, as you've indicated, a level of scrutiny, we would want to keep under review.
Yeah, I mean, self-managed super funds pay an effective tax rate of 10% on capital gains. Did Treasury not consider bringing self-managed super funds and the taxation arrangements of self-managed super funds in as part of these reforms?
I think after the better targeted super concession changes, there was a commitment by government not to make any more changes to the taxation arrangement of super funds.
Okay. The legislation contains a number of areas where the minister can take various actions by disallowable instrument. For example, the definitions of new residential dwelling. Was it considered, why did Treasury advise the government to handle those issues in the way that you have, rather than simply providing a greater level of certainty in the second tranche of legislation that the Treasurer has flagged?
I might see whether my colleagues want to add more to what I say, but disallowable instruments are used not uncommonly, particularly where the definition may need to change, capture evolving market conditions, for example, or new ways of, in this case, or in other cases, supporting affordable housing. Sometimes there are a number of instances where definitions are delegated to subordinate legislation, but I might see whether any of my colleagues wants to add anything.
Thanks, Senator. Sorry, it's Chris Leggett again. So, as you're probably aware, that the use of legislative instruments is strictly governed by the Legislation Act to ensure accountability, transparency, and parliamentary oversight. So we have very close regard to the Legislation Act when we're advising government as to how to structure the legislation, whether to use instruments. Increasingly, acts confer powers to make legislative instruments implement schemes established under those acts, and we've done no differently here. The instruments enable Parliament to focus on the core principles that underpin these laws and avoid getting distracted with what is often very lengthy and complex details. It is often appropriate for these details underneath the legislative principles to be set out in instruments, as those details are more likely to change over time to reflect, as Ms Brown said, the evolving economy, political landscape and changing of government affordability programs. As we said, the Treasury Laws Amendment Tax Reform Number 1 Bill authorises the Treasurer to set out details in legislative instruments. For example, as you said, the definition of new residential premises, some exceptions from loss quarantining for certain types of dwellings that are used for certain purposes. This is intended to provide flexibility for the Treasurer to exclude dwellings from loss quarantining that are used for purposes that support particular kinds of accommodation and allows unintended outcomes to be addressed quickly to provide market certainty. This power would be used to exclude, as we've sort of said, build-to-rent development, residential properties that are used to support government housing programs, for example, through the provision of affordable housing. These types of instrument-making powers are common and widely held and widely used.
Okay, does Treasury currently know which government payment recipients will be exempt from the minimum 30% tax rate?
Rob Preston, Senator, we're progressing these legislative instruments as a matter of priority and providing advice to government.
Okay. When would you expect to provide that advice to government?
Well, we have been providing a range of advice on this matter continuously, and we're actively doing so.
All right. Okay. Thank you.
Are you done?
Yeah.
Okay. All right. Thanks, Senator McKim. We'll go to Senator Pocock on the line.
Thank you, Chair, and thank you all for your time this afternoon. I was interested in your response to Senator Chandler's questions about the timing of advice to government, and I'm interested in how the date that you've provided advice or the government has asked you to draft something would give away cabinet deliberations.
Senator, I think the nature of that question was going to Senate processes because it was about information provided during the development of the budget.
Yes. And so how does that reveal cabinet deliberations?
Sorry, Senator. Sorry, can I just interrupt for one moment? I apologise for this, but I think to try and address the sound issues with Treasury, we are going to suspend for a quick moment. We will come back to you, Senator Pocock, when that's been resolved. I understand the Treasury people will seek another solution so that we can improve the sound. So let's just suspend for a moment and then we'll come back very shortly. Because, yes, we can hear you better now. So, Senator Pocock, apologies for that interruption. You good to go again?
Thank you, Chair.
Thank you.
Thank you for that. Yeah, I just don't think that we should accept your claim that just giving us the date would reveal cabinet deliberations. And was just looking at Odgers, page 666. It says that there's been a tendency for governments to claim that anything with a connection to cabinet is confidential. A claim that a document is a cabinet document should not be accepted, as has been made clear in relation to such claims in court proceedings. It has been established that the disclosure of the document would reveal cabinet deliberations. And so I don't know, I'm just keen for you to actually give us the dates that have been asked for. I don't see how that reveals what was actually discussed at cabinet.
Senator, I understand it's a long-standing convention not to disclose the dates of cabinet meetings. And the disclosure.
I didn't ask for the date of cabinet meetings. I think Senator Chandler was asking for the date that information was requested from Treasury.
So the dates could imply cabinet dates, but cabinet processes and developing advice for cabinet is a reasonably, well, it varies from matter to matter, but it can be a fairly continuous process, whereas advice is not unusually developed in an iterative way, and so advice could be provided on multiple days that all then support a cabinet submission being made on the terms that the relevant minister wants to make it. So I don't know whether we can actually indicate at one single date in any event.
Okay, so are you claiming a public interest immunity claim then?
Look, it generally is my understanding that cabinet dates are not disclosed.
Well, I'm just going off Odgers, so I don't know.
Yeah, look, I'm happy to take that on notice and see if I can't provide the dates. I'm happy to try and see if I can't.
That'd be good. I just find it so strange that dates are now all of a sudden cabinet in confidence. But I'm keen to understand more about your consultation process. Since releasing the detail of this legislation, have you met with individual businesses, including small businesses, or just with peak bodies?
I think we've met with a range of entity types, a combination of individual businesses, funders, industry bodies, owners of business. I might see whether my colleagues want to confirm that or add anything. They're all nodding their head. Yeah, so it's been a range of different, if I can say, entity types, including individuals.
Okay. Will that be made public to the committee who's been consulted?
We can. The consultations are ongoing, but we can take that on notice and provide a list to you.
Thank you. We've heard multiple witnesses request the release of Treasury's modelling. Are you able to table that for us?
Could you be more specific as to the nature of the modelling that you're wanting?
The modelling around the housing, the reduction in houses built, the small increase in rents, all the modelling that sort of underlied the talking points around the release in the budget.
We do actually. Shane Johnson. We do actually include quite a bit of the analysis, or actually the analysis in Budget Statement 4, including all the findings. But in terms of an actual modelling report, I can take that on notice if you like. It's from another group within the department, so I would just need to find out from them what can be done.
Okay. Thank you, Mr. Johnson. That would be great. Are you working on any government amendments to the legislation?
So I think that goes to advice to government. I think it's reasonable to say that we are watching these inquiries. Government is watching, well, I presume government's watching this inquiry as well. It's not unusual to move amendments to legislation, but it's a matter for government to announce whether or not there are amendments and what they are.
Okay. We've seen reports of a proposed paper to be released by the Treasurer, the workaround for tech and biotech startups and small businesses. Can you provide more detail about this reported workaround?
I can confirm that we are working on a consultation paper. The government has asked for a consultation paper to be developed. As part of that, there have been consultations with a range of entities, bodies, individuals, businesses to understand the VC ecosystem, if I can use that language, that various people and that might be affected by the CGT changes, so that we have good understanding of the sector and how they're affected. There's also been a review done of the arrangements for supporting venture capital in other jurisdictions and how it's done there. And all of that will go to inform advice to government. And but the final form of the any kind of consultation paper will be a matter for government.
Okay, so if it's a consultation paper, we likely won't see any of this before in the next month or so. I assume that process takes some time.
It is a matter for government on when they release the consultation paper. We have been working expeditiously. I think the government is keen to try and consult on this issue as soon as they can.
Okay. Thank you.
Sorry, consultation time is a matter for them.
Sure. And one area of confusion that we touched on earlier was whether grandfathered CGT arrangements would transfer in the case of death or divorce. And could you clarify that for us?
I might see whether Mr. Preston can elaborate.
Sorry, Senator, just to clarify your question, this is in relation to assets that benefit from the exemption from negative gearing. Is that right?
Property, yeah.
That's right. So in the event of a transfer of an interest or a part of an interest, the new owner of that part of an interest would no longer benefit from the exemption.
Okay, and that includes divorce.
Divorce has not been ruled out through the legislation.
Okay. And what about yesterday? There was a lot of talk about the definition of the new residential dwelling. Can you shed any light on that?
That will be set out through the legislative instruments. The tax explainer that was published on budget, and I can include a bit of some information on how that works. I think the general principle is that it relates to dwellings that genuinely add supply. Were there particular questions that you wanted to? That's probably all I can say definitively at the moment. But were there further questions?
Senator, just to refer you to the tax explainer, there is a table on page 6 of the explainer on negative gearing capital gains that lists what will be an eligible new build and what would be not an eligible new build. That is being developed and put into considered further, and that's what will form the content of the legislative instrument. But we're hoping that table will give you some sense of the underlying rationale.
Okay, so people should just go off that. Thank you. I'm happy to hand back the call. Thank you, Chair.
Senator Chandler.
Thank you, Chair. Can Treasury tell me how much revenue we will receive from just the capital gains tax change, separate from the negative gearing changes?
So, Senator, we may need to take that on notice because the government packaged the costing for negative gearing and capital gains and I don't know whether we have it on hand. The combined cost over the forwards, I'm just trying to find it, is roughly 2.2, sorry, I would need to add it up. It starts in year 28-29 and brings in 1.35 billion. That increases to 2.28 billion in 2029. But that is the combination of negative gearing, capital gains.
Ms. Brown, I don't ordinarily like to push public servants when they take questions on notice because I understand that you have a right to do that. But this is pretty basic information. And we've traversed this at estimates previously. I would have thought that Treasury would have made an official available today who can split these two costs of the CGT changes and the negative gearing changes and be able to provide us with a disaggregated number for both of those costings. So can I ask you again, is there really no one sitting around the table down in Canberra who can tell the committee how much revenue the CGT changes are going to bring in for the government and how much revenue the negative gearing changes are going to provide?
Senator, I'm looking at my colleagues and I do apologise. We have not got in our possession a broken down disaggregated number. I have the BP2 in front of me and unfortunately it is a packaged cost.
Are you even confident that a disaggregated number exists somewhere in the Treasury Department, or did you exclusively cost this revenue stream based on the combination?
No, Senator, costings were done separately.
So why can't you tell us what the numbers are?
I just don't have the numbers with me, Senator. I apologise.
Well, I certainly hope that in response to that question on notice, we do get a very clearly disaggregated number of the CGT costs on the one hand and the negative gearing changes, the costs of those on the other hand. I'm wondering whether Treasury has read all of the submissions to this inquiry.
Senator, we've read some of the submissions.
How many?
I believe the submissions are still uploading. I've received a number directly that I've read. I wouldn't want to say it's terribly many, but we have got a team looking at the submissions downstairs, and Mr. Preston may be able to elaborate on how that team is progressing through that work.
Mr. Preston.
Senator, I was just saying that my team and other teams are reading the submissions that they're uploaded. We're paying close attention to the submissions and making notes, Chair, internally.
But you can't tell me how many submissions you've read.
Me personally, I have read, I would say, about 40 submissions. But I don't know every member of my team. Have we read every single one that's been uploaded at this point in time? We are working our way through all of them as they get uploaded.
Ms. Brown, do you have any estimate on how many of the submissions you've read?
I went online about Wednesday when there was probably about 19 uploaded. And then I went online again at the end of Friday when there was about 59 uploaded. I understand there is now a considerably greater number uploaded. I probably read around a handful, a number that was sent to me directly and a number that I looked on. When I say number, I do mean a few on the internet through the website page, the committee's website page. As I said, though, the team is looking at them. We have a process by which issues will be elevated and raised.
So can you explain to the committee what that process looks like, Ms. Brown? Are you actually tracking how many submissions that your department are reading?
So Mr. Preston might be able to elaborate, but I believe summaries are being made.
We're preparing summaries, Senator. We have a team who's farming out submissions. We have summary documents that are being prepared. We're looking across the sweep of evidence.
Will those submissions receive a response from Treasury prior to the passage of the legislation?
The submissions to the committee, Senator, so it would not be usual for Treasury to respond to submissions to the Parliamentary Committee.
I mean, I think you've highlighted, Ms Brown, one of the problems with the very short inquiry timeframe for these changes, that clearly the department has not had the ability to read all of the submissions. You've admitted as such today. Do you think that the timeline for the passage of this legislation from being introduced in the Parliament to being inquired by this committee to ultimately being passed by the Parliament, and I suspect the view is that that must be done before the end of the financial year, do you think that's adequate?
I think the timing for legislation is a matter for government. There's a range of factors that they need to balance up. One is, as you said, the introduction date. Another one is when certain measures take effect, and there were elements in relation to negative gearing that took effect from budget night. And so providing the detail and the certainties as soon as possible is probably more pertinent in those cases than other, but ultimately the timing of legislation is a matter for government.
I would have thought one of the other relevant considerations... Sorry, Mr Preston, you go.
Apologies, Senator. I don't think our evidence was we haven't had time to read them. I was just saying that I couldn't speak to you with certainty of exactly how many we have read at this point in time. We're certainly farming them out and reading the submissions as they get uploaded.
I would have thought one of the other considerations for government in terms of the timing of passage of legislation is providing the key department that wrote the legislation with adequate time to read submissions to the relevant Senate inquiry, so that when we all come here and we ask questions of Treasury, you're in a position to answer them.
Senator, I think it was Parliament that chose the timing for this inquiry. It's not something that's actually in the department's control.
Would the department like the Senate to take longer to inquire into this legislation?
Senator, I don't think I can answer that question. That really is a matter for Parliament.
I think you've said as much, though, Ms Brown, that the timeline that has been set hasn't enabled you to do the work required to provide fulsome evidence to this inquiry. You haven't been able to read all the submissions.
We are trying to read the submissions, Senator. I wouldn't say that we read the submissions to every parliamentary inquiry, for every inquiry in any event. There will be a report, there's hearings. The report will weigh up all the submissions and hearings. So I wouldn't set the benchmark as how the department read all the submissions.
Does your team have the capacity to do this work in the next 2 weeks when the government wants to legislate this bill? Like, are we going to be in a position when this legislation is going through Committee of the Whole in the Parliament in 2 weeks' time and the department still can't answer questions because you still haven't read all the submissions?
Well, Senator, we're answering the questions to the best of our ability. I think whether you have Senate inquiries where there are a lot of submissions, they can be read and analysed in a range of different ways. And so I don't think where pieces of legislation have Senate hearings where there are large numbers of submissions, they can be summarised in a range of ways. And so I don't think anything that we're doing is unusual in the Senate practice.
Is Treasury aware that several submissions have raised concerns around drafting errors in these bills? Have you, in the handful of submissions that you have been able to read, have you read those concerns?
Senator, I have. I read the submission from the CPA where they raised, I think, errors in maybe 4 examples. We will look to review that, and there will be an opportunity to correct those errors.
So we should expect that there will be some amendments to the legislation that will come through the Senate from the government?
No, the errors were just in the examples in the explanatory memorandum. They didn't go to the legislative provision or the operations of the law. They were examples of how particular fact situations may apply.
Okay. So we're just going to have to take your word for it that there will be some changes made between now and when when the Senate considers this legislation in 2 weeks.
What is tabled, again, is a matter for government, but we do see there is an opportunity to make revisions. Whether they are is ultimately a matter for government.
Okay, I'm going to rotate the call, Senator Chandler. Okay, I'm going to ask a few questions, but just before that, I just wanted to put on the record that, I mean, my understanding is that this committee is conducting this inquiry outside of whatever Treasury work is happening and what they are doing. They are providing evidence to this committee, and whatever evidence that we all collectively gather will go in our report and other commentary around that, and that the process is really this committee process is for this committee and for senators to determine. But in terms of my questions, I've got 2 for Treasury and then 2 for the ATO. First for Treasury, in the budget papers, these reforms are described as improving productivity over time by ensuring that investment decisions are made for economic reasons and not tax reasons. And we've heard quite a range of evidence over the last couple of days about various views around that. Can you explain how the work that you've done in preparing the budget papers supports productivity, and how the design of the reforms reduces distortions in decision making, please?
So, Senator, I'll just say some introductory words and then allow Dr. Johnson to elaborate. But I will draw your attention to box 4.2 in the budget papers that clearly showed how the current 50% discount didn't accurately compensate for inflation. Indexation will do that and remove the distortion that's discussed in box 4.2. I'll ask Dr. Johnson now to elaborate more broadly on the impacts to productivity.
So Shane Johnson. So I think in terms of economic efficiency and potential productivity benefits, one of the key things the reform does is provide some more consistent treatment of the taxation of the real return. And that's across all asset classes that are generating a capital gain. As Ms. Brown highlighted before, in the budget papers we do highlight how the current arrangements tend to overcompensate for inflation for assets that generate a high capital gain will generate more of the capital gain or more of their return from a capital gain. Whereas it tends to undercompensate other assets, and so this can actually lead to distortions in investment behaviour and therefore in terms of asset allocation across the economy. And so one of the key things this reform would do would to remove that kind of favourable treatment that we have in the existing system towards those types of assets, put them on a more neutral playing field, and improve the allocation of capital overall. And that's, I think, there was a few individuals highlighted that in their testimony yesterday as well. So that's probably one of the key drivers is improving the allocation of capital across the economy, and particularly in relation to the housing market.
Okay, so by creating a neutral playing field, investors will make decisions to deploy their capital into areas that are more productive, including building of new houses. That's the summary?
So by having a more neutral treatment across more neutral treatment of tax treatment across assets, it actually helps improve allocation of assets across the economy, and therefore generate support economic efficiency, which in the longer term will drive or support productivity. And we highlighted, the government highlighted that in the budget as well, in budget paper 4.
Okay. I just want to turn to small business for a moment. There was some, evidence yesterday that we heard and some ongoing discussion in terms of the impact and realities for small business going forward when it comes to capital gains tax. Can you just confirm the existing concessions that will continue to play a significant role in reducing tax when it comes time to sell? Are there any changes? Yep.
Oh, sorry.
No.
So there's an existing capital gains tax concessions that are available to small businesses. So these are small businesses that have, for example, turnover less than 2 million or have assets less than 6 million. There are 4 particular concessions. They all have specific eligibility requirements. The 4 concessions are there's 50% discount where the asset has been, where it's for an active asset, where it's been held for at least 15 years. There is, for less than 15 years, there is an exemption, capital gains tax exemption, where the asset's been held for more than 15 years. There's also a CGT exemption where the proceeds are used to put into a superannuation fund that has a lifetime cap, and then there's also a rollover relief as well. So where the capital gains transferred into another small business. All those provisions are maintained underneath the new arrangements.
Yeah. Thank you for clarifying that.
And those concessions, so in terms of eligibility, we think around 90% of small business, or 90% of business are eligible for those under the turnover test.
Yeah, we did hear that yesterday. Thank you for confirming that. And are there other parts of the reform package that support small businesses and startups that you would particularly point the committee to?
So the reforms would have a number of additional measures that would support small business. So in particular, the reforms go to reintroducing the loss carryback. So this allows firms to, if they incur a loss in a particular year, they're able to offset that loss against a previous year gain and get a refund. So that actually helps with risk-taking behaviour and also supports small businesses in times when they have a loss, and they often provide something like a cash flow boost as well. In addition, there's another loss provision where smaller companies are able to get a refund of a loss that they may have incurred, where they've paid other tax, such as pay-as-you-go tax or fringe benefits tax as well. So they can claim a deduction up to that amount as well. Again, that helps businesses in times when they're in a loss situation. So particularly in that. So the second one was for startups. So particularly for startups when they're in a first taking off, where there's more likely to potentially have a loss. So now that there's one of the measures was to provide loss refundability, and then there's also some changes to the venture capital thresholds as well, which modernise those thresholds to ensure that businesses can access them and continue to grow while accessing some of those benefits as well.
And Senator, I might add 1 or 2 other measures. I think this was also mentioned yesterday. The instant asset write-off is being made permanent at $20,000. The Working Australian Tax Offset, despite its name, actually will also apply to those sole traders and their income. And the third one, the ATO could possibly elaborate on as well. It's a simplification measure. It's an app to allow businesses to better understand what their instalments are in real time. and so dynamically adjust their tax instalment payments so that they avoid either underpaying or overpaying their tax at the end of the tax year.
Thank you. Maybe I will turn to the ATO just for a couple of quick questions, and then we can rotate again. On the question of simplification, we know that when indexation was removed, the case for introducing a flat CGT was to deliver a simpler system. Ms. Brown, you've just referred to an app, and there is, as I understand it, tools being created to help with calculations and other simplification measures. With the benefit of modern technology, can you talk through, this is for the ATO, how this question of simplicity is a compelling justification today and how we should think about that?
Thank you, Senator. So, Will Day, Deputy Commissioner speaking. I might say that at the outset that we are confident in our ability to administer the changes once the legal frameworks are legislated, and to do so in a way that's as supportive of taxpayers as possible. It is, of course, something that we have significant practice in. So we will prioritise resourcing to consult on topics for public advice and guidance, and then to prepare formal advice, other guidance material and website material, etc. We will develop tools and calculators, inquire into where third-party sort of data sources might be available. We'll work closely with digital software providers and tax professionals and update our own lodgement software. We're confident that we'll be system ready. And I guess if I take a step back, the indexation was a regime we administered up until 1999 when it was a much more paper-based system. Again, we are prioritising the development of tools, and this will complement a significant program of work that's already underway to help taxpayers get their affairs right, and which is focusing on really building a digital-first tax ecosystem, which we think will complement administration of these changes.
Thank you for outlining that. I think, we've heard some significant anxiety from some witnesses about the magnitude of some of the changes, so it's good to hear some of the work that's being done there and that you're confident that you will be system ready. My final question is just, again, this live debate that we've been hearing about tax settings to apply broadly. So just, what are some of the compliance and implementation challenges and risks from different tax treatment applying to different assets?
Thank you, Senator. So, Will Day again, and without commenting on matters of tax policy, from a purely tax administration perspective, there certainly are some advantages in having the CGT changes apply to all classes of assets. That is, we could well imagine that if the CGT changes were only to apply to certain classes of assets such as real property, that could give rise to planning or arbitrage opportunities to get around at least some of the desired policy outcomes. So in a really simple sense, you could imagine taxpayers considering holding existing real property via an investment company, and when it comes time to sell that land, rather than selling the property itself, to sell the shares, if, for example, that would give them access to discounts in terms of sale of those shares.
Mm-hmm. Thank you. I will rotate the call. Senator Smith.
Thank you very much, Chair, and thank you to officials for making themselves available this afternoon. You may have noticed, if you've read some of the submissions, that there are some concerns about negative consequences for charitable giving to not-for-profits, charity organisations, community groups, etc. First question, how has the Treasury been engaging with affected or impacted groups around those particular concerns?
Senator, we are aware of that feedback from the charity. There has been feedback from charities and as reported in the media as well. And we're we're giving that feedback consideration and looking to provide advice to government.
Okay, so if you could just be a little bit more specific, have you engaged with particular individuals or organisations to more clearly understand what is the nature of their concern?
So I might see whether Mr. Preston can add more.
Yes, we have, Senator. It's the short answer to your question. We've engaged with a number of groups that represent interests of charitable giving.
And the long answer to the question would be if you could name them. So can you name the individuals and the organisations?
Not off the top of my head, Senator. We might take that on notice.
I'm sure you'd be able to recall some, Mr. Preston, if not all.
I'm not very good at remembering names. Apologies, Senator.
Maybe the nature of the audience.
So Philanthropy Australia, groups that are interested in supporting charitable giving in the country.
Philanthropy Australia, for example?
Yes, we met with Philanthropy Australia. We've met with other groups. But yeah, so Philanthropy Australia is one I can confirm, but we can take the broad number of groups on notice.
Communities Council of Australia, of which Mr. David Crosby is the CEO?
Senator, I'd rather not take a quiz on.
No, sorry, Mr.
I've taken it on notice, and I'll get back to you.
No, Mr. Preston, you cannot take a question on notice that you know the answer to. And what I'm doing is because I do not want to have to wait for these answers. I would like to get these answers today or the next few days. Did you consult with Mr. Jeff Wilson and Future Generation who made a submission?
So one of the reasons I want to take it on notice, Senator, is there'll be people that have whose names that if I had a better memory I could recall, but then there'll be people that I have not met with but colleagues have, and one of the reasons to take it on notice is to ensure I don't misinform the Senate as to who Treasury has met with on this topic.
If you inadvertently misinform the Senate, you're free to correct the record. So,
Sure.
Have you met with Mr. Jeff Wilson? Have you met with Mr. Jeff Wilson?
I have not personally, no, Senator.
Has any official in the Treasury?
I don't know, Senator. I'll take that on notice.
Has the consultation around the consequences for charitable giving concluded or is still ongoing?
We continue to meet with people from the sector, so I would say it's ongoing.
On notice, will you provide me a list of all the organisations, the individuals and the date on which you met them thus far?
Yes.
In evidence earlier today, Mr. David Turner, who's a witness to this committee, confirmed that he'd met with you, Mr. Preston, and two other officials from the Treasury. What were the circumstances that led to that opportunity for Mr. David Turner himself, by himself, to meet with yourself and two other officials? What's the background to that?
As we were consulting with a number of organisations that have interest in the startup sector. Some of them were reaching out to Treasury directly, others were reaching out to the Treasurer's office. The Treasurer's office, I believe, passed on Mr. David Turner's contact details and a meeting was arranged.
Again, just on notice, could you just provide us with some information or with details of which stakeholders were referred to you from the Treasury's office and on what date you and which officials from the Treasury met with them?
I'll take that on note to see what we can provide, Senator.
Thank you. In evidence earlier today, Professor Stewart said that she had been involved in the preparation of various reports and documents, etc., which is not surprising given that she was a principal advisor at the Treasury. Can the Treasury provide me with a list of documents, reports that Professor Stewart had a meaningful contribution in?
Senator, we can do our best to do that. She was involved in a range of work. As you know, we've discussed Professor Stewart's work before. She was engaged some time ago, but I'm happy to try and see if we can't get you that list of work that she was involved in.
That's right. I think she might have left her special role in 2025, so not so long ago.
Yes, she worked for us around 23, 24.
That's when she started, I thought.
Yes, she finished working for us in 2024 as well.
The Assistant Minister confirmed in his National Press Club address that modelling had been undertaken as part of the budget work. On notice, can you just provide the names of the actual modelling exercises that were undertaken? I have received a letter from you, Ms Brown, that says release of the modelling itself is a decision for government, but I'm interested in understanding what was the scope or the full scope of the modelling exercise in the broad, and whether or not you can provide me with a list of the names of the various modelling exercises that were undertaken.
We can take that on notice, Senator. Yes.
Great. Thank you very much. I think that's my 10 minutes. Okay.
We have no more questions.
He's got more questions.
Oh, okay. Mr. Preston, as part of the work that you're doing in regards to consultations around the negative impact to charitable giving, have you, as part of that consultation, are you doing any separate or independent analysis around those that have been able to quantify what they regard as the impact?
We've been engaging with stakeholders to understand their perspectives and sought their views on what they consider the impact of the settings would be, and sought feedback on on what in their view could be done about it.
Because I asked the question because there's a range of figures out there.
We haven't commissioned any sort of specific modelling on the question, if that's what you're implying, Senator.
Oh, no. I'm just asking whether or not, because there's a range of, the modelling question I'm satisfied with. I've written to Ms Brown, she's provided me. I've now written to the Treasurer himself, asking for the release of that. I suppose I was just curious to know that you were sort of testing, because there is a range of numbers that have been identified. I was just curious to make sure that you were sort of putting some interrogation over those numbers, however you might choose to do that.
Well, yeah, we engage with stakeholders in good faith. We try to understand what they consider the impact to be. People often bring a range of different views on potential impacts. I think on a question like this, how big could the impact be? It's not a straightforward question, so I guess my hesitancy is more that I don't think it's sort of reasonable to sort of expect stakeholders to necessarily be able to quantify or estimate a figure like this in a particularly kind of detailed way.
Oh no, but some have. And my question was whether the Treasury, you yourself, and whether other Treasury officials had sort of put some of those numbers under a form of interrogation or analysis, because there are different sorts of numbers out there. That was conceded. I mean, some people think it's small, which I think is a bit hard to believe, but we'll sort of take that on face value for the time being.
We've certainly tried to understand the impacts as best we can and draw in a range of different data sources, Senator.
Okay, I think I have probably, so I could go on and on and on, but I'm getting a stare, which is being directed at me and not Treasury officials on the phone. So
they're not here to stare at.
Thank you. Correct. Thank you very much.
We've still got time. Okay. Well, I do think we have concluded all of our questions. So thank you, Senator Smith, for that. That concludes today's hearings. Thank you to all witnesses who've appeared throughout the course of the day, and to Hansard and Broadcasting for their assistance. Responses to any questions on notice should be provided to the committee as soon as possible, and the committee stands adjourned. Thank you.